News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we begin with the latest on the wildfires in Los Angeles. The death toll remains at 24, with at least 3 active fires raging across the area. Another round of dangerous weather is in the forecast today for wind gusts as high as 50 miles an hour. Los Angeles County Deputy Fire Chief Robert Harris says people need to be ready.
Severe weather conditions will continue through Wednesday. Please be assured that the Los Angeles County Fire Department is prepared, and we are anticipating winds and low humidity and low moisture, which will be a threat to the Los Angeles County area.
Deputy Fire Chief Robert Harris says that threat extends north to Ventura County as well. At the White House, President Biden is looking ahead to the recovery.
The federal government is going to cover 100% of the cost for the next 180 days for things like firefighter overtime pay, debris removal, temporary shelters. It's going to cost tens of billions of dollars.
The president spoke at a White House briefing. Wells Fargo.
Everyone, good evening to all of you. आज है 14th of January 2025. लेवल्स की बात करें, क्रूड ऑयल में कल के लेवल है, कोई चेंज नहीं हुआ है. कल साइडवेज था काफ़ी देर तक, फिर क्लोजिंग के टाइम पे रेजिस्टेंस पे हिट किया था. वहाँ से थोड़ी बहुत सेलिंग एक्सपेक्टेड थी, वहीं पर ओपन हुआ था. वहीं से एक सेलिंग का ट्रेड वापस मिला है. नीचे एक एफईजी बन गया है, वहाँ पर थोड़ा बहुत रुक रहा है. अगर एफईजी के नीचे निकलता है तो फिर कल का लो, और फिर हम जो कल का नीचे सपोर्ट बनाया था 6615 वाला, वहाँ तक एक टारगेट एक्सपेक्ट करेंगे. ब्रेकआउट, एनी ब्रेकआउट अबव 6880, मार्केट गिव अगेन अ न्यू मोमेंटम और ऊपर जा सकता है. तो वही कल के लेवल से वापस सेलिंग का प्लान रख सकते हो. एफईजी ब्रेक हो तो और क्वांटिटी ऐड करना. बाकी अगर बाइंग का प्लान करोगे तो ब्रेकआउट पे कर सकते हो अगर ब्रेकआउट होता है. ऊपर और कोई लेवल है नहीं, 15 मिनट में शो नहीं हो रहे. सो क्रूशियल लेवल है काफ़ी. डेटा की बात करें तो न्यूयॉर्क सेशन की ओपनिंग 7 PM पर एक डेटा है गोल्ड और सिल्वर के लिए, एंड फिर 8 PM पे यूएस मार्केट ओपन होगा. चेंज इन क्रूड ऑयल लेवल. गोल्ड और सिल्वर में देखें, गोल्ड भी साइडवेज ही चल रहा है. गोल्ड में भी कल के लेवल है, कल एक सपोर्ट तो ब्रेक कर दिया था इसने. फिलहाल रेंज बाउंड चल रहा है. नीचे एक सपोर्ट है अच्छा 2650 एंड 2660. ऊपर रेजिस्टेंस मुझे लगता है ब्रेक हो जाएगा अगर जाता है तो, नहीं तो 2675 एंड देन मेजर रेजिस्टेंस 2700. सिल्वर को भी अगर देखो, बाउंड है, डेटा है इसलिए काफ़ी देर से रेंज में बना हुआ है. नीचे देखो एक सपोर्ट अच्छा है अराउंड 29.12 के अराउंड. बाकी ये दोनों लेवल तो मल्टीपल टाइम टेस्ट हो गए हैं, तो मेरे अकॉर्डिंग कहीं ब्रेक हो जरूर होगा 29.50 और 29.87. ऊपर फिर नेक्स्ट रेजिस्टेंस जोन हमारे पास कल का ही हाई है 30.37. बाकी ये 30.72 तो आई थिंक टेस्ट हो गया, इसको अवॉइड करना ये वीक है. सो दीज आर द गुड स्ट्रॉन्ग रेजिस्टेंस जोन. बाकी रेंज है, अभी मॉर्निंग से रेंज बाउंड ही चल रहा है सिल्वर और गोल्ड. डेटा इंपॉर्टेंट पीपीआई का तो ध्यान रखियो. गैस को देखोगे, गैस को देखते हैं. एक सेकंड लेवल बनाए नेचुरल गैस के लेवल से देखते हैं.
And Goldman Sachs estimate the insured losses could top $30 billion.
Meanwhile, Nathan, officials are still looking into what could have caused these fires. L.A. County Sheriff Robert Luna says they're investigating whether power lines owned by Southern California Edison could have sparked the Eaton fire that's devastated Altadena. But the CEO of Edison's parent company, Pedro Pizarro, tells Bloomberg there's no evidence the lines were having any issues.
Typically, when you have a fire caused by electrical infrastructure, you do see a signature, voltage dropping, current increasing. We have not seen that in our study.
CEO Pedro Pizarro's Edison International is facing a lawsuit over the Eaton fire. Residents have also filed a lawsuit against the L.A. Department of Power and Water over limited water supplies to fight the Palisades fire.
Another developing story we're following this morning, Karen, involves the release of special counsel Jack Smith's report on President-elect Donald Trump. He says the president-elect could have been convicted for trying to overturn the 2020 election. We get the details from Bloomberg's Gina Cervetti.
The DOJ released Smith's 137-page report after a week of legal wrangling over whether the document could be made public. Trump's team had made emergency requests to federal courts to block it from being released. Had they succeeded, the new administration could have buried it for good. The report details Trump's efforts to pressure Vice President Mike Pence to reject congressional certification of the 2020 election, including a deadly attack on the U.S. Capitol on January 6, 2021. The report also highlights Trump's refusal to help stop the riot and his continued support for those who attacked the Capitol, which Smith sees as further evidence of Trump's guilt. Trump and his allies have long railed against Smith's investigation and findings, saying they represent a baseless political attack. Gina Cervetti, Bloomberg Radio.
All right, Gina, thank you. Well, we turn now to the Middle East and major developments on a ceasefire deal between Israel and Hamas. The Associated Press reports the two sides are finalizing terms on a deal, with Hamas officials saying they've accepted a draft agreement. The AP says Israel is still weighing the deal. However, both sides have warned talks could still fall apart. It follows comments from President-elect Trump and President Biden, who both say a pause in fighting could come before Inauguration Day next week. U.S. National Security Advisor Jake Sullivan also told Bloomberg he's optimistic about a deal.
I think the pressure is building for Hamas to come to yes. I think Israel also has achieved a huge amount of its military objectives in Gaza, and therefore they are in a position to be able to say yes. So there is a distinct possibility that we can get this deal done this week before President Biden leaves office.
Well, despite progress, U.S. National Security Advisor Jake Sullivan still urges caution about a possible ceasefire. The proposed deal would involve a 42-day truce, with Hamas releasing 33 hostages in its first phase, according to senior Israeli officials. Palestinian prisoners will be released from Israeli jails and a buffer zone established in Gaza, with further negotiations to follow.
Now, Karen, a Bloomberg News exclusive. Some of Donald Trump's economic team are considering a plan to gradually increase trade tariffs. Sources say the discussions are looking at a ratcheting of levies by about 2 to 5% each month. We get more from Bloomberg's Kriti Gupta.
This, of course, is still a proposal that's being reported on. It's not official yet. And it's also being proposed by people who are not in power just yet. So there are a lot of ifs and buts involved. But the crux of the idea is simply that it uses an act that grants emergency powers to the president when declaring that the country is in a national emergency.
Bloomberg's Kriti Gupta says Scott Bessent, Kevin Hassett, and Stephen Moran are working on the plan, but the gradual tariff hike proposal is in early stages and has not yet been presented to Trump. A spokesman for the transition team refers to the president-elect's previous public comments and social media posts about tariffs.
Well, Nathan, Elon Musk will continue to have major access to Donald Trump when he takes office. The New York Times is reporting Musk is expected to use office space adjacent to the White House as he launches the Department of Government Efficiency. Musk owns companies with billions of dollars in contracts with the federal government. Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. The last of the wild card playoff games, the Vikings and the Rams. The game moved out of Los Angeles and into Phoenix, and L.A. won easily 27-9. Matthew Stafford, 2 touchdown passes. The Rams had 9 sacks. They advanced to play Sunday in Philadelphia. The Dallas Cowboys fired their coach, Mike McCarthy. Contract is about to expire, so he becomes a free agent. The Cowboys reportedly have already had a talk with former star player Deion Sanders, now the coach at Colorado. That's a Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
Potentially acquired TikTok's US operations if the company fails to avoid a controversial ban in the country. It's an outcome officials in Beijing have debated, according to sources familiar with the matter. While Beijing officials have discussed a potential deal involving the world's richest man, they strongly prefer that the short video app remains under the ownership of its parent ByteDance.
I'm going to have to start thinking about TikTok.
They also see TikTok negotiations as a potential area for reconciliation with the Trump administration,
Today,
despite the prospect of tough
why a new
negotiations.
Gaza peace deal could be close at hand. A special counsel report finds Donald Trump engaged in criminal efforts to overturn 2020's election.
Trump's Pentagon pick is set to face a Senate grilling, and how new oil sanctions on Russia could offer Trump a negotiating chip in Ukraine. It's Tuesday, January 14th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Jonah Green in New York.
And I'm Tara Oakes in Liverpool.
When you hear LSEG data and analytics, what do you think of? Comprehensive data you can trust. Exclusive access to Reuters News.
I'm Tara Oakes in Liverpool.
When you hear LSEG data and analytics, what do you think of?
Hostages and achieve a ceasefire in Gaza.
We have a structure which free the hostages, halt the fighting, provide security to Israel, and allow us to significantly surge humanitarian assistance to the Palestinians.
Egypt, the US, and Qatar are mediating the negotiations, and there's another round of talks in Doha today as they work to finalize the details. Our foreign policy editor, Don Durfee, breaks down why this time a deal may just make it across the finish line.
We have both Biden's Middle East envoy, Brett McGurk, and Trump's incoming Middle East envoy, Steve Witkoff, both working together on this deal. It's a pretty rare for that to happen before a new administration comes into place. And I think it's fair to say that the Biden administration really has done the great bulk of work here, right? They've been working on this for over a year. And Trump has given this deadline. He says he wants a ceasefire to be accomplished by the time of his inauguration, or else there is going to be all hell to pay. It seems like it's set this default deadline for all of the parties, and that seems to have been a helpful thing in terms of giving some people something to focus on and getting a deal done. It is really important to bear in mind that a lot has changed in the region. Hamas itself severely weakened. Hezbollah has been effectively defeated by Israel. And Syria, the government of Assad has fallen. And Assad was an ally of the Iranians who supported both Hamas and Hezbollah. So for what remains of Hamas's leadership, there weren't a whole lot of options left anymore.
A report by US Special Counsel Jack Smith has concluded that President-elect Donald Trump would have been convicted of election interference, but his return to the White House made that impossible. It says Trump engaged in an unprecedented criminal effort to hold on to power after losing the 2020 election. On Truth Social, after the report's release, Donald Trump called Smith a lame-brain prosecutor who was unable to get his case tried before the election. Los Angeles firefighters are braced for more high winds today, with concern they could fuel the two huge wildfires still burning. Some of the winds could reach hurricane force.
The U.S. House of Representatives has introduced a bill that would pave the way for the purchase of Greenland. If passed, the Make Greenland Great Again Act will allow Donald Trump to enter into negotiations with Denmark once taking office. Denmark has repeatedly said it's not interested in selling Greenland. The U.S. Supreme Court has turned down a bid by Facebook owner Meta to avoid a multi-billion-dollar class action lawsuit by advertisers. The suit accuses the company of overcharging them by inflating the number of people their ads might reach. With the U.S. dollar on the rise and a blowout December jobs report last Friday, President-elect Donald Trump is inheriting a strong economy. So where does that leave his campaign promises of aggressive import tariffs strict immigration curbs, and deregulation. Howard Schneider has been looking into it.
It's a very different economy than it was in 2017. There's maybe not a lot of room for improvement on some of the big top-line metrics like GDP growth and unemployment. That's not to say there aren't things he couldn't do to achieve his campaign goals, which are kind of distributional in nature, more microeconomic. Too many immigrants in jobs, let's get more native-born workers in those jobs. Too many goods made abroad, let's find a way to make more things at home. Just saying that from a big macro perspective, it's not clear how much room there is to improve.
So what happens with the economic proposals he made, for instance, with immigration?
Again, it depends on how aggressive he gets with this. Are the immigration rules going to be really widespread, aggressive roundups that hollow out industries of labor they relied on? Or is it going to be more targeted, people with outstanding arrest warrants or criminal records sort of thing that kind of has a high publicity value add, but doesn't actually result in that many people leaving the shores of the U.S.?
New US sanctions aimed at cutting off Russia's cash resources for the war in Ukraine are targeting Russian oil producers and a fleet of tanker ships known as the Ghost Fleet or Shadow Fleet. Those are ships with concealed or complicated origin and ownership. The move will likely push some of Russia's main customers, like refiners in China and India, to look for new sources of crude. It could also provide Donald Trump with some leverage on Ukraine. Our White House reporter Andrea Shalal has been looking into the timing of these restrictions.
Well, the Biden administration was at pains throughout this crisis with the Ukraine war to find a way to thread the needle, to impose pain on Russia without driving up the price of U.S. oil. That they've been struggling to sort of find a way to put pressure on the Ghost Fleet. And I think at this point, they have a lot less to lose because they're walking out the door. So we've already seen oil prices go up, and consumers are going to have to bear that price at a time when inflation has started to come down, but that doesn't mean that prices are lower.
So how's Trump expected to handle these sanctions?
We haven't heard from Trump's team specifically on this, but we do know that he likes to maintain a high level of uncertainty, and that he feels that that gives him advantages in trying to achieve policy outcomes. We also know that he's trying to end the Ukraine war and end the flow of billions of dollars of U.S. money to Ukraine. So imposing pain on Russia is not a bad thing. I suppose, in terms of his negotiations with Putin, and we do hear that there will be a conversation between Trump and Putin early on, he can say, look, I didn't put these sanctions in. I can lift them if you do this, right? So it's a good negotiating tool.
So a handy early negotiating chip for Trump on Ukraine. But a possible early headache on the cards too, as today marks a Senate confirmation hearing for Pete Hegseth, his pick to run the Defense Department.
The former Fox News host is likely to face tough questions from Democrats on his controversial views and troubling allegations over past behavior. Phil Stewart covers the Pentagon.
Pete Hegseth is one of the most divisive nominees for this job in memory. He's made a lot of very controversial remarks, including about whether the chairman of the Joint Chiefs of Staff got his job because he's black. He's opposed women in combat, and he's really railed against the diversity, equity, and inclusion initiatives that conservatives have taken aim at. And so I think he's going to find a very kind of a heated nomination hearing in a way that's not really seen so much at the Senate Armed Services Committee.
And what about the allegations against him?
Some of those allegations include a 2017 allegation of sexual assault, which did not result in charges and which Hegseth strongly denies. But there are going to be questions about whether there might have been other allegations of sexual assault against him. We reached out repeatedly to Mr. Hegseth and to the Trump transition folks for comments, and we have not gotten a response. Pete Hegseth has also been accused of excessive drinking on the job at Fox and also in his work after leaving the military at veterans organizations. He's accused of mismanaging funds at those veteran organizations. And so there are questions among lawmakers about whether he has the ability to manage a department with over $800 billion in annual budgets. What is his acumen to lead a vast organization, given that for many lawmakers, they're seeing more of a bomb thrower, more of a provocateur than a leader?
To stay ahead in fast-moving markets, you need to transform quality data into tailored, practical, and valuable intelligence.
नेचुरल गैस का चार्ट लगा दिया है. नेचुरल गैस चार्ट इन फ्रंट ऑफ यू. PM होने वाला है. लेट्स सी कुछ मूव आता है तो. बाकी क्रूड ऑयल में एफईजी का ब्रेकडाउन रीटेस्ट होता है तो फिर से सेल कर सकते हैं. टारगेट लगा रखा है वैसे तो. मार्केट है साइडवेज ही. एफईजी ब्रेक किया तो कल का लो और फिर नीचे कल का सपोर्ट. ऊपर ब्रेक किया तो फिर नया हाई. स्ट्रीम पे बोल नहीं पा रहा हूँ तो आई विल मैं कमेंट करता रहूँगा कमेंट सेक्शन में. बेटर रहेगा. रिपीट कर देता हूँ जो लोग अभी आए हैं एक बार. क्रूड ऑयल के कल के लेवल है. नेचुरल गैस फिलहाल के लिए थोड़ा बहुत बेरिश चल रहा है. ऊपर आता है तो ये कि रीटेस्ट जोन है. यहाँ पर एक रीटेस्ट के लिए सेलिंग का प्लान करना और ऊपर रेजिस्टेंस डे हाई 350 352 एक अच्छा रेजिस्टेंस है. वो तो काफ़ी अच्छा रेजिस्टेंस है. बाकी एक सपोर्ट था ब्रेकडाउन हो गया तो रीटेस्ट की तरह काम करना चाहिए इसको. नीचे एक छोटा सा सपोर्ट है. वैसे एक बार सपोर्ट ले चुका है यहाँ पर. 2 बार सॉरी. थर्ड टाइम आया है. अगर ये होल्ड नहीं करता है तो फिर नीचे मेजर सपोर्ट है आपका 319 के अराउंड. तो अगर बेटर रहेगा मैं एक्सपेक्ट करूँ कि अगर या तो ये ऐसे आ जाए नीचे, एक पॉसिबिलिटी सबसे अच्छी रहेगी. या फिर ये क्योंकि अभी ये मॉर्निंग पे ओपन हुआ था एग्जैक्टली हिट नहीं किया इसने, टच नहीं किया लेवल को. एक पॉसिबिलिटी है कि ये सीधा यहाँ से जाए रीटेस्ट को रिमूव करे और फिर गिरे नीचे इस तरह से. या फिर ये भी एक पॉसिबिलिटी है. तो ये तीनों ही पॉसिबिलिटी रहेंगे यहाँ पे. कल निफ्टी बैंक निफ्टी आप लोगों को बताया था निफ्टी बैंक निफ्टी में मार्केट काफ़ी ज़्यादा ओवरसोल्ड है. फेयर पोजीशन में है. वहाँ से बाइंग की पोजीशन बन सकती है. कल तो मार्केट थोड़ा बहुत सेलिंग में ही था बट आज रिकवर अच्छा किया. अभी फेयर और ग्रीड इंडेक्स वेरी फेयर में जाए तो वहाँ पर एक बाइंग अच्छी देखने के लिए मिलती है. डेटा का ध्यान रखना गाइस. So guys, don't forget to like this stream. सेशन ओपन होगा 6:30 पे, यूएस मार्केट 8 PM पे। पर क्रूड ऑयल में लेवल ही नहीं है।
outlooks is
10 मिनट में उतना पीछे दिख नहीं रहा, 1 आवर टाइम फ्रेम यूज कर सकते हो। गैस पुट ऑप्शन होल्ड है तो ट्रेल कर सकते हो सर। कितने पे सेल किया है नेचुरल गैस आपने? कहीं हाई लेवल से सेल किया है तो ये रीटेस्ट लेवल आपका ट्रेलिंग एसएल है। अभी सेल कर दिया तो अभी तो सेलिंग का ट्रेड है नहीं। सेलिंग का ट्रेड आपको मिल सकता है ऊपर यहाँ रेजिस्टेंस से या फिर रीटेस्ट जोन से, या फिर ये भी अगर थोड़ा सा ब्रेक डाउन कर दे तो। फिलहाल ये सपोर्ट था, थोड़ी बहुत बाइंग आ रही है यहाँ पे। हाई लेवल से कहीं सेल किया है तो आप प्रॉफिट बुक करके ट्रेल कर लो। बाकी ऊपर रेजिस्टेंस यही है, रीटेस्ट जोन 335, 36 एंड देन 350 और 52 को नया रेजिस्टेंस बन जाए तो बात अलग है, अदरवाइज these are the level for resistance.
uncertainty and unforecastability.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following a blowout jobs report on Friday, the sell-off continues. Equity futures pulling back on the S&P 500 by 0.8%. On the Nasdaq 100, we're down by 1.2. In the bond market, yields are still pushing higher. Yields up for a 7th consecutive session on a 10-year, up by 2 basis points. Your yield right now, 478.40. And to make this mix just a little bit worse, crude, 5-month highs. Brent crude back through 80, make it 81.15, going into a massive week ahead. On the data side, PPI, CPI, retail sales, then earnings, big bank results kicking off on Wednesday.
You put all this together, a real question about whether the data that we get this week will confirm what we saw in payrolls report that really spoke to the American exceptionalism, or whether it will defy it. If you get this sense that the U.S. is continuing to diverge and you get this dollar strength ongoing, you get yields higher, you get the idea of a potential Fed rate cut pushed off the table for 2025, does that only make the pain worse in global markets?
It's good news, bad news. And I think we spent Friday morning talking about that. You were the first one to ask the question. I think poured some freezing cold water over it as well, and you were right to. Stuart Kaiser agrees with you over at Citi. Good growth data outweighs higher 10-year yields, but unless and until inflation surprises, and I think we can't talk about Friday by just talking about the payrolls report. You've got to throw in you, Mitch, as well, and inflation expectations, because that poisoned the well too.
The idea that 5 to 10-year inflation expectations came in at the highest levels going back to 2008, rising to 3.3%. If you look under the dynamics of the University of Michigan sentiment survey, you could argue, again, this is a political barometer, because Democrats increased their expectations for inflation dramatically. Republicans ratcheted back their expectations for inflation, and that seemed to be the divide. That said, this has driven inflation in the past, and this is something that the Fed looks at. So even if it's political, can you take it off the table?
The political breakdown is on the edge of comical. I agree with you, Mitch, on Friday. This move in crude won't help. Brent crude this morning up by 1.7%. Anne-Marie, WTI up by close to 2%. $78 a barrel.
And you're seeing a lot of analysts come out raising their expectations. Morgan Stanley modestly talking about the expectation of Brent going higher. And this is because we've seen the boldest and most significant sanctions placed on Russia and on their crude at a time when an outgoing administration, even though this war has been raging on for years now, decide to take the most significant steps at a time when on the horizons there still are concerns of other pockets of crude supply, most notably when the Trump administration comes in and they go back to maximum pressure campaign on Iran. And that is why you are seeing not just what is happening right now with Russia, but also future. What does this mean for supply in the oil global market?
This you can file under the parade of things that maybe President Biden wanted to do before the election, but now that it's over, go full throttle, let's go, and do all the things that really he feels like are now politically insensitive. Question about whether this adds insult to injury longer term, because essentially if people are worried about the deficit, if they're worried about the idea of inflation, this doesn't help.
It's certainly hurting the equity market. We're down by 0.8% on the S&P 500 to kick off the new trading week this Monday morning. Coming up this hour, we'll catch up with Beata Mathi of Citi, looking for equities to bounce back. Maya McGuinness of the Committee for a Responsible Federal Budget on the cost of rising bond yields. And we'll speak to Mark McCormick of TD with the United States and the US dollar on a 6-week winning streak. We begin this hour with stocks falling as traders dial back Fed rate cut bets following a blowout jobs report. Beata Mathi of Citi expecting equities to rise in the year ahead, writing, quote, full-year returns should be more evenly spread between regions, though broadening dynamics may need to wait until we move further past Inauguration Day. For now, we maintain our overweight stance on the United States. Beata joins us now for more. Beata, welcome to the programme. How much of a challenge is this bond market to your call?
Morning. Thanks for having me. What a busy Monday morning it is. So, equity market, so what you've quoted is quite a constructive view on equities, but it's going to be a volatile year and there's going to be a lot of uncertainty there, right? So yes, our core overweight still into the inauguration and at the start of the year is the US. But what we've been flagging since the fourth quarter of last year is that the US market is really priced for perfection, and that's where pressures from the bond market could come stronger than elsewhere, like any other factor as well. So what we've been arguing is that now is the right time to start diversifying from very expensive price for perfection US equity market into the rest of the world bucket. Now, within the rest of the world, our model suggests that the market that has been most beaten up through all various pressures in the second half of last year is the continental Europe. So this is our preferred diversifier. And of course, when the US is under pressure, all of the markets are going to go down. But you've been seeing this dynamic starting already, that big pressure on NASDAQ or S&P doesn't necessarily translate in the same amount of pressure on the rest of the world equities, and especially in Europe.
Beata, the idea here is that you guys are upgrading Europe to overweight at a time where you're concerned about the whole price for perfection idea in the United States. And this goes to this question of, is it just the bar is so low in Europe, or do you actually see something positive coming out of the region? And I don't mean to sound snarky, but we're talking at a time where you have inflationary pressures ongoing, you have governments in disarray, and you have the potential of China's slowdown just basically eating into the region as they get caught between trade wars.
Absolutely. So these have all been pressures on Europe playing out since the summer last year, right? So we downgraded Europe before at the beginning of June with the French election announcement. Then China slowdown happened. The biggest bulk of these pressures through downgrades on EPS in Europe has happened in the third quarter of the year. We've been noticing back then that EPS downgrades from the analysts have reached recessionary levels of downgrades, of cuts. And historically, actually, it tends to be a contrarian buy indicator for cyclicality in Europe if you have a patience of waiting 6 to 12 months. So that call has started to work. The pressures continue, but these are not not new pressures, right? So the markets with underperformance versus the US have had time to price many of these in. And what we see right now in terms of, we have this proprietary what's priced in for EPS model. It's a rate adjusted model as well. And what it's telling us right now is that markets like Europe or emerging markets, the more beaten up markets in the second half of last year, are now pricing in line with this already cut EPS forecast from the analysts, right? So it's a more reasonably priced market. The US is priced for perfection, double analyst forecast. So this is where we are. Of course, it's not a smooth sailing ahead into this year for Europe, but there is a huge amount of bearishness already priced in, that's all.
This goes to the point of the weakest euro right now versus the dollar since November of 2022, dollar strength, basically money flooding into the U.S., which is going to your point of price for perfection. And I just wonder whether the currency plays into this, whether a strong currency actually will impede earnings and exports, and whether a weaker currency actually provides a tailwind to European companies.
The way I look, this is one of the potential catalysts, right, for Europe going forward. And currency, absolutely, the magnitude of moves that we've been seeing last year have been very meaningful. And when dollar is so strong, and most of the assets and investors are dollar denominated, you stay with the dollar denominated assets, as simple as that, right? Now, from our FX strategies perspective, perhaps we have another 1-2% move stronger on the dollar, but most of these moves are already behind us. Ideally, for bull on Europe, you'd like a weaker dollar. However, within the European market, we argue that the market has been very one-way positioned, just thinking about the negative. So exposure to the US, but because it's a tariff risk, very indiscriminatory treatment that we've been noticing around the presidential election. The market forgetting about the positive. So the big dollar exposed stocks have underperformed, but actually they benefit from the strong dollar.
A lot of negatives to think about, and that's the problem. Beata Manthi there of Citi. Beata, appreciate your time. Thank you. Euro dollar breaking down through 102 in this morning's session, 101.97. The lower the session, 101.78. Just on the European stock performance, just a little bit of outperformance on the Euro Stoxx 50 more recently. That's worth watching. But to your point, Lisa, Torsten Slok of Apollo, I felt like over the weekend he wrote this just for you. The narrative in markets is that the outlook for the US is great and the outlook for Europe, UK and China is not good. For markets, the problem with this narrative is that 41% of revenues in the S&P come from abroad.
I loved this line, and I love this idea, not because I think that it's wonderful for equity markets, but because essentially, how divorced can you say you are from the global market? How much can you talk about American exceptionalism and basically this wall of protection around U.S. companies if they derive 41% of their profits from the rest of this world, which goes to the European strength? How much of the European strength comes from companies who derive a significant portion of their sales from, guess where? The United States. And they actually can do a significant more exporting business because the euro is so weak. So it just goes to this question and it challenges just how much you do have this divergence.
A break of 102 on euro dollar, a massive week ahead. We've got PPI tomorrow, then we've got CPI, then we've got retail sales. On Wednesday, a long list of banks start reporting earnings. JP Morgan, Citi, Goldman, and Wells Fargo. Before we get to all of that, let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The wildfires in Southern California have killed at least 24 people and destroyed more than 12,000 buildings. Over the weekend, firefighters got a brief break from the dry Santa Ana winds that have spread the flames across nearly 38,000 acres. However, another round of wind gusts is expected to pick up later today. The National Weather Service issued a rare, particularly dangerous situation red flag warning for parts of Ventura and Los Angeles counties from early Tuesday morning until noon on Wednesday. Incoming U.S. Vice President J.D. Vance says a deal to release hostages held by Hamas could be struck before President-elect Trump returns to the White House. Vance told Fox News it could happen in the last day or two of the Biden administration. Israel said that it sent negotiators to Qatar for fresh talks. The U.S. Supreme Court, meanwhile, signaled that it is likely to hold up a law that would ban TikTok if its Chinese parent company, ByteDance, doesn't sell it by January 19th. A majority of justices suggested that they see national security concerns as overriding the free speech interests of companies and content creators. ByteDance argues that TikTok is an American company incorporated and headquartered in California. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Is this about free speech or national security? Because they are two very different stories.
Well, when you look at what happened at the Supreme Court, it sounds like they are very concerned with the tone and tenor about national security. Chief Justice John Roberts asked the lawyer, are we supposed to ignore the fact that the ultimate parent is in fact subject to doing intelligence work for the Chinese government?
Over the weekend, that cry that you heard in the streets was a whole host of teenagers realizing that TikTok was going away and trying to figure out what they're going to be doing.
Well, Ed Mills said to me last week, it can get banned on the 19th and then back on the 20th, and Trump can give it a 90-day extension, one-time extension, and they try to figure something out. But
Sure.
it's very difficult, the parameters of how this deal could get done.
In the meantime, if your social capital relies on TikTok, you're looking for diversifiers. That is what I've seen from a homeland bias.
The clock is ticking. And Mark Zuckerberg's waiting in the wings.
Oh, 100%.
More on Zuckerberg a little bit later in the program. Up next, drawing a red line on Trump's tax cuts.
We will work through this negotiation with the president, with our leadership, and come up with a number that works. If there is a tax bill that does not lift the cap on salt, I would not support that.
That conversation up next, live from New York City this morning. Good morning.
As my birthday signals another milestone in my life, I'm hopeful that if I stay true to myself and follow my instincts, my legacy will be looked on kindly for generations to come.
Equity futures on the S&P down here by 0.8%, building on the losses from Friday post payrolls. Bond yields still climbing. We're up 2 basis points on a 10-year, just south of 480 on a 2-year, back through 440. Bank of America, Aditya Bava and the team. With inflation stuck above target, the labour market stabilising, we no longer expect any additional rate cuts through this year, and in line with Matt Lazzetti over at Deutsche Bank.
And previously, they had expected 2 rate cuts, so this was a huge change for them. And this is basically something you saw across the street, with strategists at all the big Wall Street firms cutting their expectations for rate cuts. And this really speaks to how the entire yield curve is shifting upward as people talk about higher for longer. And oh yeah, maybe where we are right now isn't that restrictive.
Neil Dutta of Renmac pointing out one area of the economy where things are restrictive. Housing is simply not working. Mortgage demand is crumbling.
And we're seeing that climbing above 7%. You could see mortgage applications falling off a cliff. We have seen this, though, consistently for the past couple of years. It hasn't led to necessarily huge price disinflation or deflation, and this hasn't been the breaking stick for the Federal Reserve. So the ongoing more of the same, does it start to actually eat around the edges?
Keep this move on your radar as well, this move in crude. WTI is up by more than 2%. Crude at the moment 78.20 on WTI. On Brent crude this morning through 81.25. If you're the incoming president, you probably have some pretty strong thoughts about the outgoing president and some of the moves he's making over the past week.
Right. There's been a flurry of activity in the final weeks of the Biden administration, even though they could have taken a lot of these packages under consideration the prior year or two. When it comes to this one, someone sent me a message, a source sent me a message saying, one thing I want to make sure you realize with these sanctions is that Trump cannot just quickly lift them if he wanted to and is doing a deal with Russia. He actually needs to go to Congress to get congressional approval. So this is another reason why these sanctions have a little bit more bite to them than I think most people potentially, when they just see them on the surface, were understanding.
Inauguration 1 week away. Under surveillance this morning during a red line on Trump's tax cuts.
There's reason for all of us to negotiate in good faith. That's why we went down to meet with President Trump. He understands this. And he said to us, look, I'm with you. Come back with a number and let's work through it. And that's our objective. We will work through this negotiation with the president, with our leadership, and come up with a number that works as part of the overall tax bill. The only red line I have is that if there is a tax bill that does not lift the cap on salt, I would not support that.
So here's the latest this morning. House Republicans meeting with President-elect Donald Trump over the weekend to discuss the SALT deduction cap, calling the talks positive, but saying they got no firm commitments from Trump. The move shaping up to be a key sticking point for passing an upcoming tax package. Joining us now to discuss is Maya McGuinness of the Committee for a Responsible Federal Budget. Maya, welcome to the programme. I just want to start in the market and then get to some of the politics. How much more expensive is this bond market making the ambitions of Washington, D.C.?
Yeah, the bond market is a wake-up call for when you have trillions and trillions of dollars of debt. Higher interest rates have a profound effect on your overall budget. And so the fact that we'll be paying $1 trillion in interest payments this year, second largest item in the federal budget, squeezes out the space for talk of anything else. Spending increases, tax cuts, and it puts real pressure on the lawmakers to start thinking about fiscal issues, which is something they have been ignoring for the past years. And it is a reminder that there are real effects of borrowing too much, and we're starting to feel those effects. And this huge debt load is incredibly sensitive to those swings in rates.
Well, incoming Vice President-elect J.D. Vance certainly taking notice of the bond market. In his interview over the weekend with Fox News, he mentioned bond yields rising twice and that net interest payments, Maya, you're talking about last year being more than $1 trillion. What are they on track to be this year for 2025?
This year they'll be over $1 trillion as well.
Yeah, it's that's pretty incredible, and in terms, it doesn't really give the incoming administration or Congress a ton of wiggle room. If that is how much we are spending and the bond market is pushing back on some of this spending, what do you make of all the talk of reconciliation, tax cuts, more money for the border? Do you have an understanding from Congress on what the top line figure would be?
No, that's the big fight in Congress right now. So on one side, and this is the side that I have a preference for, there are members who are saying, my red line is, I don't want to add to the debt. Our debt is too high. The only way that you change that you break that fever, is you start using reconciliation and budgets and other tools to bring the debt down. So there are some members, and they're not enough, unfortunately, who are saying, I don't want to vote for something that would make the debt worse. But the discussions internally are talking about huge numbers, because the tax cuts, extending them without offsets, would be so expensive that there are discussions of a reconciliation number as high as $4, $5, $6 trillion in new borrowing, which would be astronomically dangerous to the fiscal situation that, as just mentioned, the bond market is already showing real nerves about.
How long do you think they will extend TCJA? Because they want to keep the top line number down, but they definitely want to make sure that they can get these tax extensions through.
Well, you've honed in on one of the possible and, in fact, likely gimmicks that there is. So tax policy should be permanent. The purpose of tax policy is to allow individuals, families, and businesses to plan with certainty. But one of the tricks to keep the cost of the bill down when you're using reconciliation is to make those tax cuts temporary. That's why we're dealing with this now, because they weren't permanent. So the first effort will be to have offsets, to have spending cuts that will offset the cost of extending the tax cuts. But I worry, and I think it's likely that in the end, a number of those extensions will be temporary, talking about just 2 or 4 years, which will hide the cost, mask the cost. We'll be back at the table having the same discussion in a couple of years if they do that. And none of the entities will be able to plan with the certainty that would make their investments decisions much more beneficial to the companies.
How optimistic, Maya, are you about the Department of Government Efficiency?
I'm a huge fan about the DOGE effort. I'm really excited about it for 2 reasons. One, it's so clearly needed. There are huge pockets of places where we could have massive savings in the federal government, from procurement for defense, from a huge healthcare industry that is remarkably inefficient in almost every aspect of how it works, to the regulations that they're looking at. So I think that's very exciting. I was concerned when they came out and said, we're going to save $2 trillion in a year, because that fiscal ambition is so far from reality that I was worried this was all bluster and kind of like the California hype cycle more than the reality of how budgeting works. But as I've seen the efforts that they're putting together, and they've walked back that metric, saying we're going to get as much as we can, $1 trillion, maybe more likely over a year, I continue to be encouraged. I think that they will find a lot of places in executive orders where you can save money. I think they will find a lot of regulatory changes. I just hope they're not all directed towards loosening regulations in the financial industry on crypto and AI, rather than thinking about where you can make things more efficiently and actually save the government real savings. The hardest pockets, though, are Social Security and Medicare, and they have said those are off the table. And as far as I'm concerned, that's really one of the tests of seriousness. Are you willing to go to where the money really is? So far, they have said that that is a red line. I get it. Politically, those are hot buttons. Nobody in Congress wants to touch them. But anybody who's serious about the budget knows that those are where the real savings are.
When you talk about they, we're talking about a sort of loosely brought together coalition of people in an area that isn't actually a department. They're not actually government officials. And there's a real question about what kind of political clout they'll have, especially at a time where everything gets watered down, when you have constituents that want everything. So at what point do you believe there's a political will to get through some of these cuts that might be recommended by DOJ?
It's a great question. I'm on one hand on the other today, but on one hand, I think we actually need to outsource some of this. Congress has failed to do its job when it's come to fiscal oversight and the fiduciary responsibility for over a decade now. And it's been really disheartening to see that the only party that cares about fiscal responsibility is the minority party trying to stop the other one from doing something. There are very few people out there really talking about how to reduce our borrowing. So I think that's great. On the other hand, obviously, a lot of the people who are involved in this have number of interests and potentially conflicts of interest with the federal government. And I think that's really worrisome at a time when we need to be rebuilding trust with how our leaders are serving as stewards for the overall economy and not just looking after their own interests. So I think their ability to disrupt and not care about the political constraints is incredibly encouraging. But I think we have to make sure that they're very transparent about how they're doing it. Biggest concern I have, President Trump, we've seen him in office before. He was not a fan of spending cuts. In fact, he increased spending massively on top of huge tax cuts, and the debt went up under him a lot because he hasn't liked to say no to things. So I think you may see a real political meeting of the minds between those working on DOJ, the opposite of meeting of minds, between those working on DOJ and President Trump, who, when he realizes how hard these things are, says, ooh, that politically is going to be difficult. And I don't know how that will play out.
We'll see if it's any different a second time around. Myra, appreciate your time. Myra McGuinness there, the Committee for a Responsible Federal Budget. Up next on the programme, Nina Richardson of ADP, joining us ahead of CPI data later this week. From New York City, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
Posting a second straight week of losses on the S&P 500. Coming into Monday and the losses continue. We're pulling back by 0.8% on the S&P, on the Nasdaq down by 1.2%. Similar move on the Russell. The wire's all over the place. It's in the bond market, it's in commodities as well. So let's get to fixed income first. Yields up again by 2 basis points. Yields are climbing for 7 consecutive sessions, close to 480. 477.99. Wasn't just payrolls on Friday. A few hours later, Lisa, we got the UMich inflation expectations read, and that wasn't pretty either.
The idea that some people were saying you can basically discount some of the strength in the payrolls report by saying that the inflationary impulse in the wages was shattered. When we got the University of Michigan sentiment survey, people looked at the actual details. They said, okay, this is Republicans feeling fine about inflation and Democrats feeling terrible about inflation ahead. And it led to the highest inflation rate going back to 2008. Nonetheless, it really puts that much more pressure on Wednesday when we get that CPI print. And it just speaks to how jittery this market really is.
So you can always poke holes in UMich. We often do on this program. The survey director said this: nearly 1/3 of consumers spontaneously mentioned tariffs, up from 24% in December and less than 2% before the election. There is an important piece of information there, I think.
People are concerned about what's to come and the sort of threat of policy to come. And frankly, I wonder if it's just consumers or whether it's also companies. And one thing that Mohamed El-Erian was talking about on Friday that I thought was fascinating is companies aren't going to deal with tariffs the same way this time as they have in the last. They don't put prices anymore on the packaging. They can adjust pricing in real time in a new kind of way. And consumers are used to not being able to check prices because they've been moving so quickly.
They're going to move even faster potentially in the months to come. I want to turn to crude just briefly to give you some numbers. Crude's rallying once more, higher by more than 2% on WTI, 78.11 on Brent crude, back through 80, 5-month highs, up by 1.8%, 81.16. We'll come back to that move in just a moment. Under surveillance this morning, 2 rounds of dry Santa Ana winds are heading for Southern California as fire crews struggle to contain the massive blazes in the region. The National Weather Service issuing a particularly dangerous situation warning for Malibu, the San Fernando Valley and Ventura County, with 70-mile-per-hour winds forecasted from early Tuesday through Wednesday morning.
It's horrendous. To give some perspective, the 40,000 acres that have burned accounts for something that is bigger than the city limits of San Francisco, Pittsburgh, Boston, and Miami. It is a shocking amount of land. There now is the question of, is this something that is a result of global warming? Is it something that as a result of human failure and planning? Or is it two stories that can be coexistent, where there are climate changes happening and it is getting more expensive and more difficult to adequately respond to it at a time where authorities really need to do so?
The destruction is pretty shocking. The Palisades fire is the 3rd most destructive in state history. The Eaton fire, the 4th most destructive in state history. These are all the wrong kind of records.
Absolutely. And you have AccuWeather coming out over the weekend talking about the total damage and economic losses. Tragic, $135 to $150 billion. And this is before the fresh news we have of these tragic winds that are going to be picking up, and potentially the fact that these fires are not abating just yet. This economic toll is going to be crushing on California.
We'll talk about federal assistance later on in the program, but the incoming administration, the tension between President-elect Donald Trump and Governor Newsom, I think, is worthy of attention through the next several weeks or so. Back in September, President Trump said, regarding his demands for water delivery and forest management, if he, Governor Newsom, doesn't sign those papers, we won't give him money to put out all of his fires. Of course, context matters here. This was back in September. People around the incoming president have said he will continue to help in the same way that President Joe Biden has, but I wonder how much will change in the next several months around this issue.
He's going to want to make a trip out there, and he's going to want to point to what he perceives as the failure of governance from Governor Gavin Newsom. J.D. Vance, though, was over the weekend asked about this, and he said that the incoming administration intends to have FEMA and other federal responses continue to help, but also saying better clued in on what's going on the ground. So I think they're going to want to take a more hands-on approach on California.
More on this story a little bit later. I promised you an update on crude again. Crude surging to a 5-month high. All of this following fresh U.S. sanctions against Russia's energy industry. The measures targeting large exporters, insurance companies and more than 150 tankers. The move potentially forcing refiners in India and China to seek alternative supplies. A big question about the timing on all of this.
There's a lot of question about the timing. Many people are being very critical of the Biden administration. This war has been raging, Russia's invasion of Ukraine, for years, and now they're waiting for the final weeks to actually really make a bold action when it comes to sanctioning, not as much as the U.S. has sanctions on Iran, but closer, much closer, going after Gazprom Neft and Surgutneftegy Gas. These are two massive producers. We're talking about 800,000 barrels of oil, and it comes at a time when there are critical concerns about supply in the oil market when Trump comes in terms of maximum pressure on Iran. So how much more can we see risk premium added to the price? I will say, if you're Saudi Arabia or the UAE, you might be liking this. And you're probably reaching out to China and India and saying, we'll fill that gap.
All I could say is, what's next? He's got a couple more days. I saw the tour. I mean, it basically is the last week, tear and reap his consequences that he's been looking to do that have no political really back through to him.
Watch this space. More still to come. There's 1 week to go, a week until inauguration. Elsewhere in China, trade surplus there, reaching a record $992 billion in 2024. That's 21% higher than the previous year. Exporters rushing to make up for sluggish demand at home and get ahead of President-elect Donald Trump's return to the White House. An interesting detail in this export data, Vietnam overtaking Japan as China's 3rd largest export destination for the first time. I'll bring you some of the numbers now. Exports to Vietnam in 24, rising almost 18% to a record $162 billion.
And where are those exports going? They're not going all to Vietnam. They're going to the United States. And this goes to the whole point that we keep hearing about, that a lot of the trade restrictions have just created markets in places like Thailand and Malaysia and in Vietnam that act as sort of third parties that can take in those exports from China and then repurpose them and put a Vietnam or a Malaysia on them and send them back to the U.S.
It's the backdoor way of this idea of friendshoring, which is why you see really both parties also talk about the concerns with Mexico and China building these factories on the border with the United States. Back to the other story on oil. To your point, Lisa, sanctions don't always work. Sanctions just create new markets. Someone at some point will fill those demand. The question I have for China overall, though, is this really about Trump and his tariffs? Or how much is this about the fact that China has a really sluggish economy? They don't have the domestic demand. So if they can use anything, any nervousness in the market and the economy about the incoming Trump administration, they're going to do it to try to dump their exports somewhere else.
Two important dimensions to the same story. Let's turn to the data coming through this week. CPI and on Wednesday, after December's blowout jobs report. Neela Richardson of ADP writing, given the uncertainty of last week's jobs report, the CPI will either reverse Friday's market sell-off or justify it. Neela joins us now for more. Neela, good morning. It's good to see you again.
Good morning. Good to see you.
256,000 on Friday. How strong was that 256,000 beneath the surface?
You know, it was, according to the report, it was driven by private sector jobs. 223,000 of that 256 came from the private sector. The last time in September that job gains were this high, it was driven by government and healthcare. So this is actually a sea change. It's the same number as September almost, but the composition changed. And it looked like from that report that private sector was accelerating at the end of the year.
So, and I know that the ADP report doesn't necessarily track the same kinds of metrics that the non-farm payrolls report does, but it was actually a lot less optimistic.
It was.
And I'm wondering why the dissonance there.
We saw a downshift in private sector hiring. And you're right, part of this is a data construction difference. BLS is counting the number of people who received a paycheck. ADP is counting the number of active employees on payroll. And we are seeing that disconnect in the broad numbers. But let's focus on the areas of similarity. Manufacturing shed jobs in the ADP report, weak in the BLS. Healthcare was dominant in both reports. But overall, yeah, we're seeing a slowdown in job growth, not an acceleration.
Which is the reason why I saw a number of reports, in particular from Pantheon Macro, talking about the likelihood this was going to get revised lower, because they actually questioned some of the responses to the surveys. Would you agree with that?
I think history has borne out over the course of the year that we've seen big revisions in the BLS first print. And that's because the survey response rate has come down. So by the second, third print, you're getting a much more robust number than we see in the initial number. But the issue for the markets is you trade on that first number, not the third. And so that's why I think looking at these two reports gives you a range of what the private sector is doing.
So based off these two reports and how the market reacted, even though you think maybe it's going to get revised, how offsides is the market going to be for that potential revision?
Well, if the market, maybe this is an educational opportunity, if the market is looking at wages, wages are going to tell you a different story than that really robust 256,000 number. It's going to tell you that wage growth has stepped down a little bit in both reports. And if you follow the wages to inflation, that means lower labor costs, and you match that with higher productivity gains that we've seen so far, you might get a better feeling in your stomach going into January that at least wage growth is not likely to trigger inflation.
We talk about this a lot because you do a lot of work looking at workers and employees. Who has the leverage right now?
Well, I don't think anyone has the leverage. If you look at the historical level of layoffs we're seeing right now, it's very, very low. So employers are keeping their employees tight. And what employers are thinking about is not how to add headcount or replace headcount. They're thinking about how to make their headcount more productive, how to make their workers more skilled, how to engage them and how to keep them. At least that's where we are right now. So we're in this moment of stasis where neither side has the leverage to until we go further into the 2025, where I think we're going to see employers dominate the labor market this year.
Neela, there were some big moments in Q4 where the data was quite disrupted by strikes, by other things like hurricanes as well. We've got another big issue to deal with now. How disruptive will the incoming information be now, given the wildfires in California?
if you use the hurricanes as an example, the damage they did in the Carolinas did show up in that jobs report. And I would think that LA, being the massive market in terms of job creation that it is, especially for retail and leisure and hospitality and the service sector, and you match that with the massive amount of damage and destruction we're seeing on the ground, I think it will have an impact in the jobs report, maybe not in January, but also in future jobs reports as well.
One of the biggest economies, not just in America, but on the planet.
The 7th largest in the world is California, and LA is a key component of
Amazing.
that.
Yeah, honestly, this is absolutely tragic and will have ripple effects at a time where you have to wonder what other effects it will have, like on housing prices. I mean, talk about some of these regions that don't have a lot of housing supply where prices were going up. Well, you have this type of situation. Doesn't that cause inflation on some level? Doesn't that actually really create demand for a lot of these workers?
Right. And it's not just about housing, which is a key component of inflation, as you mentioned. We've been tracking that all year. It's also agriculture. We're talking about a highly dense area, but we're also thinking about how this affects, how it has ripple effects into other industries that are dominant in California. And so if you're looking for places that will trigger inflation, I would look away from the headline jobs report in December and these pockets of activity that have been compromised by climate events.
Nita, appreciate your time this morning. Lots to think about. Nita Richardson there of ADP. Equities this morning, lower once again, building on last week's big losses. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Vice President-elect J.D. Vance attempted to dial back the campaign's promise to pardon all protesters involved in the U.S. Capitol riot on January 6, 2021. Vance said those who behave violently should obviously not receive pardons. President-elect Donald Trump has also modified his stance, saying many will be pardoned and there could be exceptions for people who, quote, got out of control. Apple trading lower in the pre-market this morning by just under 1%. The company sold 5% fewer phones globally in the final quarter of last year. It was due in part to the lack of Apple Intelligence features on its latest iPhone 16, which are still not available in China. Apple's market share slipped to 18% as Chinese rivals like Xiaomi and Vivo gained ground. Samsung, for its part, also lost share. Blue Origin has delayed the inaugural launch of its new flagship rocket this morning, dealing with an unspecified issue with the vehicle. The Jeff Bezos-backed firm is trying to mount a challenge to Elon Musk's SpaceX, but it repeatedly delayed its targeted liftoff time during a 3-hour launch window in Cape Canaveral, Florida. Blue Origin didn't give any detail on when it would next try to fly the New Glenn rocket. Bezos told Bloomberg on the eve of the attempt that the space industry has room for multiple winners. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the program, dollar strength.
The dollar's benefited. The EM currencies have not benefited, and and the rest of DM has been suffering. So the dollar move and the rate move in the U.S. Combined really does start to kind of cause issues for all markets going forward.
That conversation continues up next on the program, live from New York. You're watching Bloomberg TV. Not a great mix this morning. Crude higher by 2%. Bond yields elevated by another 2 basis points. The 10-year just south of 480. Bringing equities down with some more dollar strength. We're negative by 0.8% on the S&P 500. Under surveillance this morning, dollar strength.
The dollar's benefited. The EM currencies have not benefited, and and the rest of DM has been suffering. So the dollar move and the rate move in the U.S. Combined really does start to kind of cause issues for all markets going forward. There's only 3 ways you can fix that U.S. outperformance. Either the rest of the world catches up, the U.S. goes sideways, and nothing ever goes sideways, or the U.S. goes down.
So here's the latest this morning. The US dollar surging to its highest level since November 2022, following an upside surprise on payrolls. Mark McCormick of TD Bank writing, the dollar remains the only game in town, and US data is getting better, not worse, supporting a solid backdrop for US flows. Mark joins us now for more. Mark, welcome back to the program, sir. Talk to me about those flows. You've talked in the past about the importance of the performance of a domestic equity market, and I think there are some subtle signs that just more recently you've started to see some performance kick in on a Euro Stoxx 50. How important is that?
Well, I think what's important is it's kind of U.S. equities are slipping, but everything else is slipping almost harder. You can see that, yeah, Euro stock has not declined by as much, but if you look at local currency terms or adjusted for currency flows, it's down pretty significantly as well. I think a piece of it is that the rates market, the tightening of financial conditions is feeding back into equities, and it's causing risk off, which is now feeding back into the dollar. So now you're kind of moved to the other side of the smile where the world's kind of looking like it's in a worse place. And now we're seeing oil prices rising. And it feels like, to me, it feels like the themes are is US is exceptionalism. Europe is more stagflation. And the more that we see kind of elevated oil prices and we see slowing growth in Europe and we see somewhat like sticky inflation, this is not good for European currency. So it's still, again, regardless of positioning or valuations, the market is transitioning into a new environment. And this price discovery is still bullish for the dollar, especially when we look at the data, which is where we were last year, data dependent. It's data dependency, geopolitics, geomacro, and Trump 2.0 are still going to be bullish for the dollar.
Mark, when you see big, powerful moves like this, you know better than most, it's not much time for nuance. But if we could take just a minute or so for a little bit of nuance. When you look at various currency pairs at the moment, are there currency pairs where this dollar is inflicting unnecessary pain? And are there currency pairs where this dollar is forcing a necessary adjustment? How would you draw the distinction between the two?
So I think it's kind of a massive wave that's hitting all of them at the same point. There's just so much unpredictability. Again, you think about CAD. I don't see the reason why CAD should be a part of the discussion on U.S. tariffs. Again, there's a piece of it. The big driver of the U.S. trade deficit with Canada is energy that's refined basically in the U.S. So it's not that it's not like when you talk about the trade surplus in China, which is, again, one of the main things that Trump's focused on is kind of reducing that trade deficit with China. That's not the game with Canada. Maybe, again, that's the game with Mexico. Again, you look at Europe. Europe has the same composition. Germany has the same export composition as China, which is why it's been so challenging for Germany to remain competitive, which is why we're seeing the political uncertainty in Germany. Its business model is broken from what we've seen over the last 20, 25 years. So I think when we think about the currency pairs, everyone's kind of being impacted by the same uncertainty, which again is reinforcing the strength in the dollar. But the key thing that's happening is governments are trying to find ways to stimulate their economy at the same time that inflation is elevated. So you see fiscal and monetary policy working together and rates are selling off and curves are steepening. And that's creating a lot of panic and uncertainty. And this is just an environment, again, given the outperformance of U.S. data where it flows back to the dollar. So euro, sterling, CAD, MEX, they're all going to continue to underperform. I think the one place you want to look as a hedge is, again, being long the yen, because the BOJ is probably going to have to hike again very soon.
Your defense of the Canadian loonie made me think maybe he's running. I mean, at this point, pretty much it's a pretty open field. I am wondering what you think about 6 months forward, because some of the interesting Wall Street prognostications are exactly opposed to one another. Goldman Sachs, Kamakshia Trivedi talking about we expect the dollar to rally by 5% over the coming year, pretty much in line with a lot of people what they're saying about the idea of parity. Bank of America forecasting the euro-US dollar to rise to 110 by year end, simply because there isn't going to be the same kind of inflation that comes with tariff in their mind. And frankly, the blowback on the U.S. economy is going to be more significant. Would you agree with that?
I don't think it's going to have a significant blowback on the U.S. economy. I think this is going to be more directed towards the FX market itself, where, again, you've heard other guests and you've heard the conversation around it. The dollar, a very strong dollar, is bad for the rest of the world. It's not great for Asia. It's not great for Europe. It's not great even for the U.S. I think a big piece of it here is, again, what is the North Star of Trump's economic policies? And again, while there's a lot of focus on tariffs and other things that are creating a lot of uncertainty, which is building into these risk premiums, I think the thing that Trump wants, and again, we're going to already start talking about the midterms, probably in 6 months, that'll be a key focus, is the U.S. trade deficit. You cannot eliminate the U.S. trade deficit with an overvalued dollar. So the more panic that the dollar creates, the more the dollar strengthens, the more the U.S. economy looks exceptional, the more you need to kind of have some kind of currency accord, the more you need to find a mechanism and a way to reduce the value of the dollar, which will require cooperation. So if the end game here is some kind of cooperation and the means of getting there is the tariffs, is the uncertainty, is the unpredictability to kind of get to that place where you want to create a bargain, that's where you could go in 6 months where you get a weaker dollar.
Hold on a second. Mark, I'm just thinking about the Mar-a-Lago Accord that you're basically talking about. What are the contours of this thing?
Well, I think a piece of it, right, is what's going on with U.S. and China. How do you basically get to a point where you allow U.S. and China coordinate a much stronger renminbi. Of all the valuation models we track, the Asian currencies are the most undervalued. The yen, the Korean won, the Chinese renminbi should be extremely stronger. So if you want to find a way to eliminate the strength of the U.S. dollar, you can create an accord where it say, hey, we'll give up some access to the U.S., maybe a BYD factory there, under the guise of Tesla. And again, with that, you get a much stronger Chinese renminbi. So with those type of environments, what you could see is to reindustrialize the U.S. and reduce the trade deficit, and to have that work where the U.S. is a bigger exporter, you need to find a way to weaken the dollar. So those would be situations that could reinforce a weaker dollar without even looking for the U.S. to go sideways. I think those are the kind of things you're going to see in the currency market that will actually change the outlook for the dollar, not kind of the U.S. economy moving sideways or the rest of the world catching up.
Mark, I imagine we'd have to see a whole lot more dollar strength before we got to that point. How much more dollar strength?
Well, if you think about it, dollar's almost close to record highs. So we're looking for the BDXY, the Bloomberg Dollar Index, to revisit 1350. That is, sub parity for euro. That is sterling below 120. We don't think this is going to feed directly into dollar China. We do think they're going to try to hold on to that a little bit. They can use swaps, like they can direct banks to use swaps. They can use the fixings, but that means Korea is going to weaken. Dollar CAD is going to strengthen. Mexican peso is going to hit new lows. So this is a broad dollar move. So I think, again, if we add from where we started last year, again, because most of the context around the dollar last year is everyone was very bearish on it, and that changed quite dramatically. So again, I think if you take the combination of the move from Q4, you extend that, you get the BDXY to around 1350, we are in a situation where the world feels very uncomfortable with the level of the dollar strength at that point.
Interesting. Mark, fascinating stuff. Appreciate your time, sir. Mark McCormick there of TD on the FX market and the potential for a Mar-a-Lago Accord.
Essentially, it's going to become so punitive. They have to all get together in the sunshine of Florida, South Florida.
Trump has been complaining about excessive dollar strength for a while because he's concerned about the fact that this can hurt export competitiveness and the manufacturing base in the United States.
And then embracing policies that lead to further dollar strength. So something's got to give. Up next on the programme, Chris Harvey of Wells Fargo, John Schneier of CoreLogic, Michelle Meyer of the MasterCard Economics Institute, and Michael Nathanson of MoffettNathanson on the latest moves by Mark Zuckerberg over at Meta. The second hour of Bloomberg Surveillance up next.
In this gig, you get comfortable being uncomfortable. The enemy is always adapting. Hey, handsome. Always iterating.
We've seen equity be able to perform despite the fact that you've seen a pickup in long end yields because the growth picture has been strong.
The U.S. has a particularly good spot.
We're likely to see many pockets of volatility brought on by this drip feed of tariff news.
You can have a real kind of protracted pullback.
That is basically the story for the 2025 outlooks is uncertainty and unforecastability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
If you're bullish, stay in bed. We're down again by 0.75% on the S&P, on the Nasdaq down by more than 1%. Similar move on the Russell as well. In the bond market, no help or assistance coming from fixed income this morning. Yields up again for a 7th consecutive session on a 10-year yield. Fixed income just pushing higher and pushing higher on the yield side of things. Up 2 basis points to 478 on 10s, on 30s. Had a little look at 5% in Friday's session. Yields are higher on the session this morning by a basis point to 496. And crude isn't helping either. Just the wrong time for a rally on Brent and WTI. Brent crude up by 1.7, WTI up by 2%.
And this goes to Stuart Kaiser's point. Are we seeing rates rise for the good reasons of growth, or are we seeing it for the bad reasons, which is inflation without growth? And really, the oil story speaks to that. I will just say Max Kettner of HSBC talking that we're going deeper into this danger zone of rates going higher, and it could be protracted. But he sees it as a buying opportunity. So if you're bullish and you're in bed, you can get out of bed and start to look at what your list is of buying opportunities, according to Max Kettner. Look at me being bullish. bullish.
All of this, though, just shows and goes back to you, Mitch, even though I know colored heavily on politics, that there is concerns amongst the consumer and inflation. Then you look at the price of oil, and you have to think at some point that might trickle down to fuel, especially what's going on in places like California. We could potentially see a very tight commodities market, and that's not going to bode well for this Fed.
I don't know about you, but I don't need much of an excuse to stay in bed at the moment, given how cold it is.
Okay,
So,
cold.
I don't think the market really matters too much.
Well, the fact that we wake up at 3,
It's something
or
like
the fact that it's dark out. I mean, come on. Okay,
I
look.
considered 3:30 this morning.
Yeah,
So I was
doom, gloom,
let's-
morning.
Let's really push things.
Which you didn't actually,
Let's
right?
really push things. Of
It's
course I didn't.
2:58.
No, I woke up. I'm committed to the program and all of you. Your week ahead looks like this. CPI, PPI, retail sales on the economic side of things. And we've got some earnings too. Check out Wednesday. Look at this. JP Morgan, Citi, Wells Fargo, Goldman, all reporting. Then on to Thursday. Bank of America and Morgan Stanley.
What I want to hear from some of the bank earnings, not only about what they think about M&A, what they think about some of the deals that could be on the table and just how fruitful those pipelines are, but consumers and consumer confidence, and not just for people who have credit ratings above 800, but the idea of more broadly, how much confidence does each household have at a time where Torsten Slok just sent another missive talking about how households are in incredible shape. So do we get that kind of ratification also from the big banks?
How dependent is the outlook on the incoming administration? I imagine we'll get some commentary on that on a call in a few days' time.
And also on Thursday, Scott Bessent, the designate for Treasury Secretary, will have his hearing. That's going to be very interesting, and I think the market will be paying attention to what he has to say about what's going on with bond yields, about the dollar, and maybe about sequencing of enacting Trump's agenda.
Stay tuned for all of that. Stay tuned for this as well. Coming up this hour, Chris Harvey of Wells Fargo, as stocks sink on the back of a blowout jobs report. Alex De Silva of AccuWeather, with winds set to increase extreme fire risk around Los Angeles. And Michael Nathanson of MoffettNathanson on huge changes over at Meta. We begin this hour with stocks lower, the S&P 500 on a 2-week losing streak as traders continue to dial back rate cut bets. Chris Harvey of Wells Fargo saying investors are staring at a wall of worry, driven by the 100 basis point rise in 10-year yields since September. Expect lower rates through higher rates. Ultimately, we expect higher yields to be self-correcting. Chris joins us now for more. Chris, good morning. Good to see you.
Good morning.
Self-limiting, that's a phrase, self-correcting, that we've been exploring over the past week or so. Some people think we're already there. Do you think we need to inflict a little bit more damage before we see things turn the other way?
I think so. The move has been so sharp, people just don't step in and say, okay, now's the time. They wait for things to consolidate. You know, portfolios don't look that great, risk doesn't look that great, and so they're going to say, okay, we have CPI, let's get through CPI. And then let's decide after that. So we're getting there, but I think we still have some more upside.
Speed matters, size matters. It's 100 basis points since September on a 10-year yield. Does the why matter? What's behind the more recent move? What is this, inflation, growth? What is it?
Yeah, if you talk to 10 different people, you get 10 different answers. What we think is it's really driven about the Fed and about growth, right? If you look at what's really driven nominals, it's been more or less, in the 10-year, it's been more or less real rates. Inflation expectations have been relatively well behaved, but they are pushing up against 2.5%, which we think is reasonable. We don't see inflation accelerating from here like other people. And so when you look at that, you say, okay, we're getting to a level that we think people will start to step in, but the technicals are telling you, hey, wait a little bit, there could be more upside, or there could be more upside to yield.
There could be basically a better entry point. Things could sell off a little bit more. You did wake up today. You got out of bed. You came here. I just want to say thank you. And you actually are doing what we were talking about, which is looking at the potential entry points. Right. Not maybe yet, but down the line. What exactly are you looking at to understand that?
So what are we arguing about? If I'm right, it really is about growth. Well, if the economy's strong, shouldn't that be good for earnings? And if so, maybe earnings start to help stabilize things. The other thing is, at some point, do the bond buyers start to step in? And if they do, okay, great. The other thing that we're talking about is who's going to be head of the Treasury. It looks like Scott's going to be appointed, right? There's a big talk about, hey, we could have a Liz Truss moment. Well, his experience and his influence should minimize that probability, okay? What are we looking at with regard to inflation? Well, inflation expectations already at 2.5%. Where do you think they're going to go from there? And is the economy accelerating from here? Because I think inflation is going to be demand-driven. I just don't see enough demand. The last thing I would say is one of the things that we're looking at is how the market reacts to price versus unit volume growth, right? And one of the things we were always talking about is, it's about supply and demand. Well, what we're seeing during earnings season, what we saw during earnings season, is the market is rewarding unit volume growth over price. And if that continues, that could cause a reaction function to really limit inflation.
A lot of people are worried less about Liz Truss moment, and they do have confidence about the Scott Bessents of the world maybe tamping down that possibility, and more worried about the strong dollar impeding earnings.
Yeah.
How much are you looking at something that Mike Wilson really laid out over the weekend, which is that international companies are going to see a much bigger hit and domestically oriented companies are going to do a lot better on a relative basis?
We're not looking at that so much for idiosyncratic reasons. What we're looking at that is that's a big risk factor. If you go back to the summertime, August, you saw what the yen did. If you go back to September of 2022, you saw what the pound did. If you look at the euro and the pound right now, they don't look too healthy. And typically when you see these currencies slide like that, that's a big risk factor, and that could start to weigh on the markets. Yeah, can it affect some idiosyncratic stocks and some stock stories? Sure. But we're worried more about the macro side because things are really starting to slide pretty quickly.
Do you think there's a line in the sand for the incoming administration?
When you say
when it comes to how high the dollar, they'd want to see it go?
Well, they've indicated to some degree the Trump administration would like to see, my best understanding, they'd like to see a lower dollar, but that's going to be really hard in this environment. Where you do it, how you do that, it's not really clear to me, especially if the Fed's slowing down, the economy's stronger, and the rest of the world has a little bit more stress than we do.
The economy's stronger, yet they're looking to potentially spend a lot more. I spoke to the former Speaker of the House last week, Kevin McCarthy, and he said the market's going to have a voice, right. But then really didn't know exactly how big that voice would be when it comes to deficit spending and pushing back on how much this reconciliation package could be. Do you have a sense of what the market can handle?
I don't, but the one thing I will say is that we really need to take control. We really need to moderate healthcare spending. And until you moderate healthcare spending or the growth in healthcare spending, you can't get the deficit under control.
You mean entitlements?
Entitlements. But it's really within entitlements. It's more so healthcare than Social Security.
Just getting some news I wanted to bring you. It comes from Macy's. They're trimming their outlook. The holidays clearly did not deliver, and the stock is getting hit in the pre-market. I think we're down by something like 4%, Lisa, at a moment.
Yeah, forecasting net sales at or slightly below $7.8 billion to $8 billion, basically saying, as you said, disappointing holiday season. Also, the idea of improving 50 stores to an additional 75 locations. I'm trying to understand what this means because it's talking about hiring more staff at a time where they also are closing other locations. So you wonder about the experience and how they transform what some people have experienced when they go there, which is different.
Sounds very personal, somewhat diplomatic. The stock is down by about 2, just to bring you an update on the stock price. Get some more earnings through the week. We mentioned the banks, of course. On Wednesday, you're going to hear from a ton. JP Morgan, Citi, Wells Fargo and Goldman Sachs. Can we continue to maintain the faith in the financials? Nothing was spared from the sell-off on Friday with the exception of energy, given the rally in crude again this morning. Can we continue to maintain the faith in financials?
I think so. Does that mean that they'll trade better on Friday? I don't know, right? But if you look at what the reasons why we like financials, especially banks, we still believe there's going to be multiple expansion. We still believe there's upward positive EPS revisions. We haven't even seen, right? We're talking about deregulation or lighter regulation. You're seeing the changes at a lot of the heads, but you really haven't seen things come into effect. And so we're sitting on a situation that we haven't seen in over 15 years.
Lisa alluded to this earlier in the program. Do you get a decent read on the consumer from these large financials, given that many of them serve a pretty high-end client?
Yeah, I think you'll get a decent read. And they've talked about low end, they've talked about high end. I think that the consumer is okay. Right? They're not great, they're just okay. And what we have to worry about with the consumer at this point in time is what is their psychology, right? How do they feel about things? And we've had some reports on inflation and inflation expectations, which weren't great. And if that continues, that could cause the consumer to pull back a little bit, and that is a concern.
I'm looking at the consumer's appetite right now, and it's for Blue Mercury. It's also for high-end handbags and shoes, as you deal with some of these different types of customers who go to department stores. And it sort of speaks to how much different industries are transforming right now. Yeah. How much dispersion is there right now at a time where you have those that are performing well and adapting quickly and those that are falling off the map?
I think there's a ton of dispersion. I think if you're still selling to the high end, that's great. What we do know is services still very strong. But if you have run-of-the-mill type stuff, unless you're Walmart or Costco, it's hard to push that, right? And Walmart and Costco are really taking a ton of market share, which is putting a ton of stress on other retailers.
Let us know how bonus season goes later this week, will you? All right? Chris, it's good to see you. I'm not going to go there. I kind of went there, but I'm not going
You totally did go there.
Chris Harvey of Wells Fargo. Have you seen some of the numbers we're talking about?
I know.
10% plus across
Huge.
the street.
Although I imagine some places more than others. I saw Deutsche Bank coming out. Pretty big bonus season. JP Morgan. Yeah, pretty much across the board.
I may say well earned as well, Chris. Equity futures right now in the S&P, negative by 0.9% with an update on stories elsewhere this morning. Let's get you Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Los Angeles wildfires are on track to be the costliest in U.S. history. AccuWeather has raised its estimate for total economic losses to between $250 and $275 billion. FEMA Administrator Diane Criswell says that things will need to change when it comes to rebuilding. California Governor Gavin Newsom issued an executive order suspending some environmental and regulatory hurdles to speed up the rebuild. Korea's transport ministry says the black boxes pulled from a Jeju air jet that crashed in late December stopped recording in the final moments before impact. A joint team of Korean and U.S. officials are trying to find out why the devices stopped working in the final 4 minutes of the flight. The crash killed 179 people in South Korea's worst aviation disaster. Macy's shares falling pre-market, as you all were mentioning, down 2 1/3%. The company issued a downbeat outlook for the sales in the current quarter, a sign that executives might have been too optimistic about expectations for a solid holiday shopping season. Comparable sales were roughly flat in the 9 weeks ended January 4th compared to the year before. But higher-end stores like Bloomingdale's and Bluemercury reported positive comparable sales. And that's your brief. John.
Danny, thank you. Stock down about 3%. More updates on Macy's throughout this program this morning. Up next, LA wildfires igniting political tensions.
Right now, at least from the LAFD side, we're focused on two things: containing the fires and saving lives and protecting property. With the impending winds, we got to pay really, really close attention to this.
We'll bring you the latest up next on the program, live from New York City this morning. Good morning.
Why was Saudi chosen to host the 28th World Investment Conference? We are becoming a really global thought leader. Since the launch of our Vision 2030, all the world has been watching. We know that the global FDIs are declining. However, in Saudi, for the past 2 to 3 years, we have been increasing. It's not a zero-sum game. We can all work together for the prosperity of the international community.
Equity futures near session lows were negative 0.9% on the S&P 500. Yields pushing higher by 2 basis points, 4.78 on a 10-year, and crude up by close to 2% at the moment. WTI 78. Under surveillance this morning, LA wildfires igniting political tensions.
Right now, at least from the LAFD side, we're focused on two things: containing the fires and saving lives and protecting property. With the impending winds, we got to pay really, really close attention to this. This wind event is approaching us, and it's approaching us very, very quickly. Mayor Bass, Chief McDonald, myself, our city leaders are fully committed to ensure that we're ready for this next event.
So here's the latest this morning. Los Angeles bracing for multiple rounds of Santa Ana winds this week, set to cause further destruction as political infighting continues, with Governor Gavin Newsom and local leaders pointing fingers. This as President Biden pledges full federal aid over the next 180 days. President-elect Donald Trump taking office in just 1 week. Joining us now to discuss is Bloomberg's Tyler Kendall from the nation's capital. Tyler, how well aligned are leaders in Los Angeles at the moment with federal government?
Yeah, good morning, John. Well, President Biden today will convene senior administration officials for an update on the federal response in the state. We know that the Pentagon has deployed 500 troops on the ground, and California Governor Gavin Newsom confirms that at least 9 states, as well as Canada and Mexico, have also deployed resources there. So when it comes to federal and state government working together, they seem to be aligned in that case. But as you mentioned, President-elect Trump is going to take office in about a week, and we know that he he has been invited to tour the devastation there. He's yet to publicly accept that invitation, although he is publicly criticizing the response in a post on Truth Social most recently. Yesterday, he called California officials, quote, incompetent. In response, Governor Newsom says he's used to President-elect Trump's insults and defended his own response. However, Newsom says he is asking questions of his local officials and has already directed the state to conduct an independent investigation when it comes to LA County's water supply, which has been a point of contention. John, at least one lawmaker has actually gone a step further. Newly minted California Senator Adam Schiff is calling for an independent commission to review the state's response to the crisis as a whole.
Tyler, overall, what is the future of disaster relief, especially in a place like California, where we know there's this tit for tat between President-elect Trump and Governor Gavin Newsom? What is it going to look like?
Well, Vice President-elect J.D. Vance over the weekend appeared to try to tamp down concerns that Trump would withhold aid, telling Fox News that Trump will be a president for, quote, all Americans. However, you have seen Governor Newsom, for example, point to past comments from the president-elect, most notably September 2024 at a press conference in Los Angeles, where Trump preemptively threatened to withhold wildfire aid if Newsom did not reverse course on some water regulations, most notably one that Trump would like to see divert more water to California farmers. However, I'm actually closely watching Congress on this one because, Anne-Marie, as you know, FEMA recently saw its disaster relief fund replenished in December, about $29 billion. But a chronic and also bipartisan concern is that FEMA is going through a backlog of cases and likely will not have enough money for these wildfires to cover it. That means that we're likely gearing up for additional supplemental disaster relief to be passed, likely in March when Congress considers the next government spending deadline. However, Anne-Marie, over the weekend, Senator John Barrasso, the number 2 Republican, told CBS News that that aid likely will come with, quote, strings attached. What that means, particularly for California policy, remains to be seen.
Tyler, I appreciate the update. Tyler Kendall from Washington, D.C. Let's continue the conversation. There are wide-ranging estimates emerging as analysts work to calculate the potential financial impact on real estate and insurance in Los Angeles. John Snare of CoreLogic, which produces data in response to catastrophic global events, joins us now for more. John, let's get into some of the data and whether you can tell at the moment, or if it's too early, just what went wrong here.
Well, it's one of those things where, because the fires are still spreading in containment, while increasing, fires are still not contained. Coming out with insured loss estimates or total economic loss estimates are always subject to change. One of the things we are sort of honing in on is that this is likely going to be, a $20 to $30 billion insured loss event. Definitely one of the most destructive wildfire events in the Los Angeles in history, maybe in California history.
John, this comes at a point when we've already had housing shortages in California, discussion around where people are going to live at a time where the average price in some of these areas was $3 million for homes. How do you rebuild in a place at a time when you have labor shortages, having in construction in particular, when you have insurance premia that are going to have to go through the roof, and you have real questions about what additional risks are going to be going forward?
It's a really good question. And when it comes to rebuilding, keeping this concept of, or this idea of mitigation in mind is really important, because what we saw in, if you look at historical examples like the Camp Fire in Paradise back in 2018, rebuilding an entire community with fire risk in mind can do wonders in terms of reducing wildfire risk and actually have a pretty serious reduction on wildfire insurance premium. Not just individual mitigation at the homeowner level, whether that be a Class A roof, making sure there's no combustible structures attached to your primary home, but making sure that when you rebuild, keeping in mind natural fire breaks within the community and combining these individual mitigation and community level mitigation efforts can do wonders. It can reduce wildfire losses by 75% and could have a direct impact on insurance premiums as well for homeowners who can move back to the area.
The issue is, John, and we've seen this in other areas also, is that a lot of the models, whether it's fire risk or whether it's flood risk, are not updated. They are outdated. They don't necessarily reflect the entire risk zones. And it's more expensive to put certain measures in place that could mitigate the risks. How resistant are officials when you talk with them about planning ahead if it costs more, if it actually does take more resources at a time where their resources are strapped in other places?
It's a good question. And I think officials, regulatory officials, are more open to the idea of using these forward-looking models, the stochastic models, as opposed to being reliant entirely on historical loss experience. The models are updated frequently, annually, biannually, what have you, to account for increase in risk, whether that be due to the environment for wildfires, for example, fuel layers, wind patterns, what have you, or for flood, just a higher sea level, increased frequency of flooding events. The models are accounting for these changes, and the recent regulatory changes in California that were effective at the beginning of this year, right, allowing carriers to use stochastic models, forward-looking models, means that, and what we hope, and this is what we believe will be the case, is a more healthy insurance industry within the state. There will be more carriers to be able to provide more coverage at actuarially sound rates, so that in the event of another natural disaster event, there will be finances available for home and business owners to rebuild.
But John, thousands of insurers chose not to renew home insurance policies of thousands of people. The former Speaker of the House is from California. He was telling me his mom just weeks ago lost her Geico insurance. What happens to those people?
Well, they end up going to the insurer of last resort. It's called the FAIR plan in California. And we've seen recently that more and more homeowners and business owners have moved into the FAIR plan. A similar phenomenon we saw in recent years with the Citizens Insurance Plan in Florida when it comes to wind insurance. And as these state-backed insurance plans grow in terms of the number of policies in place, well, that means there's a lot more risk. There's a lot more risk sort of within their books. And a large natural disaster event, like what we're seeing in California now, could have a pretty serious impact to that state-backed, or that state-backed insurer of last resort. Now, in California, carriers who write in the state must participate in the FAIR plan. If reserves, reinsurance, any sort of bonds, cap bonds that are in place are used up as a result of this event, the insurers will make up that difference so that all claims are paid. The downstream economic effects of that, how that applies to premiums or rates going forward remains to be seen, but those claims will be paid and people will be able to rebuild if they are part of the FAIR plan.
John, I appreciate your input this morning and your time. Thank you, sir. John Snare there of CoreLogic. I think we all have a great amount of sympathy for emergency services in Los Angeles who are totally overwhelmed by all of this. The rebuild effort is going to be absolutely immense. And Governor Newsom, whose political future is very much on the line, understands that a lot of people are taking aim at Democratic bureaucracy. And when he said this over the weekend, that when the fires are extinguished, victims who have lost their homes and businesses must be able to rebuild quickly and without roadblocks. That's the direction of travel now. They need to cut a lot of red tape to help the rebuild and help rebuild fast.
And there has to be a real assessment of what red tape needs to get cut. They also need to reassess exactly how to create a situation where structures are immunized from this type of spread of wildfire going forward. Look, there's going to be a lot of studies going forward. What I'm hoping is that we can strip out some of the politics of it and the D or the R next to whoever's name is where, and to really go toward what is the most efficient way to move forward.
And when it comes to stripping out some of those deregulations, it's going to be some of those environmental concerns California put up, and they're going to say, well, this takes too long to rebuild the home, and they're going to basically just let them go without using those concerns.
Up next on the programme, we'll continue this conversation. We'll catch up with Alex Da Silva of AccuWeather, with Los Angeles set to face further threats as the winds pick up. That conversation up next.
In this gig, you get comfortable being uncomfortable. The enemy is always adapting. Hey, handsome. Always iterating.
Stocks down for a second consecutive week last week, and we're adding to those losses this morning, taking some more weight off the S&P. We're negative by 0.75%. On the Nasdaq 100, down by a little more than 1 full percentage point. With 2 hours until the opening bell, let's get you some morning movers and say good morning to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Yeah, you're right. Look, Mag 7, long duration, all grappling with a full frontal assault from the bond market. And then you have news flow, which compounds on the downside. Apple has just had a quarter they would prefer to forget in terms of iPhone sales, down 5% globally. They're losing market share in a growth market. Why? Because their AI product perhaps isn't as exacting as the market had wanted on iPhone 16. But you got to hand it to Mark Zuckerberg. Not only has he changed the look, the style and the rhetoric and really having a pop at everybody and repositioning himself. Steve Jobs invented the iPhone. And now they're just kind of sitting on it after 20 years. I mean, that podcast with Joe Rogan is certainly, there's some moments in that are certainly worth listening to. Roll it over, have a look at Tesla again within the family. There's a bit of an offer story here. On the offer side, you got one of Europe's largest pension funds. It's called Stitching Pension, ABP. They're dumping $500 million worth of stock. Why? Because they've got angst over the pay rise that Elon Musk gave himself. On the bid side, you've got Tesla actually doing better than Audi. Yes, all of them are under pressure. Porsche, maybe I'll get that second-hand Porsche, you never know, drive around the streets in New York. Porsche sales dropping in China, but Tesla is beating Audi. What do you want, a Tesla, an Audi, or a Porsche? Go figure. Let's roll it down and finish off with NVIDIA. The reason why I've pinned this one is a couple of things. One, the story that we put out last week, which was about the new regulation on high-end AI chips, comes into force today. So the official traffic light system comes in. If you're an ally, you're fine. Everybody else has got to get in line. But we're now very firmly in the correction zone. 3 sessions took us down by over 9%. If we open down by another 3%, obviously we're down 12% then. So this is about a stock which has now very firmly entered the correction zone. You're going to hear the clarion call of this is your opportunity. This is your golden opportunity on a correction to jump in. Dan Ives, where's the note? I think it's already out.
Appreciate your time, sir. Thank you. A Porsche. Just to throw that out there. All right, a Porsche. Make it easy. Under surveillance this morning, Apple's core business taking a hit at the end of 2024. Data from Counterpoint Research saying the tech giant sold 5% fewer iPhones globally, with Apple losing market share to Chinese rivals. One reason for the slowdown, Apple AI has been rolling out in stages and isn't yet available in China.
I'm curious how much this has to do with AI availability and sort of a disappointment that it hasn't been more bold or actually more available earlier. How much this is just the national champions in China with cheaper phones actually making inroads, because that is really what you have seen is essentially huge inroads being made by the likes of Huawei technology and Honor device, basically all Chinese companies. So that, I think, is probably a big part of this as well.
And if you buy some of those national champions and their phones, the actual AI agents, they're developing on their own and they're ready in the phones. You need to wait for this hodgepodge of approach if you buy the Apple phone.
You've got to wait until January 30th to get the official numbers. That's when we get earnings from Apple, and we'll see how they stack up with the numbers coming from Counterpoint Research. That stock is down by a little more than 1%. Elsewhere in Washington, a group of House Republicans saying their meeting with President-elect Donald Trump over the weekend was, quote, positive and productive. The GOP members from New York, New Jersey, California pushing for the $10,000 cap on the SALT tax deduction to be raised or eliminated.
Trump gave them a little bit of work to go back and do, though, basically saying, come back here, according to Mike Lawler of New York, who we actually spoke to last week as well, coming back and basically saying, well, I'm going to need a number. The line is in the sand, though, for these Republicans. I don't think they care so much about if it's one reconciliation package or two, but the fact of the matter is they need SALT included to get their sign-off. And this comes down to the fights that are going to be happening in the next few months when you have the slimmest Republican majority ever. Every single lawmaker on Capitol Hill is going to become king.
Biden had this headache through this administration, Manchin, Sinema in the Senate. Now there's a bunch of them in the House for Donald Trump to deal with.
Which is going to raise a question about how much they can actually cut, given that everybody wants a bone thrown at them, right? It's all the pork.
I was in Palm Beach this weekend. It wasn't just lawmakers from New York, from California that were going down there. You also had all the chairs of the committees from Congress. They are preparing to come in on day one and really already have a lot of these conversations out of the way. One thing I'm really keen to learn about is whether or not the debt ceiling gets put into reconciliation or not. I'm told, and what I'm hearing is that Trump wants it out. He wants these debts cleared as quickly as possible. You have to think, it's debt ceiling, it's spending, then it's reconciliation. It has potential to get messy.
Is that work or vacation, or a blend of the two?
I think it's bleisure.
Bleisure.
Yeah.
Because
That's Eric Resnick.
I went there for work, but I did also get, some sun on Sunday morning at the Breakers. I think that's bleisure.
Blended.
So
bleisure.
everyone going to Palm Beach now is just bleisure.
I think, honestly, I think it's everyone. I don't think it's the journalists.
It's leisure.
No, I get that bit.
Yeah.
Right?
Mark Zuckerberg.
For me, though.
Mark Zuckerberg was there Friday evening at Mar-a-Lago, hanging out with Trump.
I'll break it down.
Appreciate the explanation.
I'll bring a slideshow.
Yeah. Just I'm keeping up, just about. Let's get you the latest elsewhere. Some serious news. The National Weather Service issuing a so-called particularly dangerous situation alert. It's most severe for areas across Los Angeles, including Malibu and the San Fernando Valley. Los Angeles bracing for at least 2 rounds of powerful Santa Ana winds this week alone. A real fear this is going to spread and get worse.
This is devastating. I mean, when you really think about it, people in their homes not sure whether they're going to have to evacuate with go bags ready to get out of there because they might lose their homes and they know it's going to get worse. It is devastating to think. The area looks like it's been firebombed in areas. So you start to wonder, how do you move forward when we still aren't out of the heat of it? No pun intended, a really terrible situation there.
The cost is heading in the wrong direction. AccuWeather increasing its preliminary estimates of total damage and economic loss to a range of $250 to $275 billion as the fires enter their second week. Alex De Silva of AccuWeather joins us now for more. Alex, welcome back to the program. What's the latest?
Yeah, well, right now, the winds are starting to pick up in Southern California, but the good news is some of these fires have been contained a little bit more. The Kenneth Fire and the Hearst Fire are nearly 100% contained this morning. The Eaton Fire is now up to 27% contained, and the Palisades Fire, the biggest fire of them all, is now around 13% contained. Unfortunately, what do we have to look forward to over the next couple of days? More wind coming down into Southern California, big area of high pressure coming down into the Great Basin. This is going to increase the winds, unfortunately, from the northeast here over the next couple of days. We could be looking at 60 to 80 mile per hour winds in those very, very vulnerable areas there, just north of the Los Angeles metro area. This is the area I'm most concerned about. I don't think it's going to be the strength of the last event that we saw, but we could still see wind gusts even up to hurricane force.
Alex, appreciate your time, sir. Alex De Silva there of AccuWeather. Alex, thank you. Let's turn to the economy and think about the impact of all of this. We get some data this week, CPI on Wednesday, PPI before that, retail sales after that. But in a couple of months' time, you're going to see a huge disruption in this economic data. To talk about all of this, joining us now is Michelle Meyer of the MasterCard Economics Institute. Michelle, good morning. It's good to see you.
Good to see you. Good to be here.
Great to catch up with you as always. How disruptive will this data be in the months to come off the back of these fires?
Well, of course, I mean, that's probably one of the littlest things that we think about when considering the wildfires right now and the devastation that's having on people and families and livelihoods. But of course, as economists, and we're trying to understand what's happening in the economy and the markets, the high frequency data matters a lot, and it will be noisy in the coming months. So you're going to see a lot of people trying to X out the impact of California to the extent that that's possible. So a lot of that conversation, without the disruption, it would have been.
It, though, raises some issues, some nodes of pressure that we have, in particular in the housing market. The idea that they're going to have to rebuild at a time where housing shortages already were pretty prevalent in the area. How much room, how much slack is there in the economy to compensate for building, to compensate for some of these things at a time when some people say it's a pretty finely balanced labor market?
Well, of course, I mean, you have to think about the inputs into the equation for rebuilding in terms of the raw materials, the labor, just the capacity to be able to add that much housing stock as quickly as it needs to be added. But that said, we also should be seeing a lot of stimulus into the area, hopefully, which should help encourage and speed up that rebuilding process. But it's going to take time. The devastation is tremendous.
And it still hasn't ended, as we were just talking about. Broadening out, there's a larger question about just where we are and how real the numbers were on Friday, how good they actually were versus maybe overstating things with the preliminary read that wasn't necessarily verified in other data. From what you're seeing, from the MasterCard expenditures, from all of the secondary and tertiary data, do you think that this truly is a labor market that has more upside surprise than people are giving it credit for?
I do. I mean, as you know, at the Economics Institute, we've been very positive on the trajectory of the economy this whole cycle. And a lot of that is because of this ability of the consumer to spend, which represents a positive feedback loop with the labor market. So any given jobs number, we know, subject to revision. You have to look at a moving average. You don't want to overemphasize one report. But if you do look at a moving average and you think about what's happened in terms of the last several months, it has still been strong job creation, an unemployment rate that is remaining sticky low, and measures of unemployment insurance when you look at jobless claims that are still very, very low. So the labor market is supportive. Wage growth is continuing to run at a solid pace above the underlying pace of inflation for goods and services, and that's supporting consumer spending. As consumers spend, that then further drives this feedback look back into the labor market. So on Friday's jobs numbers, we had very strong hiring in the retail sector, for example. Part of that was seasonality. November was weaker, December was stronger, but nonetheless, that does represent a fact that consumers are engaging.
When it comes to, though, that concern about inflation, I know it's colored with politics, but University of Michigan is showing that actually consumers are concerned about inflation going forward. Is that driven because of talk of tariffs and policy, or is that just driven by they're still not comfortable with the price level they've seen over the course of the past 2 years?
I think expectations are still resetting to that price level, right? When you talk to an average person out there, they're saying, but it used to be so much less expensive to buy this. And that less expensive might have been a week ago, a year ago, or 5 years ago, depending on when they've last purchased the item. So I do think expectations are still resetting. It depends on the product, right? When you think about groceries, for example, over the last year and a half now, we've been in very steady and low inflation, between 1 and 1.5% for grocery inflation. So for food, you're starting to get consumers to feel more comfortable that this is probably the price that is sticking and it makes sense. They're not continuously seeing price increases. But there is a little bit of a discomfort, of course, amongst consumers after seeing such a big price level increase. That said, if you look at long-run inflation expectations from the University of Michigan, this whole cycle, they've actually been pretty well contained overall. So over the longer term, I think consumers still have a more disinflationary psychology that is sticking.
How do you think the economy will deal with potentially broad-based tariffs of the incoming administration?
So it depends, as you know, how you define broad-based tariffs. So there's so much uncertainty in terms of what the policy will actually end up being, and we'll adapt our views as we learn more. But I think in general, what we've seen in the past with tariffs is that it does prove to be somewhat of a temporary price level increase on those products that are impacted by tariffs. And then it could also just change in general the cost of production, going back to the conversation with Lisa before around the cost of rebuilding and housing construction. Input costs matter in every way, of course, across the economy.
Is it leading to any pull forward from the data you've seen? People buying durable goods? Any of that at all?
You know, it's really hard to ascertain whether or not that's happening. You do hear it and see it more visibly in terms of companies stockpiling and trying to make sure that they're importing as much as they can, particularly from areas that might be targeted in terms of tariffs. But for the consumer, that's something that's really hard to determine whether it's a pull forward or it's just an acceleration of spend.
Michelle, appreciate your time as always.
You got it.
Thank you. Thank you very much. Michelle Mather of the Mastercard Economics Institute. On the Federal Reserve front, the last week of Fed speak before the blackout period, you will hear from the New York Fed President John Williams a couple of times this week. Look out for tomorrow, I believe 3:05 p.m. Eastern Time. Very precise for the New York Fed. Some opening remarks.
So have we learned who some or the number
Not yet.
of members? I wonder if anyone's going to stand up and said, I was the one. I was the number. I was the person who decided to take into account some of the potential policies.
You've identified one Fed official who might be in the running to become the next Fed chair.
We have.
Who's put themselves in the running.
You're talking about Chris Waller.
Talking about Governor Waller.
Yes,
with that address from last week.
It's not inflationary tariffs. Just ignore that completely.
Neil Dutter of Renmac taking that side of things as well. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Already some Fed speak from former Federal Reserve Vice Chair Randall Quarles, who doesn't think that the central bank's independence will be in jeopardy once President-elect Donald Trump takes office.
Structurally, the Fed can't really be affected by the president's bully pulpit. And, the people who are appointed to the Fed generally have fairly thick skins. So while there's certainly political pressure, there's not really political levers that someone can pull to affect their independence.
He also said Trump's planned tariff shouldn't be inflationary, but at the margin could convince the Fed to lower rates. OpenAI's top executives are planning to host events in Washington, D.C. and key swing states to promote investment in AI. The company has released a new economic blueprint for AI, calling for public and private sectors to work together in areas like energy and infrastructure to keep the U.S. ahead of China. OpenAI plans to hold events in Pennsylvania, North Carolina, and Alabama to announce new AI projects as part of its efforts to boost economic activity. The NFL playoffs are in full swing with the wildcard weekend kicking off in a 5-game slate. The Houston Texans upset the LA Chargers after QB Justin Herbert threw 4 interceptions. Buffalo took care of Denver in a dominating 31-7 win. The Steelers fell to the Baltimore Ravens in their 5th straight loss. Green Bay came up short against Philly, and it is jubilation in the Beltway after the Commanders beat the Bucs to win their first playoff game since 2005 behind rookie QB Jaden Daniels. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, turning the page on DEI.
The kind of masculine energy, I think, is good. I think corporate culture was really trying to get away from it. Having a culture that celebrates the aggression a bit more has its own merits.
Just for the record, Lisa, far more aggressive than I am. Every single meeting we have.
It's probably true.
That conversation is not next. From New York City, this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Things recovering just a little bit. Stocks down by just 0.6% on the S&P. Bond market pretty stable. Crude's still rallying. We're up by more than 2% on WTI, but the 10 years hanging in there now, just about unchanged, 476.55. Under surveillance this morning, the focus very much on Meta, turning the page on DEI.
The kind of masculine energy, I think, is good. And obviously, society has plenty of that, but I think corporate culture was really like trying to get away from it. And I do think that there's just something, it's like, I don't know, all these forms of energy are good. And I think having a culture that like celebrates the aggression a bit more has its own merits. It's one thing to say we want to be kind of like welcoming and make a good environment for everyone. And I think it's another to basically say that masculinity is bad.
There's a lot to cover here, so here's some of the latest. Sweeping policy changes at Meta, with the tech giant becoming the latest company to kill its DEI programs, days after overhauling its content moderation. The CEO, Mark Zuckerberg, blasting the Biden administration for putting pressure on its platforms and saying he's optimistic about Donald Trump's return to the White House. Joining us now to discuss is Michael Nathanson of MoffettNathanson. Michael, where do we begin? So let's start here. The advertisers. Mark Zuckerberg is not a leader here, he's a follower, and he is following Elon Musk. What do you think happens next with the advertisers on Meta's platforms?
Okay, good morning, by the way, and thank you for that lead-in. So here's what I think happens. The core of Meta's advertising are small and medium businesses that are buying performance advertising. They're not brand advertisers, right? Brand advertisers get very skittish when they're in content that's not brand safe. Most of Twitter's X's business at the point of the purchase were brands. Brands ran away from that platform. But at Meta, they're there to sell things, to drive traffic. They have very different types of rationales to be there. And I don't think it's going to be that much of a deal for, in terms of changing their reason to be there. They're there for performance marketing, and that's only gotten better through AI the past 3 or 4 years. So it's interesting. There's a lot of noise about what's going to mean to his core business on the ad side. It's actually probably a non-event, right? It's just a lot of noise, but it's not going to change anything.
Well, Michael, let's build on that. Maybe it won't be bad. Perhaps it could be good. Let's talk about that a little bit more. Engagement. If you strip out liberal influence, if you reduce censorship, do you think that engagement can increase? And can I ask you this as well? Two-part question. Do you think that's what this is really about, or is it just about keeping the incoming administration off his back?
I think he's realized. So let's go to the second question first. I think he's realized, big picture, that he was the only person, the only company really trying to play to the rules that he thought were going to come out of DC. But in that nuance, this is good for Meta, right? He's going to reduce his content moderation costs. To your point, he's going to open up his platform to people who thought it was biased. It's not going to affect his advertising. In terms of your first question about engagement, yeah, it's very possible that you're going to see a subset of consumers actually find more content they'd like on Meta than they did before. So from a business standpoint, it's a massive win-win. It really is. And then you haven't asked me yet, but if TikTok gets banned, having the administration not consider you an enemy of the people will help if the government decides to challenge or not challenge whatever the Supreme Court decides next week, right? So it's a win-win on all the business quadrants that you would care about.
Let's take that a step further, Michael. Does it increase the chances that Meta could purchase the U.S. business of TikTok?
I can't, at least that is one step too far. That to me would fly in the face of antitrust law, right? But if the government doesn't want to sell TikTok, it means that the winding down TikTok is just a massive win for these guys. But I don't know how a government would allow that to happen. They are their biggest challenger. It's just too big.
Well, the issue is that TikTok is just so expensive. So the individuals that can purchase it, they're all going to be up against antitrust laws. Is there someone, a company, an entity that you think could actually buy TikTok?
Oracle was rumored in the past, right? So maybe Larry Ellison comes in with Oracle and makes a play for it. You could certainly see there's a couple private equity offers to happen. But the reality is, to your point, without Google's ability to buy it or Twitter, maybe X would make a move for it. But the Alphabet, Meta can't do it. Perhaps Microsoft would look at it. I mean, it's a really valuable asset, and we'll see if the Chinese are willing to sell it. But to your point, it will not be a frothy auction because two of the biggest competitors will not be allowed to bid for it.
Michael, this is a massive vibe shift taking place in corporate America. And I think it's quite something to see a CEO of one of the biggest companies in this country go on Rogan in the way he did and say the things he did about someone who's still in power, the sitting president. Do you think this kind of behavior from Mark Zuckerberg opens the door for other CEOs to follow and actually start saying what they really think about what's going on in Washington?
To a point, Jonathan, because I think people will be afraid to attack Trump given the fear of retribution for the next 4 years. I think this is a special case because this has been an issue for Meta since 2016. The question about how do you want to moderate content? And they're looking for the government for answers, and the government never came up with a plan. I think this is a specific case because I think it really challenged Mark's personal beliefs about what he should be doing. I don't see it that way. I don't think the next 4 years people will be going out and attacking Trump's policies. Perhaps some will challenge Biden, but I think this is such a unique case and playing to the strengths of Meta and Zuckerberg's, like where he stands right now, right? And also, you have Elon Musk at the hip to Trump, and this is a chance for Zuckerberg to kind of open up some opportunity here to get his thoughts across, because it's been dominated by Elon Musk the past 90 days.
Michael, appreciate your time, as always. Watch this space. There's so much to talk about here. Thank you, sir. Michael Nathanson there of MoffettNathanson, the latest on Meta. A lot of positives here in this shift from Mark Zuckerberg, according to the team over at MoffettNathanson. Look, the fear of retribution from the incoming president, I think, has been well covered. There's a whole industry dedicated to covering that story. Haven't covered enough the fear of retribution from the sitting president, Joe Biden, the Democratic Party. Only scratching the surface on that, and we've seen it from Mark Zuckerberg going into the weekend.
Although I wonder, to the point there, Michael's point, is this a specific case, a very specific person?
It's highly unique. Let's put it that way. TikTok, think it opens the door?
I mean, he just basically poured a lot of cold water on that, so I'm not about to sit here and say yes.
From New York City, the third hour of Bloomberg Surveillance. Up next.
This is going to sound crazy, but I know these attack vectors. Oh, had a little upgrade, have we? Okay, so that's how you want to play.
There's been a rally in bond yields around the world.
The bond market is a little bit on a knife's edge here.
I don't think we want to push our luck on yields much higher from here.
Yields have got to stabilize. Otherwise, you risk triggering these dynamics that can really hurt.
Hopefully we see the sell-off in U.S. rates that we've seen. Hopefully that calms down. I don't think it will.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So much masculine energy. Overwhelming. Equity futures on the S&P down by 0.7%. On the Nasdaq, we're down by 0.9. A massive week ahead for you. kicking off with the economic data. We've got CPI, PPI, retail sales, all of that, and some bank earnings as well. What a busy morning Wednesday's going to be. JP Morgan, Citi, Wells Fargo, Goldman reporting earnings.
Yeah, and that's going to really take center stage in parallel with CPI, which has the potential to edify what we saw on Friday. If you hear the message from banks, consumers are strong, people are spending, the capital markets are open, and regardless of what happens with policy uncertainty, companies are ready to do deals, and you get a hot CPI print. Watch out below when it comes to sort of bond prices. Yields will continue to climb.
It's arguably the favorite sector of Wall Street. On the S&P 500 coming into 2025, we'll see if the numbers and the outlook justify it. Throwing this into the mix as well, this move in crude. WTI and Brent. Brent crude up by 1.6 through 81. WTI up by 1.9 through 78. Crude rallying.
Boldest action we've seen yet from the Biden administration in their final weeks, final days in office, really going after Russian crude in a more material way than we've seen during this entire crisis. And then I think you add to that, many people talk about maybe we're going to see a glut in 2025. Then you add to that, what's on the horizon when you think of risk premium? Well, potentially a maximum pressure campaign when it comes to Tehran. From President-elect Donald Trump going back to the playbook that he's likely going to use again. He is going to enforce those sanctions on Russian crude. So that is why you're seeing this tight market. And that is why you're seeing the equity market pull back as well. This equity market does not fear economic growth. It fears the possibility that we see a re-acceleration of inflation alongside that economic growth.
Especially at a time where a lot of people don't have faith in that economic growth. Let's be honest. How many people trying to poke holes in the data that we got on Friday, talk about the weakness, the stagnancy, the idea that maybe if you get that stronger dollar, it's going to really impede on some of the earnings power, particularly of international companies. So people are more concerned about the risk premia, the idea of something else, deficit concerns, the idea of inflation, these other issues that will cause yields to rise without the commensurate growth.
Quote of the weekend, Peter Cheer, you'll like this one. What if markets reacted so poorly because no one believes the data, but everyone believes that the Fed will need to react to the data?
It speaks to the overly data point dependency of the Federal Reserve, and it goes to something we were talking about a lot last week, which is that the Fed might be the ultimate risk factor in the room, because what happened back in 2018 was not the policies of the Trump administration. It was the Fed's reaction to some of these things and the fact that they raised rates. And that, I think, is what a lot of people are going to be focused on.
Look out for the Fed speak through this week, the last week of Fed speak before the quiet period kicks in over the weekend. John Williams of the New York Fed will be speaking a couple of times, kicking off tomorrow afternoon. Equity futures right now in the S&P, just off session lows. We're negative by close to 0.7%. Coming up this hour, we'll catch up with Sam Stovall of CFRA with stocks lower to start the week. Chris Marinak of Jenny Montgomery Scott looking ahead to big bank earnings, and why Veronica Clark of Citi is still expecting 125 basis points of rate cuts this year. We begin this hour with stocks lower, building on the S&P 500's worst day since December's hawkish Fed meeting, as a blowout jobs report puts rate cut bets firmly on hold. Sam Stovall of CFRA seeing trouble ahead. As a result of Friday's hot December jobs report, investors now worry that the number of rate cuts this year may be reduced to only one, if not none. In response, the United States equity markets have resumed their downtrends and are likely to face additional challenges. Sam joins us now for more. Sam, welcome to the show, sir. Let's talk about those additional challenges. Where do those challenges come from?
Good morning, Jonathan. Well, interesting. I was eavesdropping with your conversation with Lisa just a second ago and really trying to figure out what is it that's causing the yields to move higher. And it reminds me of the Chicago song, Does Anybody Really Know What Time It Is? So I think really the question is, how far does the 10-year yield rise? Is it 5%? Is it 5.25%? Or the long-term average of 5.75%? We don't think it'll be going up that high, but I think in the near term, while we wait the PPI tomorrow, CPI on Wednesday, and PCE at the end of the month, all three are expected to show flat to higher readings, and I think that could add to the overall agita.
Sam, 60 minutes ago, we caught up with Chris Harvey of Wells Fargo. Chris made an argument we've heard a few times on this program, that to get lower yields, you need higher yields, that this is self-correcting. We've heard others call it self-limiting. Do you think we're already in that zone where this becomes self-correcting, self-limiting? It puts pressure on the economy, puts pressure on equity markets, risk assets, and yields start to fall back again?
Well, I think it's being self-correcting in terms of the market action itself. I like to take a look at the percentage of the sub-industries in the S&P 1500 that are trading above both their 50 and 200-day moving averages. And right now, we are only at 10%, which is very close to the longer-term oversold level that I like to look at. And so I'm expecting us to see a bit of a bounce back today, as well as possibly early in this week, but probably a retest as we move later in this week and into next week. I think also that investors will be calming down as it relates to the 10-year yield, because I believe that forward inflation readings will reassert the downward trend line. And so I think investors will be able to breathe a sigh of relief once again.
Sam, I want to go back to nobody knows what time it is, because that's sort of what this conversation also is reminding me of. Jurrien Timmer of Fidelity wrote this over the weekend, that earnings growth will ultimately carry the day and push the market higher. But these rate tantrums are a reminder that it doesn't take much to disrupt the market's mojo when valuations are high. You were just talking about the idea of oversold within the index. So which is it? Are valuations high, or are there sectors that are deeply oversold?
The answer is yes. It depends on the timing that you're looking at. In the near term, I think that we could see a counter trend rally because of being oversold. But I believe that we are going to need to see the yield on the 10-year note come back down again in order to maintain the upward trajectory in equity prices, because the valuations are high. Right now, the S&P is trading at a 20% premium to its just 10-year average forward PE ratio, and more than 35% on the 20-year, and technology is close to 65% based on its 20-year. So I think valuations show a market that is priced to perfection, and so I don't think we can see for a longer period of time an elevated level of 10-year yields.
Going forward, do we see banks priced to perfection at a time where we're expecting to see JP Morgan kick off the unofficial
इस क्रूड ऑयल को देखोगे वही एफईजी पर ही रुक गया है ऑलमोस्ट। एक्सपेक्टेड था ब्रेकडाउन करेगा, बट अभी भी नहीं किया। मॉर्निंग पे भी वहीं रुका था, अभी भी वहीं रुका है। अगर ब्रेकडाउन सक्सेसफुल रहा तो फिर कल का लो और ये जो नीचे टारगेट लगा रखा है, फिलहाल ये साइडवेज ही लग रहा है। यूएस मार्केट ओपन होने वाला है 8 बजे, उसका वेट कर सकते हो बिफोर टेकिंग न्यू ट्रेड्स। जो लोग सेलिंग में है अपना हाफ प्रॉफिट बुक करके ट्रेल करना गाइस। बाइंग मेरे साइड से इसमें भी कोई फिलहाल एक्सपेक्टेड नहीं है। डे लो एंड देन दिस इज द फाइनल टारगेट। अगर एफईजी निकलता है बाइंग नीचे, या तो सपोर्ट पे आ जाए 6600 के अराउंड, या फिर ब्रेकआउट ही हो जाए 6880। सेम नेचुरल गैस ही है, सपोर्ट पर ही है, वहीं पर रुका हुआ है। दो पॉसिबिलिटी है, अब इतने बार सपोर्ट ले चुका है इस लेवल पे, टेस्ट लेवल तक जाए, वहां से एक सेलिंग प्लान कर सकते हो। कैंडल ध्यान रखना ओपन इक्वल टू लो पे डायरेक्टली सेल मत करना, या फिर ये 350-52 का एक रेजिस्टेंस जोन है, और नीचे फिर एक सपोर्ट आपका 319 के अराउंड। इट इज ऑल्सो होल्डिंग दिस 326 लेवल स्टिल। बाकी जो डेटा था आपका 7 PM वाला, दैट इज नेगेटिव। पीपीआई का डेटा और कोर पीपीआई का डेटा नेगेटिव डॉलर इंडेक्स के लिए, पॉजिटिव था गोल्ड और सिल्वर के लिए। अब और आज कोई डेटा नहीं है, कल आएगा यूएस का इन्फ्लेशन सीपीआई का डेटा, वो इंपॉर्टेंट रहेगा, which is very important for tomorrow। एक बार गोल्ड और सिल्वर के लेवल भी देख लेते हैं। अनूप अग्रवाल जी गुड इवनिंग सर। क्रूड ऑयल का व्यू फिलहाल लगा रखा है सर आपके सामने। हाई लेवल से सेलिंग ही एक्सपेक्टेड है, या तो ब्रेकआउट करे या सपोर्ट पे आए प्राइस। बाइंग में अभी इस लेवल पे एक्सपेक्ट भी नहीं कर रहा हूँ। ठीक है, वही सेम गोल्ड में ऊपर रेजिस्टेंस एरिया पे गया न्यूज़ की वजह से। 7 PM पे जो न्यूज़ थी, ऊपर से रेजिस्टेंस लिया, सपोर्ट पे है कैंडल। लेट्स सी यहाँ पर होल्ड करती है या फिर 2650 का लेवल पे होल्ड करती है। आई थिंक मुझे लग रहा है सिल्वर ने भी लेवल ब्रेक कर दिया। नहीं सिल्वर भी रेंज के अंदर ही फंसा हुआ है अभी। यूएस मार्केट आधे घंटे में ओपन होगा, ध्यान रखना। करते रहो guys, don't forget to like this stream. मैं कंटिन्यूसली बोल नहीं पा रहा हूँ, इसलिए कमेंट बॉक्स में रिप्लाई ज़्यादा करूँगा, ध्यान रखना। क्रूड ऑयल अगर नीचे आता है तो फिर डे लो, कल का डे लो, ये एक पहला टारगेट रहेगा और फिर फाइनल टारगेट 1620। कल भी रुक गया था, आई डोंट नो द रीजन, यहाँ पे कोई ऐसे सपोर्ट था तो नहीं। कल मार्केट काफ़ी रुक रहा था इस लेवल पे।
This is the Asia Trade. I'm Sherian in Tokyo.
I'm Hadi Stradwatts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set to catch a tailwind from Wall Street, where dip buying fueled a rebound in the S&P 500. Treasury is extending a drop on bets that the Fed may stay on pause most of the year. Also ahead, Donald Trump's team said to be looking at ramping up new tariffs month by month, seeking ways to avoid an inflation spike. South Korea's constitutional court to begin deciding whether to remove President Yoon Suk-yeol from office over his martial law declaration. Plus, we are live at the UBS Greater China Conference and Goldman Sachs Global Macro Conference to talk market strategy with both of the bank's chief economists.
Heidi, we saw a little bit of a rebound in the overnight session on Wall Street, but this, of course, the caveat is that the global bond rout continues, and that's really pressuring the stock markets. Of course, we do have the earnings season starting this week with big banks, not to mention that we also have to contend with the Fed's easing path. So investors have a lot to digest at the moment, but suffice it to say that right now, given the pressure in the stock markets, we're almost wiping out the bump that we saw after the election of Donald Trump in November. We're down about 5% from the December highs.
We're, of course, watching China as well, Rav. We've got a couple of developments when it comes to the China securities regulator vowing efforts to stabilize the market at a time where, of course, the sort of macro picture remains very much fragile. We had the Chinese trade numbers coming through, the trade surplus reaching a record $992 billion in 2024. Strong exports, weak import demand. Their exports rising nearly 11% and exports hitting to the US almost $49 billion. So that trade surplus could really come under threat very quickly particularly by the incoming Trump administration. We'll get more on sort of what their latest plans are in terms of how to dole out these potential trade tariffs soon. But we could see that leading to a decline in the months to come when it comes to exports, particularly to the US. The other piece of news that we're watching when it comes to China, of course, as the MSCI China index enters a bear market, the technical signaling that we're looking pretty oversold after that 20% drop. But the securities regulator now vowing to stabilize the market this year to anchor market expectations. The CSRC saying that they'll work with the PBOC to enhance those policy tools to induce and maintain a positive market momentum. So, easily said than done, right, given the oscillations that we continue to see, not just recently, but over the past few years when it comes to sentiment in China.
Yeah, at least in the near term, it seems that inducing that positive market sentiment might have worked for the Chinese offshore yuan, because we saw it gain against the U.S. dollar in the overnight session. We had the PBOC again coming out with another verbal warning, not to mention announcements of tweaks to capital control rules, trying to support the currency. Take a look at the Japanese yen holding at that 157 level against the U.S. dollar, really range bound at the moment. The Japanese market coming online after a holiday. We are expecting the BOJ deputy governor to speak today, so we'll be watching out for that speech as the ASX 200 right now is gaining 0.25%. But it's really about U.S. dollar strength right now that's affecting all of the currency moves across Asia. We're talking about 5 sessions of gains for the dollar, and Goldman Sachs now actually upgrading its dollar forecast. It sees about 5%. And those rate expectations, will the Fed be able to ease as fast as they want? That recalculation really leading to that bond route that we continue to see. We had seen a little bit of upside for the stock market in the overnight session, a lot of dip buying into play, with the S&P 500 managing to reverse almost 1% of losses in the regular session. But it's really about that pressure coming from the fact that yields continue to surge, the 10-year yield really approaching that 5% level, Heidi.
Well, Bloomberg has learned that Donald Trump's economic team is discussing a gradual approach to tariffs to boost negotiating leverage and avoid a spike in inflation. Our editor, John Harney, joins us now for more. So what are we hearing in terms of, I guess, the strategizing, given so much of these market concerns are really tied to what a huge inflationary spike we could see from trade tariffs?
Well, first of all, this is all very gradual. As our reporters, Jenny Leonard and Soleil Motion, say, that the president-elect has yet to really see this proposal, let alone sign off on it. But it does indicate a bit of nuance as far as tariffs go, raising them slowly over a period of time with 2 goals, if you will, in mind. One is to see what sort of reaction they get from whoever is the target of the tariffs. The other is to see what happens with inflation. As you point out, markets have been very jittery about this whole tariff regime that the president-elect wants to, or has proposed on the campaign trail, and would like to put in place.
Do we have any idea of the priorities when it comes to implementing these tariffs gradually, and what that could mean for the broader global economy and markets? Not to mention that perhaps some of those key appointees for key roles in Trump's cabinet, what that will look like in terms of how this could play out.
Well, Scott Bessent, his nominee for Treasury Secretary, has played a role in this, this idea that's taking shape, and as far as who how this will play out, that's still remains unclear, because specifics. Again, the president-elect has not said whether or not he'll go along with this, and fairly recently, Mr. Trump has said we're going full tilt on tariffs. No gradualism, no halfway measures. But many countries have been quite nervous about this, including our neighbors, the United States, Mexico, and Canada.
John Hardy, our Bloomberg News editor there with the latest on what we can expect from the tariffs from the incoming Trump administration. Turning to South Korea, its constitutional court will today begin hearings on whether to uphold President Yoon Suk-yeol's impeachment and have him permanently removed from office. Our economy and government reporter Soo-hyang Choi joins us now from Seoul. And Soo-hyang, we're also hearing that Yoon's chief of staff wants a third-party location in order to be questioned. What can we expect from these court proceedings, especially on the first day?
Oh, right. Of course, the biggest question has been whether Yoon will appear himself at the court hearing. But Yoon's lawyers have been saying that the president will not attend this first hearing due to safety concerns. Remember, as you said, the president is facing a separate criminal investigation over his martial law declaration, and he just does not want to risk the chance of getting arrested while appearing at the court. Now, if he does skip the court hearing, as his lawyers have said, the court will have to wrap up the session pretty quickly, even within a matter of minutes, because the law stipulates that the impeachment trial has to proceed with the impeached person present. The court will be able to proceed further from a second hearing, which is slated for Thursday, without Yoon's attendance. Another uncertainty that we're watching is that uncertainty that we are watching is that Yoon has just yesterday filed a number of complaints, including raising an issue with one of the justices, saying that her liberal background cannot guarantee a fair ruling. So court justices will hold a meeting in a couple of hours to review this complaint. And if they do accept this complaint as valid, that could also inevitably delay the whole procedure.
So do we know the timeline for a likely ruling, given that investigators are also separately trying to figure out how to arrest him?
The Constitutional Court has up to 6 months to review and deliver a ruling, but if you look at the past cases, it took about 2 to 3 months for the court to review the impeachment and deliver a decision. In 2004, the court reinstated then President Roh Moo-hyun, saying that his wrongdoing at that time, it was an election law violation. It was not serious enough to kick him out of the office. Then in 2017, the court unanimously decided to remove then President Park Geun-hye from office in an influence peddling scandal after a 3-month review. Now, the court has 6 months, but 2 of its 8 justices are set to retire in April. So it's widely expected that the court may want to deliver a ruling before then, because they need at least 6 justices to agree on removing Yoon from office.
Soo-hyang, it's been over a month since the martial law decree, and of course we're together on the ground in Seoul covering that. I remember what was interesting was that the majority of the public in Korea really wanted to see Yoon impeached. They were not in agreement with the martial law declaration, but also there were a few people who would gather continuously in Gwanghwamun, really supporting the president. What's public sentiment like now?
Right, the public sentiment has quite shifted. Interesting is that we've seen the support rating for the main opposition, Democratic Party, sliding as much as 12 percentage points in our latest poll. And that compares with how the ruling Conservative People Power Party's support rate has been increasing to a level above what was reported before the martial law. Now, remember, the opposition leader, Lee Jae-myung, is one of the more polarizing figures in South Korea's political landscape who faces his own trial. So what we can tell from these polls, at least, is that even if the court rules in favor of Yoon's impeachment, and which would trigger an early election within 60 days, that does not necessarily mean that the Lee or the Democratic Party will gain an easy, clean victory. So we'll have to watch the developments very closely.
Bloomberg's economy and government reporter Soo-hyang Choi there with the latest. Coming up on the Asia Trade, our exclusive interview with the UBS Global Head of Economics and Strategy Research is next. Live from their Greater China Conference, we'll be talking about Asia's developing economies too, with the co-winner of the 2024 Nobel Prize for Economics. We'll also be heading to the Goldman Sachs Global Macro Conference in Hong Kong today to speak with their chief economist. Much more ahead. This is Bloomberg.
As my birthday signals another milestone in my life, I'm hopeful that if I stay true to myself and follow my instincts, my legacy will be looked on kindly for generations to come.
Let's take a look at how we're trading. We're just about 15 minutes into the start of the cash session. A little bit of upside, actually, after what has been really a dour few sessions here in Australia. The ASX 200 up by just about 0.5% there. So really kind of following on the back of the dip buying, I should say, wave that we saw in the previous session on Wall Street. Well, the UBS Greater China Conference is continuing today in Shanghai, and there is our Chief North Asia correspondent.
गाइस क्रूड नेचुरल गैस देखोगे टारगेट हो चुका है। जो लोग बाइंग में हैं वो लोग प्रॉफिट बुक कर लेना। अब यूएस मार्केट ओपन होने वाला है, देखो वेट कर सकते हो उसका, उसके बाद ही सेल करना। कहीं कैंडल ओपनिंग को लो बन के इस रीटेस्ट लेवल को ब्रेक ना कर दे सीधा, ठीक है। बाकी अगर नॉर्मल कैंडल बनती है तो यहाँ से एक सेलिंग का प्लान है, बाकी बायर्स एग्जिट कर लेना और फिर टारगेट नीचे तक रखना। बाकी अगर ये ओपनिंग को लो बना के निकलता है तो फिर ये सीधा ऊपर में नेक्स्ट रेजिस्टेंस तक जाने की कोशिश करेगा। बाकी बायर्स चाहें तो एग्जिट भी कर सकते हैं। यूएस मार्केट ओपन होने वाला है इन फ्यू 8 मिनट।
It's about the bond treasuries, essentially, the sell-off and the yield spiking. We could get the trifecta soon with the 10-year going to 5%, 4.8 right now after the
This is the Asia Trade. I'm Sherian in Tokyo.
I'm Hadi Stradwatts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set to catch a tailwind from Wall Street, where dip buying fueled a rebound in the S&P 500. Treasury is extending a drop on bets that the Fed may stay on pause most of the year. Also ahead, Donald Trump's team said to be looking at ramping up new tariffs month by month, seeking ways to avoid an inflation spike. South Korea's constitutional court to begin deciding whether to remove President Yoon Suk-yeol from office over his martial law declaration. Plus, we are live at the UBS Greater China Conference and Goldman Sachs Global Macro Conference to talk market strategy with both of the bank's chief economists.
Heidi, we saw a little bit of a rebound in the overnight session on Wall Street, but this, of course, the caveat is that the global bond rout continues, and that's really pressuring the stock markets. Of course, we do have the earnings season starting this week with big banks, not to mention that we also have to contend with the Fed's easing path. So investors have a lot to digest at the moment, but suffice it to say that right now, given the pressure on the stock markets, we're almost wiping out the bump that we saw after the election of Donald Trump in November. We're down about 5% from the December highs.
We're, of course, watching China as well, Rav. We've got a couple of developments when it comes to the China securities regulator vowing efforts to stabilize the market at a time where, of course, the sort of macro picture remains very much fragile. We had the Chinese trade numbers coming through, the trade surplus reaching a record $992 billion in 2024. Strong exports, weak import demand. Their exports rising nearly 11% and exports hitting to the US almost $49 billion. So that trade surplus could really come under threat very quickly by the incoming Trump administration. We'll get more on sort of what their latest plans are in terms of how to dole out these potential trade tariffs soon. But we could see that leading to a decline in the months to come when it comes to exports, particularly to the US. The other piece of news that we're watching when it comes to China, of course, as the MSCI China index enters a bear market, the technical signaling that we're looking pretty oversold after that 20% drop. But the securities regulator now vowing to stabilize the market this year to anchor market expectations. The CSRC saying that they'll work with the PBOC to enhance those policy tools to induce and maintain a positive market momentum. So, easily said than done, right, given the oscillations that we continue to see, not just recently, but over the past few years when it comes to sentiment in China.
Yeah, at least in the near term, it seems that inducing that positive market sentiment might have worked for the Chinese offshore yuan, because we saw it gain against the U.S. dollar in the overnight session. We had the PBOC again coming out with another verbal warning, not to mention announcements of tweaks to capital control rules, trying to support the currency. Take a look at the Japanese yen holding at that 157 level against the U.S. dollar, really range bound at the moment. The Japanese market coming online after a holiday. We are expecting the BOJ deputy governor to speak today, so we'll be watching out for for that speech as the ASX 200 right now is gaining 0.25%. But it's really about U.S. dollar strength right now that's affecting all of the currency moves across Asia. We're talking about 5 sessions of gains for the dollar, and Goldman Sachs now actually upgrading its dollar forecast. It sees about 5% gains for the dollar for the rest of the year, given the resilience of the U.S. economy. And those rate expectations, will the Fed be able to ease as fast as they want? That recalculation really leading to that bond route that we continue to see. We had seen a little bit of upside for the stock market in the overnight session, a lot of dip buying into play, with the S&P 500 managing to reverse almost 1% of losses in the regular session. But it's really about that pressure coming from the fact that yields continue to surge, the 10-year yield really approaching that 5% level, Heidi.
Well, Bloomberg has learned that Donald Trump's economic team is discussing a gradual approach to tariffs to boost negotiating leverage and avoid a spike in inflation. Our editor, John Harney, joins us now for more. So what are we hearing in terms of, I guess, the strategizing, given so much of these market concerns are really tied to what a huge inflationary spike we could see from trade tariffs?
Well, first of all, this is all very gradual. As our reporters, Jenny Leonard and Saleha Motion, say, that the president-elect has yet to really see this proposal, let alone sign off on it. But it does indicate a bit of nuance as far as tariffs go, raising them slowly over a period of time with two goals, if you will, in mind. One is to see what sort of reaction they get from whoever is the target of the tariffs. The other is to see what happens with inflation. As you point out, markets have been very jittery about this whole tariff regime that the president-elect wants to, or has proposed on the campaign trail, and would like to put in place.
Do we have any idea of the priorities when it comes to implementing these tariffs gradually, and what that could mean for the broader global economy and markets? Not to mention that perhaps some of those key appointees for key roles in Trump's cabinet, what that will look like in terms of how this could play out.
Well, Scott Bessent, his nominee for Treasury Secretary, has played a role in this, this idea that's taking shape, and as far as who how this will play out, that's still remains unclear, because specifics. Again, the president-elect has not said whether or not he'll go along with this, and fairly recently, Mr. Trump has said we're going full tilt on tariffs. No gradualism, no halfway measures. But many countries have been quite nervous about this, including our neighbors, the United States, Mexico, and Canada.
John Harney, our Bloomberg News editor, there with the latest on what we can expect from the tariffs from the incoming Trump administration. Turning to South Korea, its constitutional court will today begin hearings on whether to uphold President Yoon Suk-yeol's impeachment and have him permanently removed from office. Our economy and government reporter Soo-hyang Choi joins us now from Seoul. And Soo-hyang, we're also hearing that Yoon's chief of staff wants a third-party location in order to be questioned. What can we expect from these court proceedings, especially on the first day?
All right. Of course, the biggest question has been whether Yoon will appear himself at the court hearing. But Yoon's lawyers have been saying that the president will not attend this first hearing due to safety concerns. Remember, as you said, the president is facing a separate criminal investigation over his martial law declaration, and he just does not want to risk the chance of getting arrested while appearing at the court. Now, if he does skip the court hearing, as his lawyers have said, the court will have to wrap up the session pretty quickly, even within a matter of minutes, because the law stipulates that the impeachment trial has to proceed with the impeached person present. The court will be able to proceed further from a second hearing, which is slated for Thursday, without Yoon's attendance. Another uncertainty that we're watching is that Another uncertainty that we are watching is that Yoon has just yesterday filed a number of complaints, including raising an issue with one of the justices, saying that her liberal background cannot guarantee a fair ruling. So court justices will hold a meeting in a couple of hours to review this complaint. And if they do accept this complaint as valid, that could also inevitably delay the whole procedure.
So do we know the timeline for a likely ruling, given that investigators are also separately trying to figure out how to arrest him?
The Constitutional Court has up to 6 months to review and deliver a ruling, but if you look at the past cases, it took about 2 to 3 months for the court to review the impeachment and deliver a decision. In 2004, the court reinstated then President Roh Moo-hyun, saying that his wrongdoing at that time, it was an election law violation. It was not serious enough to kick him out of the office. Then in 2017, the court unanimously decided to remove then President Park Geun-hye from office in an influence peddling scandal after a 3-month review. Now, the court has 6 months, but 2 of its 8 justices are set to retire in April. So it's widely expected that the court may want to deliver a ruling before then, because they need at least 6 justices to agree on removing Yoon from office.
Soo-hyung, it's been over a month since the martial law decree, and of course we're together on the ground in Seoul covering that. I remember what was interesting was that the majority of the public in Korea really wanted to see Yoon impeached. They were not in agreement with the martial law declaration, but also there were a few people who would gather continuously in Gwanghwamun, really supporting the president. What's public sentiment like now?
Right, the public sentiment has quite shifted. Interesting is that we've seen the support rating for the main opposition, Democratic Party, sliding as much as 12 percentage points in our latest poll. And that compares with how the ruling Conservative People Power Party's support rate has been increasing to a level above what was reported before the martial law. Now, remember, the opposition leader Lee Jae-myung is one of the more polarizing figures in South Korea's political landscape who faces his own trial. So what we can tell from these polls at least is that even if the court rules in favor of Yoon's impeachment, and which would trigger an early election within 60 days, that does not necessarily mean that the Lee or the Democratic Party will gain an easy, clean victory. So we'll have to watch the developments very closely.
Bloomberg's economy and government reporter Soo-hyun Choi there with the latest. Coming up on the Asia Trade, our exclusive interview with the UBS Global Head of Economics and Strategy Research is next. Live from their Greater China Conference, we'll be talking about Asia's developing economies too, with the co-winner of the 2024 Nobel Prize for Economics. We'll also be heading to the Goldman Sachs Global Macro Conference in Hong Kong today to speak with their chief economist. Much more ahead. This is Bloomberg. Let's take a look at how we're trading. We're just about 15 minutes into the start of the cash session. A little bit of upside, actually, after what has been really a dour few sessions here in Australia. The ASX 200 up by just about 0.5% there. So really kind of following on the back of the dip buying, I should say, wave that we saw in the previous session on Wall Street. Well, the UBS Greater China Conference is continuing today in Shanghai, and there is our Chief North Asia correspondent, Steve Engel, with our next guest. Steve.
Yeah, that's right. The coffee is starting to percolate and the people are starting to trickle in, obviously, on day 2, the last day, actually, of the UBS 25th anniversary Greater China Conference here in the financial center of Shanghai. And our first guest this morning is Arun Kaptin. He is the Global Head of Economics and Strategy Research at UBS, also the UBS Chief Global Economist. Great way to start the morning because, again, we've seen that jobs report from the United States on Friday, followed by a sell-off globally yesterday, a little bit of a recovery in the S&P overnight. But again, it's about the bond treasuries, essentially, the sell-off and the yield spiking. We could get the trifecta soon with the 10-year going to 5%, 4.8 right now, after the 20 and 30 already surpassing 5. How do you read this and what it means about the state of the U.S. economy and going forward?
Yeah, so I think it's a combination of 3 things, what's happening in the bond market. So supply has not actually gone up, right? But I think the fear of supply sort of plays a role control. So what's actually going to happen on the fiscal, we don't really know. I think there's a tariff fear, right? Again, we don't really know. So it's very, very difficult for people to buy the bond market here at these levels when you've effectively got career risk when you don't know what's going to happen in the next 100 days. So I think that really keeps people at bay. And then I think the jobs report and just the optimism about sort of, the continued strong growth in the U.S. sort of managing to sustain itself, I think, is sort of the third factor. Now, we don't really believe any of that, so we feel this is an overshoot. If you look at the term premium move that we're seeing, we've only seen a move like this sustained in 2008 and 2013, the taper tantrum, right? We had something similar in 21 and 23, and it didn't last. So looks like an overshoot, but it feels a little too early to buy.
Well, people are just kind of going, wait and see what's going to happen. And not just from 6 days or 7 days from now from the inauguration. What are going to be the policy steps? Day one could be a lengthened out process.
It could be a 3-month process where we have to wait to see what gets announced.
Right. So how sticky is inflation, and what does that mean for rates going forward?
So it's not, in the components that we think really matter, it looks like the stickiness is sort of disappearing. If you look at sort of the way rents are behaving, that's now finally moving in the right direction. I think the problem in Q4 is you have a sort of a pandemic residual seasonality problem where if you use pre-pandemic seasonals, then, I think the inflation data would have looked a lot better. So we knew there was going to be some stickiness or some elevated prints the last couple of months. We actually have a pretty hot one penciled in for this week, and then another one for January. But then it starts to sort of come down. So we're not actually very concerned. The other thing I'd say is when you look globally, the data looks fantastic, right? So the disinflation momentum has actually picked up. So it really feels like a bit of a disconnect here between what's happening in the U.S. bond market and what we're actually seeing in the data.
Is there an argument to be made that there won't be any cuts this year, or maybe one?
You could get there in two different ways. We have 4 cuts, right? So we don't. So I think the way you would have to get there. So ultimately we think the Fed follows their models, right? And their models, if you pencil in a slowdown to something like 2%, which is what the Fed itself has, and you pencil in some additional disinflation, the models would say you got to go to a low 3% Fed funds rate, right? Not 4 or not above 4. But it's highly sensitive to the data. So if you don't get a slowdown, right? If the top 20% keeps carrying the economy and inflation stays at these levels, then you can start to justify the market pricing.
Right.
Now, if you then also get tariffs on top of that, then you can even start to think about, well, do they maybe have to reverse some of these?
Well, how inflationary are tariffs going to be? You spoke to Randall Quarles yesterday, the former Fed Vice Chair of Supervision. I had him on TV yesterday as well, and he said basically tariffs are not inflationary. Maybe that's a Republican mantra right now that they truly believe. But in your year-end report, you said we don't see tariff risk being priced in global currencies. Does that mean there's no threat, or that means it's just not priced in yet?
So we don't think they're priced, right? And I think the notion that they're not inflationary comes from the 1819 experience. But of course, the problem is that what happened then was about 1/5 the size of what Trump has campaigned on, and actually what he campaigned on was only China and then this global tariff, not the 25% in Canada, Mexico, et cetera. And so the ability of the corporate sector to absorb these tariffs like they did in his last term is just not going to be there. And so we do think it's inflationary. Now, I think then, of course, it becomes an issue of, well, tariffs on who and how high are they and what do you exempt? Because the way we think about the tariff impact for, say, a China tariff is if you exempt the goods where China is dominant, so in our forecast, we exclude 25% of all the goods where you have no ability to buy anything else, that greatly lowers the inflation impact, right? So if you do across-the-board tariffs, it's much more inflationary than if you start to exempt the things where you have no alternative.
Well, I read a Bloomberg story today saying that they're thinking about the possibility of extending those, amortize it out over many, many months. 2% one month, 2% another month. What kind of inflationary impact as far as steady inflation would that cause?
So I think that's problematic for the Fed, right? So I think normally we think of tariffs as a one-off price level shift and then it goes away a year later. And then provided it's not big enough, you don't have spillover effects. So you don't get second round effects that sort of are inflationary. But if you do rolling tariffs, it's a little bit like the repeat of the pandemic and the Ukraine shock that we had. You have one supply shock after the other, and you start to create sort of a much higher peak in inflation. So I think it would be much more difficult to sort of know what to do with that as a central bank.
We're going to have Wong Tao on a little bit later on at 8:30 Shanghai time to talk about the China market. But what do you see as the real shock is going to be on the Chinese market on these tariffs?
So I think we have an existing property problem, which is well known, right? So we have an economy that's already struggling, and we think even this year is still going to subtract, the property market subtract about 2 percentage points from growth. The tariffs, we think on our level of tariffs will subtract another 1.5, right? And I think the policy responses are quite different to both of those shocks. How the market react, I think, is a bit unclear, because if you think of what is the market? I mean, if it's the equity market, a lot of what's tradable, so if you think about sort of, H shares, for instance, it's internet and consumer companies. They're not, a lot of those are not necessarily going to be subject to the tariffs. And then the question is, well, what is the knock-on effect from the weakness in the economy to those companies? And so, sort of somewhat strangely, perhaps, or perversely, we actually, one of our favorite markets this year is the Chinese equity market, despite the fact that we have a very, very bearish forecast on the economy.
Well, so in your year-end report, you said growth to slow, global growth over the next 2 years to 3.2% from 2.6%. Is there any upside?
Sorry, it's going from 3.2 to 2.9. Yeah.
2.9 next year, but 2.6 in the next...
In 2026, correct.
In 2 years, right.
Yeah.
So any upside surprises that we could...
No, I think there are many, right? There's so much policy uncertainty. There's many things that could go right? I think we could see the Chinese property market recover more quickly than we think. We could see more stimulus. We could see lower tariffs. We could see... there's a whole range of things that I think could go right, but at this stage... we're more on the worrying side in terms of what's coming our way.
Arun, thanks for kicking off this morning coverage this morning and having us here at the UBS Greater China Conference. Thanks so much. All right, Sherry, going to send it back to you as we've kicked off day 2 of the UBS GCC. Back to you.
Yeah, Stephen Engel there in Shanghai with great conversations coming up today from that conference for the remaining of today's session. And still to come, millions of residents on edge with the Southern California wildfire threat set to intensify. The latest live from Los Angeles next. This is Bloomberg.
I implore everyone to not disable the messages on your phone. This is extremely frustrating, painful, and scary, but these alert tools have saved lives during this emergency.
Residents in Southern California are being asked to stay alert as the region braces for a second week of fierce winds whipping up wildfires that have already killed at least 24 people. California Governor Gavin Newsom is proposing the state provide at least $2.5 billion in additional funding for emergency response efforts to fires in Los Angeles. Let's bring in Bloomberg's clean tech reporter Michelle Ma. Michelle, so what's the latest on these containment efforts and how much would this extra funding help?
Well, so containment efforts, are progressing, and we're making progress for sure. From times last week when the fire was still 0% contained, we're definitely improving. But I think the concern right now from a lot of folks on the ground is that we're going to see continued high winds Tuesday and Wednesday, and I think there's a lot of concern that those high winds accompanied by the dryness of the condition is going to make the fire worse and dampen containment efforts.
What do we see when it comes to conversations around rebuilding and, I guess, preparedness for future? I say fire seasons, but of course the concern is that this shouldn't be peak fire season, that it's kind of going to be the rolling risk going forward as the climate changes.
That is a very real concern, and I'm really glad you brought that up. No, this is not going to be the last time that California sees wildfires like this because of climate change, like you mentioned. And, I've been talking to community members on the ground throughout Los Angeles this week and last week, folks in Altadena, folks in the Palisades who have been affected by these fires, who have lost everything. And, I think that the conversation around rebuilding right now is, for some, too soon. For others, that's the only thing that's on their mind. And for everyone, I think it's an open question, right? Like whether or not they'll be able to rebuild, even if they want to, if their insurance companies will be able to support them the way that they want to. They're already starting the claims process, trying to get on the phones with their insurance companies, all the while trying to secure more permanent housing, more rentals, navigating all of the logistics that are involved in dealing with the aftermath of losing everything. So it's really a lot for everyone in Los Angeles right now. Everyone's affected.
Yeah, completely overwhelming, even as we start to see sort of a little bit more improvement on the outlook. But that was Bloomberg's clean tech reporter, Michelle Ma, joining us. And of course, there's more on the global fire threat and climate threat ahead. We take a look at how Australia is dealing with its bushfire season, especially with these overlapping global fire risks. The ANU Institute for Climate, Energy and Disaster Solutions will be with us on Australia Ahead. This is Bloomberg. All right, take a look at some of the data that's just crossing the Bloomberg when it comes to Westpac consumer confidence numbers for the month of January for Australia. Confidence falling 0.7% month on month. The confidence number is falling to 92.1. We have seen, of course, just increasing concerns when it comes to the level of retail confidence here in Australia, household confidence, particularly with the retail sales numbers coming in quite weak, even for that peak November-December period most recently. So that cost of living crisis, high interest rates and uncertainty over when the RBA will actually start to cut is still very much playing out there. When it comes to the Aussie dollar, as you've seen, just said before, we have seen a bit of a move when it comes to the Aussie as well as the Kiwi in this part of the world, really leading the charge in reaction to the reports of perhaps more moderate, gradual moves, Sherry, when it comes to these tariff strategies from the incoming Trump administration.
Yeah, at a time when we continue to see dollar strength, we have Goldman Sachs also lowering the forecast for the Aussie dollar to 62 US cents in 3 months' time. Take a look at where we're at when it comes to the stock markets. The ASX 200 gaining about 0.5% as we continue to watch Nikkei futures at the moment, upside of 0.9%. Japan coming back from holidays, and Nikkei was down for 3 sessions. The Japanese yen little changed during that time over the long weekend. We are awaiting the Deputy Governor of the BOJ, Ryoso Himino, to speak this morning, and that will give us sort of an indication of where the BOJ goes from here. U.S. futures at the moment pointing to the upside. We had seen a little bit of rebound on the overnight session, given some dip buying that we saw that reversed the S&P 500's losses of almost 1% in the session, Heidi.
And of course, in addition to the move that we see in currencies, also watching treasuries as well, as we see kind of not just stocks wiping out, being close to wiping out that Trump bump, but also these Fed rate cut hopes continue to dim. Although, of course, we just had a previous guest still pricing in 4 cuts from the Fed this year. So clearly there's a lot of uncertainty on either side of that bet there. That's what the US 10-year yield is doing at the moment. But let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And of course, so much of the sort of dimming of Fed easing hopes has been linked with the fear of surging inflation from tariffs. So this news potentially of a more moderated, piecemeal or at least a sort of, flexible approach month by month, does that give a little bit more, positivity to investors?
I'm really not sure that it does. Apart from anything else, we had a similar report a while back that gradual tariffs were being considered. And within hours, Trump was out on social media saying, no, it's not being considered. And what he has said publicly about tariffs is very much on the shock and awe side of things. He has publicly stated numerous times that tariffs are beautiful, that they will make America great again. So I think you have to regard such reports with a healthy dose of skepticism. Not that it isn't the case that there could be people within the Trump administration or within those circles who are looking at ways they could make this approach less of a disruptor for the US economy, although the aim is, after all, to disrupt the global economy. But that doesn't mean that those proposals will make it onto Trump's table, and if they do, that he will accept them. As far as yields go, tariffs are only one of the reasons why yields have been climbing. Another reason is Trump is definitely going to move to retain the tax cuts he brought through in 2017 and look to add more tax cuts to it. There is on his agenda the idea of cutting waste from the US government. But we've had plenty of experience with both sides of American politics, promising big spending, but fixes which will meet the spending doesn't have to be funded by bigger deficits. We haven't seen those not so big deficit part of it coming through. So that's a big part of the concern as well. There's also the concern that I think you had a previous guest talking about, if you've got tariffs being imposed at a low level, but then each month they're going to go up, that would actually threaten to sort of lock in a higher path for a gradual higher path for prices, and in fact, in some ways a better look for the economy is if you have a one-off tariff shock and then the economy can adapt to it, rather than setting in motion a process where each month you see higher tariffs. So there's a lot to digest there. I think part of what's going on today just shows how much fear there is of what tariffs could do.
Yeah, and also, of course, we know that a big target is Beijing at the moment. And with a trade surplus at record highs, of course, that's really going to get the ire of Donald Trump. Not surprising, all of these expectations for Chinese assets have been going downwards, but at the same time, Beijing really not sitting still. They continue to pledge more support.
Yeah, that is a constant. The problem is that apart from last September's big announcements that they would definitively move to stimulate, they changed some of the language both that the government was using and then that the PBOC is using. But they've also made it clear that they're in charge of a super tanker. They're not in the business of doing U-turns. They will take a gradual course to try and turn the economy around. It's not at all clear that they will be able to turn the economy around sustainably. And also, if they do turn it around, does that end up being still a slower, lower growth profile than many had been expected? I think a lot of investors are coming to the judgment that China is not going to go back to being the hugely impressive leader of global growth that it was for much of the 2000s up until now. So in that context, a lot of people are lowering their sights and probably hoping for a slow, gradual recovery in Chinese assets. The difficulty is that right now there still remains so many headwinds. Perhaps the best that can be done is to prevent serious declines from here, at least in the short to medium term.
Garfield Reynolds, who leads the Markets Live Asia coverage, there with us. Now, the latest from the corporate front, Apple's iPhone sales fell about 5% globally in the final quarter of 2024, hurt by underwhelming upgrades and competitors making inroads in China. Counterpoint Research says Apple's global market share slipped 1 point last year to 18%. Separate IDC data offers a similar picture, giving Chinese smartphone brands their best combined quarter on record, taking 56% of global sales. Bloomberg has learned that Honeywell International is poised to proceed with a breakup after pressure from activist investor Elliott Management. Sources say it's planning 2 publicly traded companies, with one focused on automation and the other on aerospace and defense. We're told it may announce the plan with its fourth quarter earnings in February. Bloomberg's been told Cleveland Cliffs and Nucor are looking at a joint offer for U.S. Steel. The Cliffs CEO confirmed his interest at a media event and later told Bloomberg he'd fund the deal using debt. A source says the partnership could include Cliffs acquiring most of U.S. Steel, while Nucor took its mini mill assets. Shares of all 3 companies jumped on the news. Sonos CEO Patrick Spence is leaving the company after a failed app revamp upset customers and stunted growth. The audio technology company named Tom Conrad as interim chief executive while it looks for a new leader. Sonos launched a new mobile app last May that came riddled with bugs. Spence was criticized for not apologizing fast enough, while Sonos had to delay multiple product launches.
Well, still to come, Sherry will be back at the UBS Greater China Conference with the co-winner of the 2024 Nobel Economics Prize. That exclusive conversation is next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
Kamala and I took office, our nation had become stronger at home, are stronger in the world. And now, America is more capable and I would argue better prepared than we've been in a long, long time.
President Biden arguing that his actions over the last 4 years have left the U.S. in a stronger position ahead of the inauguration of Donald Trump. Some of the other stories that we're following this hour, and President Biden says negotiators are pressing hard and on the brink of a deal to pause Israel's 15-month war in Gaza. Earlier, Israeli officials said they'd presented a detailed outline to Hamas during indirect talks in Doha. Sources say the first phase would involve a 42-day ceasefire and the release of 33 Israeli hostages in exchange for Palestinian prisoners. Members of President-elect Donald Trump's incoming economic team are said to be discussing slowly ramping up tariffs month by month. Sources say the gradual approach is aimed at boosting negotiating strength while helping avoid a spike in inflation. We're told the proposal is in its early stages and has not been presented to Trump. Greenland's Prime Minister reportedly says he wants closer ties with the US, highlighting the Arctic island's push for independence. His comments to a local broadcaster come after Donald Trump repeatedly restated his ambition to take control of the self-ruling territory of Denmark that's home to 57,000 people. House Republicans have introduced a bill to begin negotiations called the Make Greenland Great Again Act. Well, the second day of the UBS Greater China Conference is getting into full swing in Shanghai. Let's get back there. Our Chief North Asia correspondent, Stephen Engel, is with our next special guest. Steve.
Yeah, that's right. Day 2 of the 25th anniversary of the Greater China Conference here in Shanghai with the UBS, obviously. And our guest now is James A. Robinson, Professor James A. Robinson at the University of Chicago, and he's an economist and political scientist and the 2024 co-winner of the Economics Nobel Prize. Thanks so much. It's not often we get the honor to speak to Nobel laureates as yourself. So you're here at the UBS conference. I'm sure you're going to be peppered with a lot of questions. You're going to be on stage. What's your main message to the banking community here, 3,000 of which are attending this record attendance?
Well, I think you know, the people at this conference, they're very interested in understanding, you know, where is the world going and what's happening with economic growth in different parts of the world, and, you know, and what does the future look like, and who's going to do well and who's not going to do well. And my message is that's all about institutions. You have to look at the institutions. That's what my research shows, and try to understand, you know, what do the institutions imply for people's incentives and opportunities and prosperity?
A lot of your research really looked into the discrepancies between nations and why some succeed and why some fail, and why those patterns perpetuate. Obviously, we have the two global superpowers, the United States and China, economic superpowers, but from very different models. How do you draw, what conclusions do you draw from the United States model, which has a long-term success, and the Chinese model, which has really only been the last couple of decades in this current iteration?
Yeah, differences and similarities. You know, I would say what's similar is, you know, fundamentally the United States has flourished because it has what we have, inclusive economic institutions. It has rules that create broad-based patterns of incentives and opportunities. And, you know, in some sense, that's exactly what China didn't have before 1978, and that's exactly what it created after 1978. It abandoned the socialist economy. It created the state withdrew from the economy. It created opportunities for entrepreneurship. It created incentives. The private sector flourished. So that it's sort of moved to this much more inclusive economy, and that's what's driven economic prosperity. So that's something we understand. So what's more complicated from my perspective is, I'd say, why has the United States been able to sustain that sort of economy? That's to do with the political institutions. And of course, China has very different type of political institutions. So that's the bit that fits less well.
So how does the current iteration of the Chinese economy, which cracked down on innovation, de facto innovation, by cracking down on the platform economy like Alibaba and the like, and the job creation that created and the innovation that it created, is it a political model that perhaps is not suited for that long-term creative destruction that you talk about in your research?
I think that, I think that's right. I think there's no historical precedent for a country becoming like a first world country with a political system like China has. I mean, of course, there's Qatar or whatever sitting on oil and natural gas. But apart from that, there's no, based on industry and education, and there's no historical precedent for that. So I think, what's paradoxical is that some things do flourish. Electric car is flourishing, for example. There's a lot of innovation and entrepreneurship. So some things flourish, other things don't flourish, but I think the big picture would be, yes, it's very hard to have an inclusive, innovative, entrepreneurial economy when you have this kind of power structure in society.
Can China break the pattern, though, of failed countries that have moments of prosperity, but because you mentioned in your research as well about the Soviet Union, where they essentially flourished as a main superpower until they hit the 1970s, and then they hit that roadblock of no creative destruction, where you need innovation to continually replace outdated technologies. China can possibly break that model because you mentioned EVs. They're an innovative society as well, and they have deep pockets.
Yeah, I mean, there's a history here of entrepreneurship and trade and innovation, which you didn't have, for example, in Russia. So there's something culturally different about China, which is fascinating. I mean, in Why Nations Fail, what we point out is there's many examples in world history of societies that have these awkward combinations of institutions that can prosper for 40 years, 50 years. I mean, Argentina was one of the 10 richest countries in the world in 1910. But, it was in the right place at the right time, but it never had the institutions to really go to the next stage. So I think the way you articulated that is exactly right. That's the problem in China. Do they hit the wall like the Soviet Union, or can they do something different?
How do you factor in the next technological leap that we're experiencing right now, and that is AI, which is being developed sort of in a bifurcated world because of trade disputes and national security concerns?
Well, that's a fascinating topic. I mean, what's interesting in China is the enormous amount of effort being put into AI. But AI is seen as much as a tool for managing society as it is for something for raising human productivity. So the question is, are those two things compatible, or are they not compatible? Can I innovate something which allows me to control people but simultaneously raises productivity? And I guess my view would be the answer, there's a lot of research on that at the moment by academic economists. But my view would be you can't combine those two things.
So the creative destruction concept is happening in the United States. We're seeing the automobile industry being replaced by EVs. Disruption is happening.
Absolutely.
AI, they're saying, is the absolute next industrial revolution that is happening. In China, I think data security has become a big issue. Because companies like Alibaba, as I mentioned, grew their data resources exponentially and was not able to control it by the government. Would you agree that that is perhaps going to keep that bifurcated world of AI development could actually be very separate paths?
Yeah, I mean, AI could be pushed in lots of different directions. It's not something that's just inevitably goes in one way or another way. I think one of the big debates at the moment is AI going to be something which raises people's productivity or replaces people with robots? I'm trying to use AI to make myself more productive, not to replace myself, But a lot of the model is, we're just going to get rid of workers. We'll push wages down, we'll reduce the wage bill, we'll make more profits. But that's a model with enormous social consequences.
But do you buy into Elon Musk's vision of the future?
What's that?
We're going to go to Mars. We're going to have a home robot. Everything. We're going to have small government.
I think that libertarian model of the future is ludicrous, actually. I think all the evidence is, the role of the government in the United States is absolutely crucial. I mean, who invented the internet, for heaven's sake? Not Elon Musk, know. So I think we need the government to counteract, the worst effects of capitalism. So I'm very much a believer in that model, and I think that there's this kind of race, between the state and capitalism to kind of control it. Think of all the investment in education and security and public goods, and who is it that's creating this labor force and this kind of environment? I've worked a lot. I was in Somalia last year. Now, there's a libertarian paradise for you. No government, no taxes, no regulation. It's not a rich, successful country.
Yeah, that's sustained as well. All right, James A. Robinson, professor, Nobel laureate in 2024 for economics. Thanks so much. We should go much longer next time. Thanks so much. And Heidi, we'll send it back to you guys.
I'll take it over, Steve. Our Chief North Asia correspondent, Stephen Engel, of course, there with the conversations coming from that UBS conference in Shanghai. We do have breaking news at the moment out of Japan. We are getting the trade surplus, the current account surplus, coming in for the month of November. And for Japan is 3.353 trillion yen, which is surprising to the upside. Adjusted current account surplus also at 3.03 trillion yen. This would leave the current account adjusted surplus at a growth of more than 50% year-on-year for the month of November. We've seen slight improvements in the current account numbers for Japan in the past couple of months, and again for the month of November, surprising to the upside. We'll be looking forward to the market opens in Japan in about 8 minutes after the long weekend. This is Bloomberg.
This is going to sound crazy, but I know these attack vectors. Oh, had a little upgrade, have we? Okay, so that's how you want to play.
Japanese drug maker Takeda Pharmaceutical says business in China is growing fast, but CEO Christophe Weber told us that growing geopolitical risks have deterred the company from expanding there more aggressively.
Well, we'll see what happens. I hope that healthcare or pharmaceutical will remain protected from geopolitical tension or tariff, because innovation in healthcare, in pharma, come from many different countries, many different biotechs. So if you start to have geopolitical tension or tariff or no access, it means that some medicines won't have access and patients will suffer. So my plea is that pharmaceutical healthcare should stay away from any geopolitical tension or tariff.
Well, we should find out soon enough there. And I have about time for one question left with you. And I want to talk about what you're doing in China, because you've been aggressively partnering with Chinese biotech companies. And you think about the U.S. and the Chinese relationship, a lot of concern, a lot of questions over what that will look like under the second Trump administration. Could that give you any pause when it comes to that strategy?
So there is more innovation in China. It's still limited compared to the US, and we should actually remember that 80% of the new medicines in the world come from the US, so this is something very important. We are growing very fast in China, but because of the geopolitical risk, we have been very careful not to have any dependency on China. So in case there is a bigger tension, we will not be impacted. So that has been our strategy.
Takeda Pharmaceutical CEO Christophe Weber there speaking to us earlier. Well, the market opens are almost upon us in Seoul and Tokyo in the next few minutes. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Heidi, we continue to watch whether that global bond route will continue to the Asian session. Of course, we had Treasury yields continuing to rise, despite the fact that stocks did rebound on the Wall Street session. What that means for currencies across Asia is a big question, as the dollar now continues to gain ground for 5 sessions already.
Yeah, what's also interesting, we are seeing that sort of market reaction to this report that we could maybe see a staggered, more moderate, or at least a monthly approach to implementing tariffs. Of course, nothing's been confirmed. We know that sort of this has been floated before when President-elect Trump has actually come out and refuted this. So there's absolutely no certainty. But certainly if that was the case, perhaps we could see a little bit more calm when it comes to these markets.
Yeah, especially if we see more downside on the U.S. dollar, right? But right now, what we're watching very closely also central bank action, because we are watching the BOJ Deputy Governor Himino speaking later today, and that will determine perhaps where the Japanese yen and yields could go from here, because that will give us an indication of where the BOJ goes from here. And we have seen the Japanese yen little changed ahead of that speech and press conference. But we're watching the 10-year yield very closely, because we're already at around levels that we haven't seen since 2011. Will we continue to get more upside as we see the global bond sell-off is a key question, as we are also keeping an eye on the 40-year yield, because it's very close to record highs at the moment. And of course, we are seeing markets coming back from that long holiday weekend for Japan, and we're seeing downside for the Nikkei of 0.7%, a little bit of a catch down perhaps, given that we had seen that sell-off broadly in Asian markets on the Monday session. But take a look at how Korea is coming online as well, as investors digest a lot of economic news. We just got the trade surplus coming in from Japan, the current account surplus widening as well. The Kospi now gaining about 0.5% at the moment, as we also continue to watch political risk, because the Constitutional Court now begins trial on whether to uphold the removal of President Yoon Suk-yeol in South Korea. A little bit of upside for the South Korean won. We're seeing support, Heidi, as we have seen more PBOC warnings and interventions in order to support the offshore yuan as well.
Yeah, just that sort of at least meaningful rhetoric when it comes to the stabilisation of the market more broadly. Does that lend support to some of these sort of China proxy assets like the Aussie dollar? Right? This is a picture when it comes to Australian assets. We have seen a little bit of upside when it comes to trading in Australian stocks, at least, after quite a bit of malaise over the past couple of sessions. We're seeing in particular that reaction across miners, financials and other related stocks. They're seeing a bit of dip buying perhaps after the recent days of sell-off. But when it comes to households, the outlook is still pretty gloomy when it comes to the consumer sentiment numbers that we saw falling 0.7% in January. So that is really being reflected by just the sort of structural weakness in the Aussie dollar. It is a little bit higher today, but we're off about 8% against the US dollar over the past 3 months. And as Sherry mentioned, we're clearly following what's going on with yields at the moment, with this sell-off continuing to ripple through global bond markets.
Yeah, so what a perfect time to really head to the Goldman Sachs annual Global Macro Conference for Asia Pacific, getting underway in Hong Kong right now, with more than 2,000 investors, policymakers and analysts gathering to really go over the economic outlook for the year ahead. Our China correspondent Min Min Lo is there with our next guest. Min Min.
Thanks, Heidi. Certainly what those Trump tariffs mean for the global economy is an important theme here at the Global Macro Conference. And the perfect guest to join us here discussing this is Jan Hatzius, the Chief Global Economist at Goldman Sachs. So, Jan, really great to have you here. And I want to start with what's happening in the U.S., because obviously we're waiting for the inflation data. We had a very strong jobs report on Friday, and we're seeing yields spiking. Investors really stop pricing in anything more than a full rate cut. But your house view, though, is still that the Fed will cut twice this year. Why is that?
Basically because we think that inflation is still on a normalizing path. And right now we're at 2.8% for the core PCE measure that the Fed watches particularly closely. We think that's going to go down to about 2.4% by the end of the year. And even of that 2.4%, about 30 basis points in our forecast comes from tariffs. Tariffs are more of a one-off effect. It's a price level effect. So you might want to sort of downweight that 30 basis points. And the underlying inflation rate in our forecast is 2.1%, which is very close to the Fed's target. So in that kind of environment, I still think you're likely to get a couple of cuts. But clearly the FOMC is in no hurry. And therefore we think it's probably going to take until later in Q2, maybe the June meeting, for the first cut to be delivered.
As you said, inflation is actually still quite well above that 2% target. Do you see any risk of no cuts at all, and under what scenario?
I think you can't, look, there's always a range of scenarios, so it's hard to really rule anything out, especially when it comes to monetary policy. Monetary policy has to be very data dependent and respond to new information. So if we were to see very sticky inflation closer to 3% throughout the year, yes, I think in that case they might not cut. That's a possibility. But again, if I look at the adjustment that's occurring in the economy, the trends in the most kind of least noisy components of inflation, if I look at the labor market rebalancing that we're seeing even after the strong jobs report and the slowdown in wage growth, to me that suggests there's still some room for monetary policy to normalize. After all, the funds rate's still quite high at 4.25% to 4.5%.
Okay, so you see the Fed cutting as a way to normalize rates. But meantime, we actually have the news today that Trump's economic team is looking at possibly a gradual approach to those tariffs, hiking maybe 2 to 5% per month. And to me, this sounds like it's just going to be a giant headache for businesses. So what is your take on this and how it's going to shape global trade and businesses?
First of all, I'd say there have been a lot of different reports about tariffs. I mean, I think we can have pretty high confidence that tariffs are coming in some form. What form exactly they take, I think, is still a little bit open to debate. There are different approaches to rolling out tariffs. You could do a 10% tariff immediately, or maybe a 20% tariff on China. That's our baseline assumption. But you could also roll this out more gradually. I think which one is more damaging or less damaging is a little bit of a judgment call, because if you go more gradually, then obviously each increment is pretty small. It's kind of predictable what happens next. But it also lasts for a longer period of time, and you don't get it over with in some sense as quickly. So I think those are ultimately probably a little bit more details. The important point is that, yes, I think
News when you want it with Bloomberg News Now. I'm Nathan Hager. Tuesday morning trading is underway on Wall Street and stocks are on the rise. That is the sound of the opening bell from the floor of the New York Stock Exchange. And at the open, the S&P 500 is higher by nearly 0.5%, trading above 5,800. The Dow Jones Industrial Average opens nearly 0.5% higher. It's near 42,500. And the NASDAQ Composite is leading the gains up 0.6% at about 19,200. The 10-year Treasury yield is up about a basis point to 4.78%. All this comes after a surprise slowdown in wholesale inflation last month, driven by lower lower food prices. Bloomberg's Michael McKee has the December Producer Price Index.
PPI headline comes in half of what was expected. The forecast was for a 0.4 gain. It's only 0.2. Core rate comes in flat at 0 after a 0.2 rise the month before. The forecast was for 0.3.
Bloomberg's Mike McKee says overall producer prices rose 3.3% compared to the year prior. The Consumer Price Index for December comes out tomorrow. The first Senate confirmation hearings are getting underway for President-elect Donald Trump's cabinet nominees, and first up is Defense Secretary-designate Pete Hegseth. Bloomberg's Jody Schneider says it's been a tough nomination for the former Fox News host so far.
There's some thinking that he's in better shape than he was sort of, say, a month or so ago when a lot of allegations came out, and some people were thinking there was no way he could survive. He's surviving certainly until this confirmation hearing, but it's going to be tough.
Bloomberg's Jody Schneider says Hegseth is promising to be a change agent at the Pentagon. In his prepared remarks, the top Democrat on the Senate Armed Services Committee, Jack Reed, says he does not believe Hegseth is qualified for the overwhelming demands of the job. Israel and Hamas may be closer to a ceasefire deal in Gaza than ever. That's what both President-elect Donald Trump and President Biden have been saying as indirect talks continue in Qatar. Israeli officials say they have presented a detailed outline of an agreement. Hamas says the talks are in their final stages. Bloomberg's Ethan Brunner says the U.S. pressure has been considerable.
There's been a lot of serious work by Jake Sullivan and by Anthony Blinken and all the people associated with the Biden administration. But I do think that the arrival of the Trump administration at this moment with its bellicose manner has made a big difference. It has.
Bloomberg Israel Bureau Chief Ethan Brunner says it's unclear if a deal will be announced today, but it does appear imminent. Another day of dangerous fire weather is in store for Los Angeles as the deadly wildfires head into their second week. Here's CAL FIRE Battalion Chief Brent Pasqua.
The winds are back, not as strong as when we first had this fire, but they are back. They're stronger. We've been working tirelessly overnight, through the night, every night, to make sure this fire's put out and mop up this fire before these winds came.
Still, about 2 million people in and around L.A. are facing extreme fire conditions today into tomorrow. The blazes have left at least 24 dead. The economic toll is climbing as well. AccuWeather meteorologist Bill Waddell says the full impact could run as high as $275 billion.
There's going to be a massive ripple effect, economically speaking, not just here in California, but across the nation. Our experts at AccuWeather are telling us this is going to make the insurance crisis in high-risk areas even worse, and they tell us that preliminary estimate that may climb once again.
AccuWeather's Bill Waddell was on Bloomberg Surveillance. Wells Fargo and Goldman Sachs are putting insured losses at up to $30 billion. The big banks report earnings tomorrow, but one of them is already reporting a big change near the top. J.P. Morgan Chase says Jamie Dimon's longtime number 2, Daniel Pinto, is retiring at the end of next year. He's being replaced as Chief Operating Officer effective immediately by Jen Pipsack, currently the co-CEO of J.P. Morgan's Commercial and Investment Bank. A spokesman says Pipsack does not want to be considered a CEO at this time. Bloomberg's Sri Natarajan says that's only adding to the uncertainty.
We don't know whether that means in 6 months when Daniel Pinto steps down from his role as both president and CEO, at least those titles, when he relinquishes those titles, will Jen Pipsack be more interested then?
Bloomberg's Sri Natarajan says what does seem clear is Jamie Dimon won't be leaving anytime soon. At the open, JPM shares are little changed to the upside. Eli Lilly is down 3.5% at the open after preliminary full-year revenue came in weaker than expected on disappointing sales of weight loss and diabetes drugs Mounjaro and Zepbound. Eli Lilly is forecasting improving revenues for this year. United Rentals has agreed to buy H&E Equipment Services for $3.4 billion. H&E is soaring on that news. At the open, it's up more than 100%. And Capital One is being accused of misleading customers when it rolled out a new savings account with a higher interest rate without offering it to its existing customers. The Consumer Financial Protection Bureau filed a lawsuit against the bank this morning. Capital One shares are higher by nearly 1%. That's news when you want it with Bloomberg News Now. I'm Nathan Hager, and this is Bloomberg.
There are two kinds of people in the world. People who think about climate change and people who are doing something about it. On the Zero podcast, we talk to both kinds of people. People you've heard of, like Bill Gates.
I'm looking at what the world has to do to get to zero.
not using climate as a moral crusade.
And Justin Trudeau.
There are still people who are hell-bent on reversing our approach on fighting climate change.
And the creative minds you haven't heard of yet.
Really don't need to have a tomato in December. It's going to taste like nothing anyway. Just don't do it.
What we've made here is inspired by shark skin. Yeah. It is much more simplified than actual shark skin.
Drilling industry has come up with some of the most creative job titles.
Yeah. Tell me more.
You could imagine tool pusher,
no,
driller, motorman, mudlogger.
It is serious stuff, but never doom and gloom. I am Akshat Rati. Listen to Zero every Thursday from Bloomberg Podcasts on Apple, Spotify, or anywhere else you get your podcasts.
गाइस क्रूड ऑयल को देखोगे तो हाफ टारगेट तो हो चुका है क्रूड ऑयल का। यूएस मार्केट ओपन हुआ 8 PM पे, उसके बाद थोड़ा बहुत सेलिंग जरूर आई है। ये कल का लो है, अगर निकलना चाहो तो यहाँ निकल सकते हो, थोड़ा टारगेट बड़ा ही रखा हुआ है। बाकी अगर ये कल का लो ब्रेक करता है तो फाइनल टारगेट है, यहाँ से बाइंग का प्लान करेंगे। यहाँ पर प्राइस रुक रहा है, कल भी रुका था, बट यहाँ पर कोई मेरे अकॉर्डिंग सपोर्ट है नहीं, तो आई डोंट नो क्यों रुक रहा है। कोई रीटेस्ट जोन है। बाकी 150 पॉइंट मिल चुके हैं ऑलरेडी, सो चॉइस इज योर इफ़ यू वांट टू बुक द फुल प्रॉफिट। बाकी नहीं तो फिर ओवरनाइट होल्ड करना पड़ेगा, और कल क्या होगा नोबडी नोस। ठीक है, बाकी कल देखेंगे कोई नया लेवल बनेगा तो। सो इफ़ यू वांट टू बुक द प्रॉफिट, फुल प्रॉफिट, यू कैन बुक इट। इफ़ यू वांट टू ट्रेल, योर चॉइस। बाकी एफईजी ब्रेक हो गया, लेट्स सी अगर यहाँ से फिर से रिजेक्शन लेता है। बाकी नेचुरल गैस सपोर्ट पे था, बाइंग आई 325 से 350। यूएस मार्केट ओपन हुआ रेजिस्टेंस जोन पे, ये रीटेस्ट जोन है एक्चुअली, वहीं से सेलिंग चल रही है, थोड़ा संभल के डील करना है इसको। इंपॉर्टेंट लेवल है ये, अब अगर ये होल्ड करता है तो फिर मेरे अकॉर्डिंग इसको नीचे आना चाहिए 320 तक। अगर ये ज़्यादा बड़ी सेलिंग नहीं आती है यहाँ पर और थोड़ा देर मार्केट कंसोलिडेशन में चला जाता है, तो फिर ये ब्रेकआउट करके, ब्रेकआउट इन द सेंस ऑफ ऊपर निकल के फिर 350 तक जाने की कोशिश करेगा। फिलहाल रीटेस्ट पे है, थोड़ी बहुत सेलिंग एक्सपेक्टेड रहेगी यहीं से। आज और कोई डेटा है नहीं, कोई नई न्यूज़ वगैरह कुछ आएगी तो वी विल सी दैट। अभी फ़िलहाल के लिए लाइव चल रही है यूएस में जो होने वाले डिफेंस मिनिस्टर हैं, वहाँ पर उनको डिफेंस सेक्रेटरी कहा जाता है ट्रम्प के, और उनकी लाइव हियरिंग चल रही है, उसको देख सकते हो अगर देखना चाह रहे हो। बाकी तो और कोई ख़ास न्यूज़ अभी है नहीं। कोई इम्पैक्ट पड़ेगा तो देखेंगे। कल इंपॉर्टेंट न्यूज़ है, सीपीआई का डेटा है, तो उस पर फोकस जरूर रखना। टुमारो इज़ द सीपीआई डेटा, वेरी इंपॉर्टेंट।
Clinician taking care of you, and it frees up capacity. All those are different variations of how we think.
न्यूयॉर्क सेशन लिखा हुआ है 6:30 इंडियन टाइम के अकॉर्डिंग, टाइम चेंज होता रहता है 5:30 टू 6:30, 6 महीने 6 महीने 6:30, 6 महीने 5:30 पे ओपन होता है। लाइक भी करते रहो गाइस, 100 लाइक्स का टारगेट है। बाकी मैं कंटिन्यूसली बोल नहीं पा रहा हूँ, इसलिए कमेंट बॉक्स में रिप्लाई कर दूंगा। लेवल बाकी ड्रॉ किए हुए हैं। 7:30 का डेटा नेगेटिव था डॉलर इंडेक्स के लिए, पॉजिटिव फॉर गोल्ड एंड सिल्वर, कुछ इम्पैक्ट हुआ नहीं मेजर। लेकिन
We have lots of opportunities to, I'd say, fill out the solution for customers so that there's a better end-to-end capability. And then on the customer side, these type of relationships, we see more and more customers wanting to have not a relationship of a transactive one, but a real partnership where we're actually getting our hands dirty to help solve some of their challenges. And you know, we've done over 120 of these. It's been about $5 billion since we've spun out. But obviously, this as $1 billion by itself represents, you know, one of the largest that we've ever done.
Yeah, absolutely. Since spin-off, this partnership quite large. Let's talk a little bit more about your Investor Day. It was interesting. You take a look at the details. It seems like there was a lot of focus, of course, on the pharmaceutical diagnostic segment. I know that's your fastest growing segment, and a lot of focus on imaging agents, for example. How do you expect that market will change over the next 5 years or so?
Yeah, so one of the exciting things, and it's being discussed by a lot of pharmaceutical companies here at the conference, is this evolution of radiopharmaceuticals used in therapy. So we are a diagnostic company, not a therapy company, but these drugs that are arising, and they basically are a radioactive tracer that goes to a cancer cell, actually helps eliminate the cancer and doesn't hurt the good cells around it. We have the equipment that actually helps, what clinicians would say, see what you treat and treat what you see. And also a host of the diagnostic agents. One that we spoke at Investor Day is actually on the cardiology side called Flyrcado. And what it's used for is in a PET scanner to do cardiac perfusion. And it will replace products that have been used in older systems with higher specificity and sensitivity, which ultimately means a better diagnosis. And that's actually launching this March, April. So we're super excited about Flyrcado and this PET cardiology market area.
And Peter, I only have time for one more question, and I want to go to China, of course. You acknowledge that there's been weakness in China on your third quarter earnings call, and that's one of the lingering questions, I would say, over your stock, that China recovery. What is your viewpoint right now?
Yeah, well, first of all, I'd say overall, we're optimistic about 25 for the whole globe, I think. U.S., EU, a lot of things. China, I think my views haven't changed from what I've said at Investor Day, which is we're bullish on the future of China. It will be one of the largest, if not the largest, healthcare market in the world at some point down the road. We believe the first half is going to be a little bit more subdued as stimulus and some of the other programs they have get worked through, but we're optimistic that the second half of 2025, we start to see the recovery, and then 26, 27 beyond that, it gets back to a more normative rate of growth.
All right, Peter, that's a good place to leave it. Really appreciate you taking the time.
Thank you.
That is Peter Arduini. He is the CEO of GE Healthcare. Back to you, Sonali.
Katie, another great one. Looking forward to more conversations over there at JP Morgan Healthcare. Katie will be back in just a few minutes with Regeneron's Chief Scientific Officer. You're not going to want to miss that. Now coming up, California bracing for another round of dangerous fire conditions today. We're going to bring you the latest out of LA next. This is Bloomberg.
This is going to sound crazy, but I know these attack vectors. Oh, had a little upgrade, have we? Okay, so that's how you want to play.
Innovation, modernization, and business resilience are all top of mind for business leaders, making one thing certain. In these incredibly complex environments, end-to-end observability is no longer optional. It has become mandatory.
Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. January 20th, Donald Trump will be sworn in as the 47th president of the United States. Bloomberg will have special coverage of the historic inauguration, live from Washington, D.C. It all starts at 11 a.m. Eastern. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need. Live every weekday, only on Bloomberg. Context changes everything.
Southern California is still struggling to contain the wildfires that broke out last week. Gusts are forecast to approach 70 miles per hour today, with the U.S. Weather Prediction Center warning of extremely critical fire weather conditions. Joining us now from Los Angeles, Bloomberg's LA Bureau Chief John Gittleson. Where do we begin? Because the reality here is not only is the state grappling from the damage that's already been done, it's very much still ongoing. So how are these fires going to be contained?
Really what we need is rain, basically, but winds picked up overnight, and the red flag warning is expected to be in effect through Wednesday. The one thing that's happening now is there are an incredible number of firefighters and firefighting equipment in place, something like 15,000 people. Plus all this aircraft, people have come in from around the western U.S., Canada, and even Mexico to help fight this blaze. But overnight, a couple of small fires broke out in Ventura County, northwest of Los Angeles. Relatively small fires, and they're able to attack them. But it just shows how things can spread because California hasn't had rain for more than 8 months.
John, I know you're
Southern California.
I know you're still really in the thick of it in terms of this fire, and getting it under control and stopped has to be task number one. But I'm just, mind-boggling how difficult it's going to be to get housing for these people and how long it's going to take and what it's going to do to the local economy. I mean, these bigger picture issues, what do you think is front of mind?
Yeah, definitely shelter housing is a huge issue. I mean, LA already had one of the tightest housing markets. There's only like about a 5% vacancy rate for apartments. More than half of people who are renters are rent burdened, which means they pay more than 30% of their income just for shelter. You need a $200,000 income to be able to buy the median priced home in LA. And now the market's even tighter and prices are going up, especially for rentals and especially near the fire areas.
John, we have to leave it there. We thank you so much for all of your reporting and for joining us this morning. That is Bloomberg's John Gittleson in LA. Now, coming up, we're going to head back to the J.P. Morgan Healthcare Conference up in San Francisco. Katie Greifeld is going to be speaking with Regeneron's Chief Scientific Officer next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Let's get a quick check on what's... Oh, sorry. Was that you?
I don't know. You,
my
me,
bad.
whatever.
My bad.
But yeah, let's get a check on these markets because, of course, we are off of session lows. I know you have been very excited about this rebound.
Yeah.
Very excited.
Well, not very excited, but I was in a dark place over the weekend after it looked like we have turned down from the 24% gain we saw in 2024. I'm looking all over the place, Shanali, not just at stocks right now, but there are a lot of other moves that I think are interesting.
And if you round up, the 10-year is at 4.8%. We'll look more at these markets later, but we're going to go now to the JP Morgan Healthcare Conference in San Francisco. Katie Greifeld standing by with another key guest, Chief Scientific Officer of Regeneron. Katie, take it away.
I'm sitting by with George Yancopoulos, of course, as you said, Chief Scientific Officer over at Regeneron. George, great to see you in person.
Good to see you.
So as you told me in the commercial break, you're the science guy. So we're going to talk about the pipeline here. And one of the big themes of this conference, in addition to M&A, of course, is weight loss. And you're testing 2 drugs right now in combination with Wegovy to improve the quality of weight loss, as I understand it. Talk to us about what that means and why that is important.
So everybody's excited about these new classes of weight loss drugs that really can have a big impact, drop a lot of weight. The problem that's not quite as widely appreciated, but is increasingly recognized, is a lot of that weight loss, unfortunately, is muscle. 30 to 40%. So if you lose, for example, 30 pounds, 12, 13 of that could be muscle. That's devastating. I mean, I've been working out my whole life. I've never put on 12 pounds of muscle. If I were to lose that, I would be, very much affected. So what we're hoping to do is we've developed muscle preservation agents that we've actually shown can grow muscle in other settings in human beings. And for the first time now, we're combining them with these weight loss agents to see whether we can prevent that muscle loss or even increase it. So after you lose the weight, you've maintained your muscle or maybe even gotten stronger. That also is important from the disease aspect, because in a lot of the diseases, muscle is what controls insulin and controls diabetes and so forth. So if you lose weight but you're losing muscle, you may not have as good an effect on all these other metabolic associated diseases like diabetes. Right. This could really help there. So the other reason why it could be so important is we now know from how these drugs are used in the real world. In clinical trials, people stay on them throughout the whole period, 3-4 years. But in the real world, they're cycling on and off them. Less than a third of the people are staying on for longer than a year. You regain all your weight, all as fat, okay? And then you go back on, you lose it as muscle, you regain it. So over time, this could be devastating to some individuals, especially older people who are already suffering from decreasing muscle mass. So this could really make an impact on creating better quality weight loss, resulting in healthier people, not only resulting in pure fat loss, which is what you want to lose, but leaving you stronger, but also more metabolically fit.
Right, and great context on why muscle, of course, is important. It's not just about looking buff. You need it for the metabolic implications as well. But I want to talk about the practicality here. So you would be having muscle-boosting drugs that you're taking on top of the weight loss drug. Is that correct?
So that's what we're testing in our original clinical trial, because we have multiple muscle preservation agents, and we see which ones and how they're going to do. Once we know if there is magic combination that works the best, we can make what we already have in the labs, what we call unimolecular solutions, which will then advance to clinical trials. And those will be one treatment that will be a combination of what we would hope would be the magic combination.
And you think about the competitive...
And by the way, our approach is there. Our unimolecular solutions are designed to be given once a month. The current drugs are given once a week. So not only would you maybe get better quality weight loss, better metabolic effects, but once a month instead of having to take a shot much more frequently.
I want to get your thoughts on the competitive landscape, because you're testing this with Wegovy, of course, of Novo Nordisk, but you have Eli Lilly also looking to tackle this muscle loss problem as well. Why do you think that your approach is different and better?
Well, our approaches are very related. Indirectly, their efforts that they acquired from the outside indirectly came from our science and from our efforts. It's very interrelated. The only difference is that we break the muscle preservation approach to multiple different components. They have one approach that just tests blocking all of these related factors. We block them one at a time. So if there's one that's more important than the other, but it's safer, we'll be able to pick the safer one. They won't have the ability to separate because they have an all-in-one approach.
And where are you in these trials? When can we expect to see this data?
Yeah, so what we announced, our trials are fully enrolled, and by about the middle of this year, we should have data.
All right, middle of this year. We will be in touch on that. But let's talk a little bit about, of course, the pipeline where you spend your time. Do you think that there are any opportunities for inorganic growth here? Could you look to M&A to sort of bolster the pipeline, or are you looking to keep it in-house at this point?
So remember, we're the company that invents and develops its own drugs. We're the true unicorn in the industry. Most people can't do that. They don't have that ability, so they go to the outside. We have such a rich pipeline. We have 40 to 50 exciting programs in clinical trials already to cure allergy, to cure various forms of cancer, not only one cancer. Some of them are the most exciting anti-cancer agents that have ever been described. We're working in a variety of related fields, you know, preventing clot formation, and the list goes on and on. So we don't need to go outside for individual assets. You know, if we are so lucky as to find one magically, we might take it. But what we do, unlike most other companies, is we make tech collaborations where we see companies that we consider younger versions of ourselves. We're the leading actual technology, biotechnology company in the world. We're looking for younger versions of ourselves that are doing something that's synergistic with us. So, for example, we started a partnership, not to acquire products, but a technical collaboration with a great company called Alnylam, another one with a great company called CRISPR. So together with them, we're bringing some of the most exciting new gene medicines forward to patients. In one case, gene silencing approaches, novel gene silencing approaches. Another, the first phase 3 programs with CRISPR. Everybody talks about CRISPR. We're the ones who are bringing them to actual patients. Right. So when we go to the outside, we look for things that can be synergistic with other great technology companies. So, for example, with Alnylam, we have some exciting programs that I think could make a real difference, totally new approaches to Alzheimer's. With Intellia, we're actually doing the first in vivo knockouts of genes in humans to correct diseases, which could be addressed with genetic approaches.
Right.
And so genetics approach is a really important new thing for us. One thing that we showed incredible data, perhaps the greatest gene therapy story ever, took genetically deaf children, and with a single treatment, we were able to restore hearing in 10 out of the 11 ears that were treated, which is really miraculous. So that's what we're about. We're about developing our own science and technology. We're finding very related companies whose science is very synergistic with us and creating new breakthroughs that have never been done before. Right. And we have a history of bringing more firsts to patients, making bigger impact on diseases than almost anybody else.
George, it feels like we're just getting started, but I am up against the clock here. So thank you for your time today. That, of course, is George Yancopoulos. He is the Chief Scientific Officer at Regeneron. Back to you guys.
Katie, thanks very much. Katie Greifeld out there in San Francisco. She's going to have more interviews from the JP Morgan Healthcare Conference throughout the day, including the CEO of Illumina, which put out a press release yesterday that it was going to work with NVIDIA, which is probably a good idea for a healthcare company to do. We are looking at markets, Shonali, that continue to rebound. We saw a recovery yesterday into the green, and we're up again today at session highs.
The day is long. You are still seeing yields higher even after that PPI data. Quickly, the attention is going to turn to earnings and CPI data. Inflation is going to be right back in focus once again, Matt.
All right, so we do see actually we're giving up some of those gains. The NASDAQ 100,
almost
only
all of them.
0.06 of 1%. As the 10-year yield, as you point out, approaches 480, we'll see what happens with the CPI data tomorrow. Also on open interest tomorrow, Carol Schleif of BMO joins us, Sarah Hunt of Alpine Saxon Woods, Meb Faber of Cambria Investment Management, and Hamilton Lane co-CEO Eric Hirsch. This is Bloomberg.
In these incredibly complex environments, end-to-end observability is no longer optional. It has become mandatory.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Mike Shepard in Washington, in for Ed Ludlow. This is Bloomberg Technology.
Coming up, could Elon Musk be TikTok's savior? China is analyzing the option to save the social media company in the United States and work with the next administration. Plus, NVIDIA CEO Jensen Huang goes
नितिन कुमार जी वॉइस
News when you
वॉइस यही है, कहीं गई नहीं है, बट ड्यू टू हेल्थ कंडीशन में बोल नहीं पा रहा हूँ ज़्यादा, इसलिए कमेंट में कमेंट बॉक्स में आंसर दे रहा हूँ. कोई क्वेश्चन है तो पूछ लो.
more than once before the Senate Armed Services Committee. The top Democrat on the panel, Jack Reed, says he does not think Hegseth is qualified. He raised a number of allegations of past alcohol abuse and sexual assault and harassment against him. Hegseth says he's been the victim of a coordinated smear campaign. Another day of extreme fire weather is in store for Los Angeles and the surrounding area. Little let up from the wildfires that have left at least 24 dead and a mounting economic toll. Bloomberg's Derek Wallbank reports.
AccuWeather's overall estimate toll now somewhere around $250 billion, billion with a B dollars. The insured losses on this, I've now seen two estimates that put that around the $30 billion mark. That's continuing to rise as well.
Bloomberg's Derek Wallbank says the winds aren't expected to die down until at least tomorrow. Bloomberg meteorologist Rob Carolyn says the Santa Anas are nothing new for the region, but not like this.
80 to 100-mile-hour gusts were unique with this system. I've seen Santa Anas in Southern California that have done some pretty big damage, but I can't remember in my career us talking about over 100 miles an hour.
Bloomberg meteorologist Rob Carolyn. A ceasefire deal could be coming within days between Israel and Hamas. That's what both President-elect Trump and President Biden are saying as indirect talks continue in Qatar. We get the latest from Bloomberg Israel Bureau Chief Ethan Brunner in Tel Aviv.
The deal's not that different from what
नेचुरल गैस का बताओ. नेचुरल गैस देखो फिलहाल के लिए बुलिश है. यहाँ पर एक सपोर्ट एरिया था, वहाँ से बाइंग आई. ये रीटेस्ट जोन था, थोड़ी बहुत सेलिंग आई, बट ये ऊपर निकल चुका है ऑलरेडी. इसमें एसएल जा चुका है ऊपर. ये एफईजी से फिर से सेल प्लान कर सकते हो. अदरवाइज मेजर रेजिस्टेंस फिर 350 355 के अराउंड मिलेगा. एक्सपेक्टेड था रीटेस्ट रुकेगा, बट ये रुका ही नहीं. आई थिंक कुछ ये न्यूज़ भी आ गई है, ध्यान रखना. गाजा सीज फायर वाली यूएस की मैंने शेयर कर दी थी ऑलरेडी. वैसे तो यूएस के प्रेसिडेंट की ओर से ये बता दिया गया है कि जो गाजा सीज फायर डील है, हॉस्टेज रिलीज डील, वो रेडी हो चुकी है. हमास का वेट कर रहे हैं वो लोग. पोटेंशियल ब्रेक थ्रू ऑन ऑनगोइंग कॉन्फ्लिक्ट, जो फिलहाल के लिए करंट फॉरेन मिनिस्टर हैं यूएस के, उनकी ओर से स्टेटमेंट है. इम्पैक्ट पड़ेगा इसका अगर ये हमास एक्सेप्ट कर लेता है डील को. इट इज़ नेगेटिव फॉर क्रूड ऑयल डेफिनेटली इन दैट केस. फिलहाल तो क्रूड ऑयल का व्यू नेगेटिव ही चल रहा है सर, हाई लेवल से. यहाँ पर एक सपोर्ट अच्छा है, आ जाए तो यहाँ एक बाइंग का प्लान रख सकते हैं. बाकी अगर हाई लेवल से सेल करके रखा है तो वैसे प्रॉफिट अगर बुक करना चाहो तो कर भी सकते हो. पूरा 150 पॉइंट मूव कर चुका है वैसे ऑलरेडी. डायरेक्टली यहाँ तक चला जाए तो वेल एंड गुड. आज ही नहीं जाता है तो फिर ओवरनाइट पोजीशन हो जाएगी. नहीं तो बाकी यहाँ से फिर बाइंग का प्लान करेंगे, देखेंगे आज आ जाए तो. वैसे तो 9:30 है, कुछ न्यूज़ वगैरह आई तो वेल एंड गुड, अदरवाइज मुश्किल है. पूरा 250 पॉइंट एक साथ गिर जाना. श्योर, ओके. $328 से सेल किया हुआ है तो आपका कब का एसएल जा चुका है. 328 से सेल क्यों किया? यहाँ पर कौन सा रेजिस्टेंस था? यहाँ पर सपोर्ट एरिया था, सपोर्ट एरिया से बाइंग करते, सेल किया तो यहाँ करते, या फिर एफईजी से सेल कर लो. 328 से सेल क्यों कर दिया? अब इतना ही कह सकता हूँ सर, इस एफईजी तक वेट कर लो. अगर इस लेवल के ऊपर कहीं मार्केट क्लोजिंग करना शुरू करे तो निकाल देना, तब तो होल्ड कर लो. बाकी यहाँ से रिजेक्शन मिल के आता है तो उसको आना चाहिए नीचे 319. इतना नीचे क्यों सेल किया? यहाँ पर तो सपोर्ट एरिया था. रेजिस्टेंस पे सेल किया करो या फिर सपोर्ट पे तो बाइंग का प्लान किया करो. फिलहाल इतना ही कह सकता हूँ. अभी अगर होल्ड करना चाह रहे हो तो वेट कर सकते हो इस एफईजी के ऊपर. क्लोजिंग बेसिस का आती है तो निकल जाना, नहीं तो होल्ड कर लो. कॉस्ट टू कॉस्ट आए तो फिर एग्जिट, क्योंकि सेलिंग आई तो फिर कोई लेवल है नहीं बीच में. नीचे सीधा यही है आपका 325 एंड देन 319 लेवल लगाए हुए थे मैंने ऑलरेडी, उन्हीं को फॉलो करो। वॉइस नहीं बोल पा रहा हूँ तो अब क्या करूँ बताओ, हार्ट की प्रॉब्लम है, कांट स्पीक कंटिन्यूअसली। हाँ वो न्यूज़ तो नेगेटिव ही हुई एक तरह से कह सकते हो, अगर सीज फायर डील होती है ना हमास और इजराइल के बीच में, दैट इज़ नेगेटिव डेफिनेटली। ये एफई से सेल कर सकते हैं, ठीक है, नेचुरल गैस को। बाकी रीटेस्ट को आप कंसिडर मत करना, ये ऑलरेडी निकल चुका है इसके ऊपर। भी वेट किया था क्रूड ऑयल का नीचे आने का, कल बड़ी मुश्किल से रेजिस्टेंस पाया, वहीं पे क्लोज हो गया। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक दिस स्ट्रीम।
President Biden suggested last spring and summer. He talked about a 3-phase. It seems to be maybe going down to 2 to 3. But the basic idea is that you start with the humanitarian cases, as they're called. That is to say, the women, those who are ill, and those who are over 50, and children included as well.
Bloomberg Israel Bureau Chief Ethan Brunner says it is not clear whether a deal will be announced today. Meta Platforms is planning to cut about 5% of its lowest performers with the intent of backfilling their roles this year. That's according to an internal memo sent to employees from Meta CEO Mark Zuckerberg. He says the company is expected to reach 10% of non-regrettable attrition by the end of the current performance cycle. Right now, Meta shares are lower by nearly 2%. A big change is coming near the top at Wall Street's biggest bank. J.P. Morgan Chase says Jen Pipsack is the new chief operating officer, replacing Daniel Pinto, who is retiring at the end of next year. The bank says Pipsack, though, is not interested in replacing Jamie Dimon as CEO for now. More on that from Bloomberg's Sri Natarajan.
We should take it at face value right now, and the clear signal they're trying to send is, even though with the slew of changes that they've made today, there's various executive moves that we're seeing at JP Morgan today, Jen Pipsack's clearly saying, I don't want to be successor to Jamie Dimon.
Bloomberg's Sri Natarajan, as JP Morgan and 3 other big Wall Street banks prepare to report earnings tomorrow. Right now, JPM shares are higher by about 0.5%. Rashida Jones is stepping down as president of MSNBC after 4 years at the helm of the progressive cable news network. Jones made history in 2021 when she was named the first black executive of a major TV network. Looking at the market overall, it is moving higher after the last read on wholesale inflation for 2024 came in cooler than expected thanks to lower food prices. The producer price index rose just 0.2% in December. That was half as much as the month before. More from Bloomberg's Michael McKee.
All in all, it appears that this is a relatively good news for the economy and for the Fed. They don't need to worry about inflation at this point, but it doesn't tell them that they need to start raising rates. And so this should be, I would assume, somewhat market friendly.
That's Bloomberg's Michael McKee, and we get the consumer price index for the month of December tomorrow. But producer prices are being seen as market friendly. Right now, the S&P 500 is up about 0.25%. The Dow and the NASDAQ about 0.3% higher. The 10-year Treasury yield is up about a basis point to 4.79%. That's news when you want it with Bloomberg News Now. I'm Nathan Hager, and this is Bloomberg.
Not everybody likes talking about money. Some people find it awkward. Sometimes they even find it a little embarrassing. I do not. I like talking about money. Whether it's the boardroom, the newsroom, the trading floor, I've spent the last 30 years talking about money, writing about money, and talking about it and writing about it a little bit more. I'm Maren Somerset-Webb, and every week senior reporter John Steppick and I answer your questions about personal finance, and we discuss the best.
And then the more surprising one that people sort of scratch their head at when they think Trump, people generally think drill, baby, drill. And so they say, listen, you got to be invested in energy stocks. And because, deregulation plus drill, baby, drill is going to be really good for those names. And historically, it's not really. The deregulation part's fine, but drill, baby, drill is not constructive towards the price of the underlying commodity. Actually, it helps suppress the price of oil, which is good for the consumer and good for the economy, but not necessarily good for the equity value of things like Exxon and Chevron and sort of the big major integrateds. And so the energy sector is one that we're not really in love with right now either.
Scott, thanks so much for taking the time here with us today. Good to see you.
Hey, thanks.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host Shauna Smith here, sticking around to talk some of these trending tickers. First up, we got to go to Meta. Meta Platforms planning to cut 5% of its lowest performers, according to an internal memo seen by Bloomberg here. The shares right now moving lower by about 2.6%. There's always a bevy of news that's knocking around in the markets and investors' minds with Meta. But this major kind of restructuring that could come forward from Meta.
Yeah, Mark Zuckerberg isn't wasting any time. He has certainly announced a number of initiatives since the start of the year. This is just the latest. This coming from an internal memo obtained by Bloomberg and bringing the total here, Meta expecting to reach 10% attrition by the end by the end of the performance cycle. So the reason why this is significant is it's 5% more than what we saw in 2024. So again, in terms of why they're doing this, Zuckerberg saying in this memo obtained by Bloomberg that I've decided to raise the bar in performance management and move out low performers faster. We typically manage people out who aren't meeting expectations over the course of the year, but now we're going to do more extensive performance-based cuts during this cycle. So again, they're looking to right-size their business just a bit. They're looking to cut costs in areas where they think it is relatively attainable, and they can do that quickly. So we are seeing this initiative from Mark Zuckerberg. And remember, this follows some of the commentary that we got from Joe Rogan last week when he joined, just in terms of how he sees Meta shaping up over the next several years. Also, a couple of changes that have been announced. One big change that was announced in terms of getting rid of fact checkers here ahead of President-elect Trump's inauguration. Again, that very much seen as a move here from Zuckerberg, trying to further cozy up to Trump here ahead of his second term. So again, this obviously very separate, this having to do with their employee base, cutting the 5% of their low performers, what they call it. So again, a move here just to further cut costs for Meta.
Okay. All right. Next up, we got to talk this one because I know that corporate branding strategy keeps you up at night all the time, Shauna.
Always.
We got to talk about this one. It's going viral. Walmart giving its branding a refresh here. And here's a look at it. As shares right now, they're down by about 0.2%. Okay. This is essentially kind of the video that they put together, and essentially looking at the change between what is called the spark and the typeface that they have here. And you're seeing some of, I guess, how that's all played out and the before and after. Shauna, what are your thoughts here?
My thoughts. I wonder how much they paid for this. It looks so similar to me, to the point that I had to ask you if I was looking at the right thing, because it's just bolder and it's a little bit brighter. And I think that makes sense. Strategy standpoint wise, I don't know how much an ad agency maybe should get paid for this, but the significance of this, one of the things that stuck out to me is this is the first refresh that we've seen in their logo in almost 20 years.
Yeah, that's wild.
And this is a refresh that we're getting. So again, I don't think the average typical American is going to maybe notice the difference. Maybe I am wrong. But again, if I was comparing the two, I literally had to ask whether or not I was looking at the right thing.
I'm going to be eloquent with my first comments on this, and then I'll go a little unhinged with the second one. First, though, this is a major cost as well that you need to consider, even more so than just paying some agency or maybe having somebody in-house work with an agency to come up with a new logo or typeface and how much time goes into that. All that considered, you then have to revamp marketing materials. You have to revamp everything from the in-store experience as well. You're talking about store fronts. You're talking about an overhaul of what the website looks like. That's perhaps a little bit easier. You swap out a couple vector logos here and there. But I guess on the more unhinged side, this is giving format, typeface, or format, font, bold. That's all they clicked here. To me, it's not enough. And at the same time, it's Walmart. I mean, when you think about the fact that they have a store within a 10-mile radius of 90% of America here, it's a major overhaul to go into all those stores or try to change the look and feel or the front of all those stores with this new logo. So that's a cost. But then I think afterwards it's, okay, what do we really want to convey through just being more bold, I guess, at this point? And what does that boldness look like in the product that they have, in the service that they have been able to kind of put into so many communities for so far?
Yeah, in a statement released to some media outlets here, their Senior Vice President and Chief Marketing Officer for Walmart U.S., William White, saying that this update, rooted in the legacy of our founder, Sam Walton, demonstrates our evolving capabilities and long-standing commitment to serve our customers of today and tomorrow. So I think when you square that with our commentary, maybe we're just not appreciating.
We're not hip enough?
Yeah, I guess not.
Yeah, no, this is giving, we didn't want to pay Don Draper, so we went to Ned in accounting. Shauna, thanks so much. Appreciate it.
Thank you.
I was excited for that commentary. All right, guys, the VIX Volatility Index. Some people call it the fear gauge, but strictly speaking, it's investors' expectations for volatility over the coming days, the 30 coming days, in fact. And here to break it down and address its controversial name is Yahoo Finance Markets and Data Editor Jared Blickery. I didn't even know it was controversial.
Well, you do now, and we're gonna get to the bottom of this. I love Steve Sosnick. He's chief strategist over at Interactive Brokers, and that's one thing he says. The VIX is not a fear gauge. It is a measure of 30-day volatility, but it's kind of a fear gauge. And what is this? We're looking at a number here, 19.03. If you take all the S&P 500 options, so those are index options that are expiring over the next 30 days. There are a bunch expiring this Friday because it's the monthlies. We got weeklies coming up. You take all the ones from the next 30 days and you get one number. That's 19.01. And when we chart that over time, what we find is these levels kind of appear. It goes up and then it just kind of reverses. And when we see the levels going up, that's indicative of traders expecting the range to expand of the S&P 500. And that usually means it's going to go down because the range of the S&P 500 of stock indices tends to go down, and the range expands more on the way down as on the way up. But it is possible sometimes that the range expands on the way up, and traders expect that, and then you see a higher VIX and a higher S&P 500, but that is not usually the case, and so usually it is kind of a fear index. We did have Slatestone Wealth's chief market strategist Kenny Polcari in here yesterday explaining why he believes 22 of these levels, 22 is the VIX's key breakout level right now. Let's take a listen.
22 is the recent breakout because we saw, if you look back on the chart over the last quarter in October, November, and again December, the VIX came up from the complacent area, tested 22, backed off, tested it again, backed off, tested it again, and backed off. And so after it tested 3 times, typically the 4th time that it tested, it usually breaks up and breaks through. And when it does, it creates more angst in the market.
And that's what we're talking about, a little bit more angst in the market. As the VIX rises here, there is a little bit more angst represented by traders' fear in the market. But I think where people go a little bit wrong is they see a higher VIX and they're like, I got to buy more VIX because the market's going to continue to go down. The market can continue to go down even if the VIX retreats, because that first spike, a lot of times it doesn't last that long. And here's Kenny kind of explaining some of these dynamics.
The concern about the breakout is that stocks will weaken, right? The algos, more specifically even than the human beings, were programmed to respond to levels in the VIX. So as the VIX breaks out of 22, the most recent high, then you'll see some of the algos kick into sell mode, right? And so stocks will come under decline.
And so this just highlights a lot of what goes on in the market is systematic. That is, these large institutional traders, they have levels in mind. It could be the VIX, it could be the S&P 500, it could be the dollar, it could be the 10-year. And when you get all these levels that are important being crossed at very similar times, and right now we're seeing a lot of levels in flux right now. I was just talking about the S&P 500 and Bitcoin an hour ago. When all of that happens, you can see the market change character. And that's kind of what we're looking for. We're reading the tea leaves of the market. Now, I also have an average of the VIX, so you can call this VIX seasonality, all the way back to the beginning of calculations in 1990. So over 1 year, and this represents 1 year, the VIX traces out a familiar pattern. So we begin the year at a low level. On average, it's about 11, 12, 13. Then we get a little bit of a rise into February and March, then a retreat. Then you have the summer doldrums where, for the most part, we are a little bit quiet. But then in August, things pick up. And back to school time, back to work time, end of summer, you get this spike a lot of times in October or November. And guess what? That is prime time crash season. Doesn't mean all the crashes have to happen then, but you look at Black October of 87, the fall in 1929, those were huge October tops. And so that's what we're watching right now. We saw that decline into year end. That played out. And now we're right at the beginning of this year, just in time for a new president. So we might think, we might come to expect that we're going to need to watch the VIX to see as President Trump takes office, as the inauguration takes place, and those first few days of signing orders, what happens with the market? Are we going to see a little bit more uncertainty? We'll have to find out.
Jared, really great breakdown, and I understand now.
Thank you. The controversy, yes.
Yeah, exactly. Thanks so much, Jared. Coming up, I'll break down my top 3 takeaways from one of the biggest retail conferences in the country. Plus, small business optimism is hitting a 6-year high. We'll talk about why small businesses are feeling hopeful. And taking a look at some of the most traded stocks today from Yahoo Finance's screeners page, we're seeing Rigetti Computing, Nvidia, and Tesla top the list. We've got more wealth after the break.
As observability has evolved from
With Automation Engine from Dynatrace, you can automate valuable workflows and orchestrations across your ever-changing ecosystem. So you can break down silos, drive collaboration, and automate your entire enterprise, all with the power of the industry's simplest and most productive platform.
It's time now for today's strategy session. Earnings season set to kick into high gear. We've got big bank results. They're coming on Wednesday, and we want to get you an earnings playbook with the companies and the CEOs to watch this quarter. Joining us now, we've got Eric Clark. He is a portfolio manager over at Rational Dynamic Brands Fund. Great to have you here with us, Eric, just after the opening bell. Let's start with financials since we have many of them reporting this week. What are your top picks to watch in the sector?
Well, I think the banks will be fine. Goldman should probably paint a pretty good picture, but we're more focused on the asset managers. There's a big trend in wealth management with money migrating from public equities and public fixed income over to privates. And so, those asset managers have had pretty decent pullbacks here, making, some pretty attractive entry points as we head into earnings. I think Blackstone is the first to report on the 30th or the 31st. So we're pretty positive on that sector.
Eric, do you think overall that earnings are going to live up to these expectations, especially when you take a look at tech? Obviously, you have earnings growth expected to cool just a bit, but still much of the market relying on some of that trajectory that we are expected to see and that optimism that's already baked in.
I think we're going to be in the have and the have not category. If you're doing well, then your earnings are going to be good. And if you're not, like Signet today is a good example in the consumer discretionary area, you're probably not. So, this isn't like last year where more and more companies were doing okay. I think it's going to be a bifurcated market with earnings because expectations are a little high going into the year.
Eric, I wonder, from the CEO voices that you're listening into most closely, to give a sense of the macro environment as well as how businesses more broadly could be or should be faring up against what is perhaps a measuring post for their industries. Who are those CEO voices that you believe are perhaps the most noteworthy to listen into this earnings season?
Sure. Obviously the bank CEOs have a good read on the consumer with deposit balances and activity, but 70% of the economy is consumer spending. And so when you listen to Amazon's CEO and Walmart's CEO and Costco, that's about 17 or 18% of retail sales. So that's going to give you a good indication of the consumer and where they're spending, whether there's more discretionary spending that's going to happen this year relative to last year versus the needs side of the equation. Obviously, and then on the asset management side, listening to the CEOs of Blackstone, KKR, and Apollo, they're going to give you a really good read on overall corporate activity. These guys, can see around corners a little bit better because they own 200, 300 different companies, so they can get a good read on wages, on inflation, on growth trajectories, on profit margins. All of that stuff you can kind of make some inferences about where earnings are going to be and what sectors are going to do well and which ones might be a little bit more challenged. So the CEO is, the consumer is still doing most of the heavy lifting. Manufacturing still a little bit sluggish. So we're obviously, listening to the CEOs And I want to hear more about implementations about AI and using technology to enhance profit margins and free cash flow. And we think, over the last 3 years, if you look back 3 years from now, stocks might not look as expensive as they do today if we get a lot of those operating efficiencies, from AI and technology.
Where we've got Dynatrace deployed and it's doing its root cause analytics and we've identified auto remediations, we're seeing improvements of mean time to repair going from 4.7 hours to under a minute.
Sentiment post-election. Here to discuss, we've got Holly Wade, who's the NFIB Executive Director. Holly, great to have you back on the show with us. Let's start there. Highest optimism index reading since October of 2018. So what's leading to this?
Well, certainly after the election, small business owners were really optimistic about policy expectations going forward that were going to be easier on them in operating their business. That regulatory environment that they've been having to struggle through over the last 4 years made a difference. And so it's interesting to see this huge swing, about a 90-point swing of net percent of those saying that they expect business conditions to improve from January 2024 to December 2024. So looking at the beginning of the year to the end of the year, we saw this massive surge in those saying that they expect business conditions to improve. So there's a lot of expectations on having a better business environment going forward into 2025 from DC at least, if not from their states as well.
The uncertainty index fell in December thanks to more certainty post-election, as you were alluding to a moment ago and mentioning about economic policies. Among those policies promised by President-elect Trump, tariffs on Mexico, China, Canada. How are small businesses thinking about tariffs?
Certainly. Well, one of their biggest issues, 1 in 5 are still saying inflation is their top challenge in operating their business. We know that the cost of supplies and inventory is very frustrating for them in absorbing those costs and passing along those costs to customers. But their first impact on absorbing those higher costs is to their earnings. So tariffs are certainly a factor in that. And it just depends kind of where the policy directives take us, how broad, how steep tariffs are, and how they will impact small businesses.
Turning now to labor, minimum wages are increasing in nearly half of the states this year. How are labor costs factoring into small business owners' outlook?
So we have about 11% right now of small firms saying that labor costs are their single most important problem in operating their business. That's only 2 points below the historic average of our 50-year survey. But labor compensation, actual compensation increases and planned compensation increases have eased quite a bit over the last year, 2 years. And so those pressures are easing up, even though historically very high. So those minimum wage increases will certainly impact some small business owners in either, moving up to that minimum wage increase, that new threshold, or making sure that, they're competitive with salaries that are above the minimum wage, having to increase them as well. So those pressures are still very concerning for small business owners in that it is very involved in how much they're having to absorb higher costs and passing along those costs to customers.
So which industries are facing the most difficulty from what you're seeing with filling open positions?
So right now, the 2 biggest industries, which have been the industries that have had a particular difficult time over the last number of years, transportation and construction, and also manufacturing off and on. But transportation and construction are the two that have faced the biggest challenges in filling those open positions. And we're also seeing that, there's this resurgence because of, what they expect as far as input costs into their business related to federal government and things like that. The tax extensions that they're looking to have preserved, those tax provisions that are expiring at the end of 2025. So, the sales expectation, open positions that are still very high levels, construction, manufacturing, transportation, those are the areas that are of particular interest that we see in the survey.
Holly, thanks so much for taking the time with us. Appreciate it.
Thank you.
Certainly. Coming up, Biden issues another round of student loan forgiveness in the final days of his presidency. Find out if you qualify next.
As observability has evolved from observing data to actually give you insights, give you automation with Dynatrace, we keep pushing the boundaries for you and help you with the new challenges coming up.
Oh, yeah. You're not.
DJT on a pretty volatile ride with less than a week until President Trump's inauguration. The stock notching its best day since October early this week, climbing more than 21%. Now you can see the stock under pressure this morning, down a little over 3.5%. The big question here, what is this stock telling us, not just today, but in general? What is the fundamental story? It's not clear that there is a fundamental narrative driving this stock. Starting off the week here, moving to the upside by over 20%. There was no fundamental change to the company, to profit margins, to corporate earnings. It's really that trade that tracks the Trump administration. And so I'm very curious to see what happens. Of course, we'll be monitoring this in our special coverage on Inauguration Day, kind of what happens to this stock heading into next week.
Yeah, certainly. So we're seeing a bit of a give back this morning, off just about 4%. Of course, that follows the massive gains that we saw yesterday. But Manny, it's hard to really go any further than some of these headlines and the momentum that surrounds this stock on a fundamental basis. It doesn't trade along with fundamentals, so it's hard to draw any sort of parallels or comparisons there. But again, the lead up here to inauguration, which is less than a week away, happening on Monday. Clearly, the stock will likely remain volatile and one to watch. Not necessarily maybe a huge surprise, given the fact that once again it has returned among the top trenders here at Yahoo Finance on our tickers page.
We reinvent Dynatrace on an ongoing basis for you, because as you deliver software, as your requirements on reliability and security continue to increase, we are here to help you with this, because your customers deserve that software works flawlessly.
Roofing and big ticket item sales are going up, like vehicle sales.
And so with all of this in mind, Friday's jobs report was much stronger than anticipated, sparking a flurry of headlines about the robust labor market. But during the fourth quarter, more than twice as many job seekers characterized their experience as poor rather than good. Can you explain some of that disconnect for us?
Right. So finding a job is still tricky in this market. There's unusually low hiring taking place. Hiring rates are about where they were in 2013, 2014. There's also very little job switching taking place. And so it is hard for people, unemployed people, or people who are new to the labor market, who've just graduated from school, to break in. For workers who have a job and love it, it's a pretty good market. It is not such a great place to be if you're trying to make a change. That said, we are seeing some improvement. And part of that is because in this last report, job gains that had been driven for the last year by healthcare and government actually extended into retail and professional and business services. And so that means that more job seekers are sort of transitioning from being have-nots to being haves as their industries are being lifted.
Though job seeker sentiment broadly increased during the period, 18 to 24-year-old confidence, this was interesting. It was the only age category that saw optimism tick down. So what's the deal there among some of the younger cohorts and groups in the workforce?
That's precisely that group that's having the hardest time breaking in. Employers are still quite conservative and cautious. They're seeing strong business numbers in many cases, and they are getting excited about hiring more in 2025. But many are not quite moving yet because they want to see more evidence that these gains will be sustained. And when you're in that cautious, conservative mood, you don't take bets. You need to kind of take a bet, a little bit of a risky bet on a new job seeker, on a first-time job seeker. And that's not really where employers are just yet.
Where are we seeing the most demand, at least from how employees and those who are aspiring to get back into the workforce are seeing opportunities right now?
So we're seeing the most employer demand by far in healthcare. Incredible, resilient, sustained demand at a much higher rate than we saw before the pandemic. Year-over-year job growth in healthcare is over 3.5%, 4%, and it's across the board in all kinds of healthcare roles. Elsewhere, one isn't seeing demand nearly that hot, but there are some signs of improvement in financial services and a couple of other areas.
And then just lastly, while we have you here, Julia, I wonder how this is translating through to what you're seeing in wages as well.
देखो आना तो चाहिए इसको, यहाँ तक बीच में कोई सपोर्ट है नहीं, कल के लो पे रुक रहा है, बट यहाँ पर कल कोई सपोर्ट कल भी नहीं था, कल के लेवल लगाए थे मैंने, यहीं पर एक सपोर्ट है जहाँ पर रुक सकता है। बाकी ऊपर से सेल किया है तो हाफ प्रॉफिट एटलीस्ट बुक कर लेना, या फिर पूरा भी बुक कर सकते हो। अगर नहीं आया इसके नीचे तो फिर ओवरनाइट रखने का कोई फ़ायदा नहीं है। ओवरनाइट क्या हो जाए वी डोंट नो।
This brings the total of Americans who have had their student debt canceled by President Biden to over 5 million. So who qualified for this forgiveness? Well, it includes almost 85,000 borrowers who attended schools that the Biden administration says cheated and defrauded their students, 61,000 borrowers with total and permanent disabilities, and just over 6,000 public service workers. The Biden administration has made student loan forgiveness a cornerstone of his presidency. However, courts have largely spurned some of his larger plans, including a 2023 decision that blocked plans to cancel up to $400 billion in loans and a rejection of a proposal to lower monthly loan payments. Biden's Department of Education recently withdrew plans to deliver further loan forgiveness ahead of a second term for former President Trump. Coming up, a new survey from Yahoo Finance and Marist poll shows over a third of Americans are very dissatisfied with how much they've saved. We're breaking down why. That's next.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials.
सपोर्ट रेजिस्टेंस एफईजी लगाना कैसे सीख सकते हैं? प्रैक्टिस से, प्रैक्टिस करते रहो चार्ट पे। अलग अलग टाइम फ्रेम के चार्ट पे प्रैक्टिस करते रहो, आ जाएगा धीरे धीरे। एकदम से तो नहीं आता ना, एकदम से तो कहाँ आएगा। अलग अलग टाइम फ्रेम पे जितना चार्ट पे प्रैक्टिस करोगे प्रैक्टिकल, उतना बेटर है, उतने लेवल समझ में आते जाएंगे, सपोर्ट रेजिस्टेंस एंड ऑल। बाकी और हेल्प चाहिए तो स्क्रीन पे नंबर दिया हुआ है व्हाट्सएप नंबर, उस पर कॉन्टैक्ट कर सकते हो।
According to Experian, the average American has just shy of 4 credit cards. But if you find yourself never reaching for one of those cards in your wallet, there may be some hidden benefits to canceling it. Bobby Rebell, who is the CardRates.com CFP and personal finance expert, joins me now to offer some advice. Good to see you, Bobby. What should the consumers be considering as they're thinking about canceling a card?
Well, first of all, thank you so much for having me, Brad. And this is a great thing to be talking about because we're often told to cancel things that we are not using, that we're paying for, things like streaming subscriptions and apps and things like that. But with credit cards, it is more nuanced. So I want to caution people to be very careful before canceling a credit card. Think about why you're canceling it. Is it because you maybe are worried about overspending? Well, there might be solutions that are very simple to avoid that. Is it because you're paying fees that you don't want to be paying because you're not using those benefits, or it simply doesn't fit in your budget? Again, there are solutions that we can talk about to get around that, because there can be serious financial consequences if you go about canceling credit cards, especially on a regular basis.
What are some of the pros and cons of canceling a credit card?
Okay, so the biggest pro is if you are paying a fee for something that you are not using. Of course, we don't want anyone to be paying that fee, but what you can do is go to the credit card company and ask for them to transition you, downgrade you to a different credit card, hopefully without a fee, or maybe with a smaller fee and benefits that you're actually going to be using it. You also want to avoid fraud. That's protection from others using it. It's an easy way to simplify your finances, one less thing to take care of, one less thing to track. And of course, we don't want to be tempted to overspend, so you're just taking away that one less temptation. But there are some negatives that people should be very aware of because they are very serious. For example, it can be a big hit to your credit score. So that means that, for example, let me explain why. So it hurts your credit history. So if you do cancel, you want to cancel not the oldest one. You want to keep that credit history long. You want to make sure your credit utilization ratio is optimized, meaning you have a lot more, the more credit you have available to you, the better your score is going to be. So you want to make sure that you keep that. And of course, that you keep that in its optimal state, I should say. And of course, you do want to make sure that you keep those rewards and perks that you love to use. So be aware, there may be some that you really enjoy that you would be sad to see go.
What should consumers make sure they do if they do decide to cancel, as you've just given us some of the warnings about canceling?
Yeah, so if you do decide that it is the right decision to cancel, make sure, of course, that you pay off your balance and that you, as I just mentioned, make sure to be using those perks and benefits that you have earned, that you have paid for. You also want to make sure that you time it Right. And what I mean by that is don't cancel a credit card, certainly not your longest one, before you're going to make a major purchase decision while you're applying for a loan, let's say your mortgage or a car loan, because that's going to ding your credit score right at that point. And you also want to make sure that you are strategic. Don't cancel the oldest card, as I mentioned. Make sure you document everything. Don't just assume, yeah, they got it. Make sure you have that. And then go to your other card issuers, because what you can do to help your utilization rate is ask your other credit card issuers for a higher credit limit. And that way you'll have more spending power, and that'll help mitigate the damage that you may have done from canceling that credit card that you did want to cancel for all those reasons we've discussed.
Bobby, according to bank rates, a third of consumers make every effort to maximize credit card rewards, including ones who hold the balance every month. Are there any rewards that are worth paying interest for?
In my personal opinion, no. I think that you should not do that. I think that's a big no-no. But the rewards that people are most tempted to, I should say, are probably going to be things like travel perks, because we all love, for example, to get into those airport lounges. And you can justify them. Again, I'm not saying you should, but one might justify them by saying, well, I'm saving so much money on meals when I'm traveling because I've got a big family and we can all get into the lounge. We can all get free food and drinks and have a place to work and have solid Wi-Fi and all that stuff. So you can make the case for it, but I'm still going to say, in general, credit card interest rates are so high, Brad, 20% and plus, sometimes 30% on some store cards. So really think carefully. And if you're tempted, do some math. Figure out how much interest you're really paying on those cards and then make a proactive and intentional decision. It's probably going to be saying to you, not worth it.
Bobby, good to see you. Thanks so much for taking the time. Solid insights as always.
Thanks for having me.
In 2025, over a third of Americans are very or completely dissatisfied with how much money they've saved. That's according to a new survey from Yahoo Finance and Marist Poll. Joining me now to dig into the results and what they tell us about the American consumer is our very own Casey Bond. Casey, good to have you here. So break down that stat for us. What share of respondents were satisfied with what they have in savings?
Right. Well, unfortunately, the news isn't great. We wanted to get a sense of how people were feeling about their savings right now with the new year starting, and only 22% said that they were either very or completely satisfied with their savings at this point. Meanwhile, another 35% said that they're either very or completely dissatisfied. Another interesting stat that we came across with this survey is that women are far more likely to say that they're unsatisfied with their savings. That was 40% of women versus 28% of men.
So what are some of the biggest obstacles, Casey?
Well, we certainly faced a lot of financial challenges as a country this past year, but it might not come as a surprise that nearly half of our respondents cited the cost of living as their biggest barrier.
You know, as we think about this, how are people looking to the future? And perhaps it's part of a New Year's resolution. Perhaps you're trying to turn over a new leaf, do a little bit better at saving.
Well, the good news is the survey wasn't all doom and gloom. There is a lot of optimism around saving and finances going into 2025. 44% of our respondents said that they believe they'll save more in 2025 versus 2024. And that optimism is highest among Gen Z and millennials.
Yes. All right. Love to hear that. Let's go. Casey, thank you so much for taking the time here with us. Casey Bond.
Thanks for having me.
Certainly. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
A programming note. In this week's episode of Decoding Retirement, host Bob Powell speaks with Lori Rowley, Icon Savings Plan founder and CEO, about the aspects of other countries' retirement plans that the U.S. could incorporate.
They have more sort of national mandates. So we have state by state, we have this patchwork of state retirement plans, which also is putting a huge burden on employers that have employees in multiple states, but that's a different topic. So I think if we had a national mandate, that would put the United States more in line with some of those other countries that get higher grades. The other component is what to do with that money once you've saved it in retirement and how to live on that money. And so a lot of other countries have programs that help people figure out how to live on that savings that they have acquired through their lifetime.
You can catch Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's get a check of the markets here as we are approaching lunchtime on the East Coast here. And taking a look at the Dow Jones Industrial Average, right now we are down actually across the board for the major averages. We're lower by about 0.2%. This right now is a 6-month chart that's populated here. And well, you can just see some of the activity that transpired in December and ultimately has permeated a little bit on over into January as well. We'll just go ahead and call this coal is what we got in December. But at the end of the day, one of the huge things that we're going to continue to track is what type of prominence the tech trade has within that move downward as well here. And we'll put this on a year-to-date chart just because we've got at least enough trading sessions to start to potentially look at this. Over the course of 2025, we've been moving lower for the NASDAQ composite here. The tech-heavy average has certainly been hit. It's down by about 1.5%, 0.4% here on the day. S&P 500, you're seeing that down by about 0.3%. Since I mentioned technology, let's take a look at some of the sector moves that we're seeing on the day, and then I'll also bring a little bit more context to some of those year-to-date moves. XLK is what I was bringing up a second ago, down 0.2% here on the day. And of course, just to give you that year-to-date move, we're down by about 2.5%. And why don't we just put this on a year-to-date move for all of these sectors here right now, which gives us a little bit more of the clear picture as to what's been moving lower as we've started off 2025 here. You've got XLP Staples, that's down by about 3% here to start off the year. Of course, we're just getting into earnings season. We had Delta last week, we had Walgreens last week, and so now we're going to get into the banks starting tomorrow and through the rest of the weekend. Also, we're going to get some CPI data. That could also be market moving as well here, so we're going to continue to track that. But as of today, there you're seeing a little bit of a mixed picture. Utilities leading the charge. That's it for Wealth, everyone. I'm Brad Smith. Thanks for watching.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today we're going to go behind the headlines with Lori Rowley. She's the CEO of Icon. Welcome, Lori.
Hi, how are you, Bob? Nice to be here.
Well, I'm great. Great to have you here. So I want to talk about the problems with our retirement system here in the United States. But first, I want to make mention, do a little table setting. Experts like Alicia Minnell, she's written a book that several years ago that talked about the shortcomings of the 401k plan. Teresa Gilbert-Ducci has written about the shortcomings. MRSA recently gave the U.S. a C+ for our retirement system, saying that it has some good features, but some major risks and shortcomings that should be addressed, and that without these improvements, the efficacy and long-term sustainability can be questioned. And with just 50% of workers having a workplace retirement plan, we have a coverage problem that shows up in people having a lack of confidence in their being able to maintain their pre-retirement standard of living in retirement, according to the Employee Benefit Research Institute. So what say you, and what can workers do who don't have access to a workplace plan do to help improve their retirement security?
Well, first of all, I just want to echo, some of those findings that you were just saying. And I think it's important to kind of understand how we got here, which is, we've relied on the 401k system for such a long time, and it's been a really good plan for a whole bunch of people, but it was created 50 years ago.
And almost by accident, right?
And almost by accident, right?
They should be
because
equalized,
so many people. Yeah, because so many people don't have access to a 401k plan. So why are we penalizing those people with a capped lower rate of annual savings?
Yeah. So would you do the same for both traditional IRAs, Roth IRAs, and spousal IRAs?
Of course. Yeah. I mean, I don't think we have anything that's going to, there's no problem with people saving more. I mean, we can think about those sort of tax incentives and where to do it. But I think as a whole, society gets better off when people have more money saved, not only for their future, but it's also it's a good way to start off people on better financial decision making.
Right. Lori, when you think about like how we got to this place where only half of workers have a retirement plan in the workplace, I think about the history of, there was a time when, 80% of people had a defined benefit pension plan at work. And over time, the percentage of people who have a defined benefit pension plan at work has declined considerably. And so we've got this problem here where now people maybe who heretofore had a retirement plan don't. And so for them, the solution is an IRA. And I know we're going to get to your 3.0 solution, but can you sort of talk about this history? I feel like, to me, like a social contract was broken with the sort of the demise of the defined benefit plan.
Yeah, I mean, and there's a lot of reasons. I mean, you can go way back and figure out why employers started to offer a retirement plan. It was really to keep workers, like the idea was, Bob, as you know, to keep that employee staying at that employer for their whole career, right? And there was a bunch of incentives on the employer side and the employee side that they both wanted to do that. But as we said, times have changed, right? So when we switched to the 401k plan, sort of the incentives started to change. And now you see an environment where employers don't want the burden of a 401k plan. There's some cost and complexity issues that are really, the incentives are that they want to move away from that. So I'm not going to change that part of the, economy. So I think what we need to do is adapt to what's happening in the workforce to, reconstruct that social contract in a new way. We can't keep relying on the systems that we've used in the past because they're failing. They've been good. It's nothing, it's not attacking the 401k plan. It's a perfectly good solution for a subset of the workforce, but it's just not adapting, and it can't adapt to the needs of where we are today.
Yeah. So one of the problems that you've mentioned in the past about these retirement plans is that of portability. And I want to play a clip. One of the things that we recently introduced here on Decoding Retirement is we, instead of talking at people, we wanted to talk to people about their retirement, about the reality of their retirement. So we went out on the street, and then I want you to watch this clip, and when we come back, we can talk about it.
From a previous job, I still have some, like a 403B or 401k, and it's nice to just have that little cushion and that comfort, I guess.
Yeah. Were you able to roll that money over, by the way, into an IRA or okay. Yeah. So, Lori, in the clip, our worker, a young worker, was at an employer that had a 401k plan. She left that employer and rolled that 401k over into an IRA, which is perhaps more the exception than the rule. Tell us a little bit about, your issues with portability, and what should people do when they leave their employer with their old 401k?
Yeah, so the portability failure of the 401k plan is because the plan was never really constructed to be portable, right? So there's all these like patchwork systems that people can do. So basically 3 things happen when an employee leaves their employer that has a 401k plan. They leave it behind. Actually, just today in the news, there was a story that 25% of all assets in all of the 401k plans are abandoned or lost plans. So you've got 29 million people that have lost their 401k plans. That's when they walk away from it, they forget where it is. You've got about 800 billion that's rolled out of 401k plans into IRAs. So that's what she did. And then you have a much smaller, just a tiny segment of people that roll it into an employer's 401k plan. And that could be because it's a hard thing to roll into another employer's 401k plan, or maybe they're going to an employer that doesn't have one. And so that's why you see all of this money going into IRAs or getting left behind or getting cashed out. So that's the portability failure, in my opinion, which is it's a lot for us to expect people to make these decisions every time they change jobs about where they're going to put the retirement plan, what investments they're going to have, what is their portfolio. It's the most important asset that people have in their life, and we're asking them to change it every couple of years. That's where the problem comes in.
Right. So what's the actionable advice? Is this on the employer, the HR department, and say, hey, you've left the workplace here and you've left behind this money, you should do something with it? Or is it on the employees, onus?
There's a lot of different opinions on this. After my years of being in the retirement industry, I absolutely think that every individual should keep their retirement plans with them. And so I think they should take it out of that employer's plan and put it into an IRA so that they have control of it. They have, they know where it is. They can monitor their investment. They can watch the fees and their portfolio and not be subject to losing their plan. We just set up a lost and found in our country for old 401k plans because it's such a huge problem. And so I think people need to keep that asset with them through their whole life.
So 2 things. One is the government does, although belatedly, does send you a notice that says, hey, you may have left behind a retirement plan at an employer that you were with 10 years ago. Right? So that is occurring, right? The government is sending out notices.
Well, yeah. The challenge is that if you don't have if your address has changed, which oftentimes it does when you change jobs, you become disconnected from it. So you never get that piece of mail, right? So it's one of there's an enormous amount of undeliverable mail in that space. It's one of the huge problems. And sometimes people are getting checks and they don't find them, and then they're never cashed. And so that's what happens. So it's an address issue too. I know that seems like a really basic problem, but it's a huge issue in the retirement space.
Yeah. And the other is, at the moment, though it's uncertain what will happen with this, but the Labor Department has issued regulations or rules that require advisors to go through a process with respect to rollovers. And for some, it's onerous. Yes. And for some, they say, well, I'd rather not give advice on whether you should roll it over or not. I should just give you education so I don't have to be subject to the rules and regulations of the Labor Department.
Yes. I think that there has been a reluctance in the industry to educate people on their choices, but I think there is a good case to be made that clear education goes a long way, and it's not a recommendation. If you can lay out to people what their options are, people are smart. They just want to be told in simple, clear language what they need to do and give them an easy way to do it. Right. So there's a lot of convoluted, complicated, as your podcast is titled, decoding language in the retirement industry that folks don't understand, because why would you if you're not, haven't been in that industry for 30 years? So give people clear educational information on how to make informed choices about what's best for their finances, and people will do the right thing.
Yeah. At the moment, where do you recommend people go to get that kind of education? The Labor Department or SEC or FINRA, or where to?
I am loath to make those kind of recommendations, Bob, because it's just not a lot of good sources. I mean, source of truth really would be a government resource. You're going to have to kind of parse through some of the jargon there to understand that. But that is really the most unbiased source of information, is looking at the Department of Labor or the IRS about what your options are.
Right. So much of the problem for our coverage issue in the U.S. is due to small business owners not necessarily wanting to offer employees a 401k plan for a couple reasons. Yep. One is there's a lot of turnover maybe in the small employer environment. And two, the hurdles for small employers to put in place 401k plans is maybe somewhat onerous. Yep. But Secure Act 2.0 did put in place incentives for small business owners to offer these plans to workers. What are your thoughts about that, and whether there'll be any uptake in that?
I mean, we've always had incentives to try to get small employers to offer 401k plans. They increase those incentives with Secure 2.0. I don't think we've seen the big uptick that folks were hoping for. And it's because those incentives run out. And then the employer is still standing there holding this plan that they have a really hard time managing and paying for. And so I think that going back to the drawing board, we need to have better solutions that address the needs of small businesses.
So, Lori, we have to take a short break. And when we come back, we're going to talk more about your solution to the retirement crisis here in the United States. Don't go away. Welcome back to Decoding Retirement. I'm talking with Lori Rowley. She's the CEO of Icon. Lori, you have proposed something called a PRP, a personal retirement plan, as your solution to our crises here in the U.S. What is it?
It's a portable retirement plan, and it's a combination of a workplace retirement plan and an individual plan. So that works just like a 401k plan and how it feels, right? So we know that getting folks to save through their employer is a really, really good way for people to build their financial wellness. The challenge is how do we make it easier for employers to offer a retirement plan? So the PRP works and acts like a 401k. An employer sets it up. The employees have their contributions put into their account through payroll. But the big difference is that it removes the costs and the complexity and the fiduciary responsibility from the employer. So they can set up this plan on our platform. We engage the individual. We're the registered investment advisor, so we hold the fiduciary burden to the individual. We can put them into a personalized portfolio that's tailored to their needs, and their savings go directly into their own account that they own because it's a form of an IRA. And that means that when the employee leaves that employer, they take their plan with them completely intact, so it removes the need entirely for a rollover. So your plan can stay with you. You don't have to change your investments. You don't have to change anything about your plan. You just disconnect from your employer, and you can go on to use your plan at your next employer. You can use it in conjunction with a 401k plan if you have one at your next employer. You can use it if you're a gig worker or a 1099 worker. It's agnostic to your employment status. So the idea here is really to keep you with your plan through your lifelong savings journey and make it really simple and easy for employers of all sizes to offer a high quality, easy to use plan.
Right. So it sounds like it doesn't require any regulatory involvement to create this sort of thing. Is that correct?
On the part of the employer, yes, not on our part. We have a few regulatory hurdles, and of course, we are under the auspices of the SEC as a registered investment advisor. But yeah, so the employer doesn't have to do any legal plan document. It's not a sponsored plan. It's more of a facilitated plan. So the employer can set it up. It takes about 30 minutes to do that from end to end, and their employees can have a retirement plan in under an hour.
Right. So you mentioned that the employer doesn't have any fiduciary responsibility. That's one of the hurdles that small employers say that exists when they're setting up a 401k plan for their employees. Who bears the fiduciary responsibility in your PRP?
So we do, right? So I don't believe, so we're a registered investment advisor, we're a fiduciary. So we hold the fiduciary responsibility because we have the certification and the licensing to do that. I think it's onerous to expect employers, so many small employers, to have a fiduciary responsibility to their employees. And that's what happens in a 401k plan. And you're talking about businesses that, have owners that may not have expertise in investing in portfolio management, and they have to go out and set up a plan for their employees. And that puts too much of a burden on the employer. That's why you see very few net new 401k plans being created in this country. Morningstar puts it at about between 4,000 and 5,000 a year. Net new plans are created in our country. So you can see how employers are just really resistant to that kind of regulatory and administrative burden that's sitting on top of them with a 401k plan.
Yeah. So we can add your solution to the mix of things that people are experimenting with. We've seen things like state IRA programs being launched in, I think, about 20-some states now, give or take. I might be wrong on the exact number. What's your thought about state IRAs and whether people should be taking advantage of those as a way to sort of at least save for retirement in an environment where their employer doesn't offer a plan?
Look, my whole career has been around getting people to save more, and whatever way we can get people to do that, I think is the right thing to do. One of the things that is just a truism of life, that the easier you make it for people to do something that's hard, the more likely they are to do it. And I don't know that the state plans can overcome that hurdle of how easy it is. It's a little complicated for employers and individuals, but if they can do it, I think that's great. There is some portability friction there with those state plans too. So I really think, though, the important thing to focus on is how do we think about sort of next generation retirement plans and helping employers get access to them.
Yeah.
Either through state mandates, because, the state-run plans are also accompanying mandates. So you have this forcing function of, California, we have millions and millions of businesses that are impacted by the mandate here. And I think that flexibility of options and choices is always a better thing in the marketplace. So you can have the state-run plan if you want to use that. If that works for your business, you can use a plan like ours, the PRP, or a 401k plan if that works for your business. So I think that optionality and flexibility is the path forward.
Right. Lori, I mentioned at the beginning of the podcast here that Mercer has rated the U.S. as a C+ when it looks at all the retirement systems across the world. When you look at other countries, what is it that others are doing who earned like an A grade that we ought to be looking at to incorporate here in the U.S.? Any thoughts about that?
Yeah, I mean, I have thoughts on that. There's two big components of that. So they have more sort of national mandates. So we have state by state. We have this patchwork of state retirement plans, which also is putting a huge burden on employers that have employees in multiple states, but that's a different topic. So I think if we had a national mandate, that would put the United States more in line with some of those other countries that get higher grades. The other component is what to do with that money once you've saved it in retirement and how to live on that money. And so a lot of other countries have programs that help people figure out how to live on that savings that they have acquired through their lifetime. And that's where our system really falls short. There's a whole bunch of reasons why. I'm sure you've done multiple podcasts on that topic of retirement income. It's a challenge that we have in our country. Part of it is because of the 401k system and how that doesn't really interface well with the retirement income system. But again, as we're looking for retirement 3.0, I think part of it has to be more personalized, easy to use options on the living on your money in retirement component of the equation, which we haven't solved that at all in our country. It's a huge problem.
Yeah. I mean, when you look at countries like Australia, where they have a superannuation program, or maybe in the United Kingdom, where they have the Nest program, are those things that you think would be worth adding to our sort of mix of solutions?
I mean, we're talking about, I think it's good. There's been enough years of saving under those plans to look at what's really worked and what hasn't, because they have problems too, frankly. And so I think we have an opportunity to learn from those countries and see what they've done that's worked for them and maybe come up with a hybrid system. I wouldn't say we should exactly copy some of those other systems, but having, dug into the data there, I think there's a lot to learn and a lot of good takeaways that we can sort of build on for a national retirement policy that works for businesses and employees.
All right. So we often talk about the retirement crisis here in the United States, and I sometimes like to quote Andrew Biggs, who you may know, who says there is no retirement crisis, right? There's no retirement crisis for the highest income quintile Americans, and there's no retirement crisis for the lowest income quintile Americans, but it's the middle income quintiles for whom the retirement crisis is real. First of all, any reaction to that? And two, how do we solve that if that's the case?
I mean, Andrew's got some interesting ideas. I chat with him about it from time to time. We don't see eye to eye on this. I actually think we have a retirement crisis for a whole bunch of folks right in the middle that don't have coverage, go in and out of coverage, have expensive coverage if they have it. And I don't think that Social Security is going to be the solution, especially considering the fragility of that system and how long people are living. That's not really an appropriate response to people not having enough retirement income. I think the system has worked well for people who work for large corporations and are in the top, 10% of earners in our country, but it's everybody else that is really struggling. I think you might be a little isolated in that feeling, especially if you ask folks. I mean, I think you have to go right to the heart of the issue. Ask individual savers, participants, employees, what they think about their financial security. I've been doing a study for the last 20 years on this topic every single year. And every single year it gets worse. As you mentioned, people are more worried about their financial prospects, their financial health, having money to live on when they retire. And so I think that that's really the data that we need to focus on, is what is the day-to-day experience of people living, today with their financial health in the state that it is, and how they are feeling about their savings and their prospects for their future.
Yeah. I'm fond of quoting the Employee Benefit Research Institute data, where they have the retirement confidence survey for umpteen years now. And year after year after year, it seems like only 25% of people are very confident about their prospects for having a secure retirement. And that number hasn't really moved at all over in the
It's never moved in the years that we've both been in this industry, Bob. That number has never moved. So we're not going in the right direction. And I think there's just so much opportunity to do better, right? We don't have to look for perfect necessarily, but we can certainly do better than we are right now.
Yeah. Lori, we've covered a lot of ground. Anything we missed or just bears reemphasizing before we wrap up?
Yeah, reemphasizing for anybody listening out there. I know that when people meet me, Bob, I don't know if it's the same for you, but when people meet me, like the second or third question they ask me when they find out what I do, what industry I work in, they're like, I have an old 401k plan. What do I do with it? So I just want to tell folks, anybody listening out there, if you've got those old retirement plans, take a day, take an afternoon, go find them, collect them, put them in a safe place so you don't become disconnected from them.
Yeah. Lori, I want to thank you for joining us today and sharing your knowledge and wisdom with our viewers and listeners. It's so greatly appreciated. Thank you.
I appreciate being here. Thanks so much.
Thank you. Up next is a segment that we call Ask Bob, where we answer a reader's question. And the question goes like this. I've been retired from the federal government since I was 53 years old. I'm now 64. It was a buyout, hence full retirement benefits. Since I have the federal employee health benefit through OPM, do I need to enroll in Medicare once I turn 65? And the answer is this. The Federal Employees Health Benefits Program is considered creditable coverage, which means it satisfies Medicare's requirement for health coverage. You are not required to enroll in Medicare Part B at 65 if you're happy with your FEHB coverage. However, there are a few considerations to weigh. So that's it for this week's episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget, for the latest retirement news and expert analysis, check out yahoofinance.com.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.